that trick when you have the trolley and you take your arm in behind the shelf and you sort of scoop the whole thing out into the basket trolley? That's how I shop when it's on offer. Sadly, the financial market is a very different proposition. And what really affected me was a phone call that I received after that long thing there. It was Saturday morning and someone called me and said, hey, you gave a talk up here up north and I just wondered if I could have your opinion. My brother and I want to invest in Northern Rock because we think that it's a fantastic stock and it's probably a rare opportunity that is so cheap. What do you think about that? And I said, well, I'm not so sure it's a good idea, and there's two reasons for that. One, supermarket aside, that mentality doesn't work in the financial market. And secondly, let's say you do buy it here, and it miraculously does turn around. You now forged a pathway in your mind that says, hey, next time a really good stock comes along and it's fallen 66% from its peak, now might be a good time to buy as well. And you might get away with the first time, you might get away with it the second time, but overall, you are playing Russian roulette, and sooner or later, you are going to get your head handed on a silver platter. Thank you very much. And I don't know, he probably went ahead and bought it anyway. But this is the story of Northern Rock, and it happened 100 meters from where we are today, approximately 12 years ago. People queuing up. And that picture is a fascinating picture, ladies and gentlemen. Why? Because the night before, the government had announced that no account depositor of Northern Rock would lose as much as a penny. Yet even though the government of all entities had guaranteed people's deposits, people still queued up. Well, if you don't trust the government to honor an IOU, who will you trust? It was pointless to queue up. It was a futile exercise. The money were guaranteed, but such is the power of fear. And it made an impression on me. And it leads me on to a story that I'm not particularly proud of telling, because I think that the Me Too generation has done an incredible amount of work to shine light on behavior by men that shouldn't be there. Nevertheless, in a much less illuminous times, the father of modern economics likened speculation to a beauty contest. He said, you will be presented in front of you 30 beautiful ladies. And your job is not to say who's the prettiest. No, your job is to say, who do everyone else think is the prettiest and the second prettiest and the third prettiest? That was his premise for the financial markets. Our job is not necessarily to think about the markets in the context of what we think will happen, but to think about, what do I think you think? What do I think you think and you think and you think? He called this once removed thinking. The idea of don't attack the market from the point of view of where do I think it's going to go? Think, where do everyone else think it's going to go? He likened it to a beauty contest, where the job wasn't to select who you thought was the prettiest, but who you thought everyone else would think was the prettiest. Otherwise, you wouldn't win the competition where in the newspaper where this was presented. Okay, so now we come to thinking in scenarios, and this is what I want to cover in the web seminar that we will be holding later on. It will probably be next week by now. I want to start off with a piece of analysis that I did a while ago. This is the statistics of the Dow Jones Index over the last 7,500 trading days, or 30 years. What I find incredibly interesting is that this is the distribution of the losing days and the winning days. Now, when we started trading the Dow 30 years ago, the Dow was trading at 1,700. Today it's trading at 29,000. So However way you think about it, we have been through an amazing bull market over the last 30 years. Yet the distribution of winning days and losing days in the Dow Jones is exactly 50-50. Over those 7,500 trading days, half of them were winning days and half of them were losing days. So for all this talk of technical analysis, when I come to work in the morning, I realize whether we're in a raving bull market or on a devastating bear market, the odds of a winning day or a losing day is 50-50. And it's a sober thought, because you go to work and you're thinking anything can happen. Absolutely anything can happen. So what I would like to show you over the next 15, 20 minutes is to perhaps touch on the things that you had hoped I would touch on an hour and a half ago. And instead I got well traveled down the road of psychology. What you'll see is statistics for the last 256 trading days. And these are some of the questions that I have asked myself and answered. If Thursday is higher than Friday, then what does the following Monday look like? If I only traded extended bars on a scalp basis, how would I perform? Would I make money? Is there evidence to support that what Monday starts, Wednesday will continue? How often is the high or the low of the Dow Jones made in the first 30 minutes of trading? How often do gaps occur, and how often are they filled? How often does a trend day occur? And if you don't know what a trend day is, you will. Are there any common denominations between strong trend days? Is there support for the comment that if you have a strong Friday, you'll have a strong Monday? If Tuesday is lower than Monday, then what does Wednesday look like? These are some of the questions that I have asked myself. And the reason why I ask myself those questions is because it gives me a roadmap of what I can expect. Doesn't necessarily mean it will happen exactly as I hoped, but it's an incredible guide into what I can expect. And it has been invaluable for my trading. Let's take an example. How often is Monday the high or the low of the week? Not a particularly interesting question, because frankly, I will only know until Friday night whether Monday was the high of the week or the low of the week. But it actually happens that 60% of all trading weeks, Monday is the high of the week. Now, this information by itself is not particularly helpful. However, say you prepare for trading on a Thursday, and you see that Monday so far is the highest day of the week. Could that piece of information help you when you are trading the Dow? And by the way, why am I so focused on the Dow? The fact of the matter, if the spread betting companies and the CFD companies were reporting what products were traded, you will find that Dow Jones is one of the most traded products. I happen to know a CEO of a spread betting company here in the UK who has stated for me that 90% of all their trades by volume and by stake size are executed in the Dow Jones index. Yes, wow, that's what I thought too. So let's take a look at it. The result I'll show you, they're manually tested. It means that I have printed out about 7,500 charts that I go through manually. Yes, it's quite the library I have at home. Maybe not everyone's idea of a library. I have asked myself this question. If Monday so far is the highest traded point for the last 3 days, i.e. Monday, Tuesday, Wednesday, then how often is Thursday going to trade below the low of Wednesday? I found that there was a total of 25 times when I was faced with this possibility. And out of those 25 times, Dow traded below the Wednesday low 21 out of those 25 times. To me, that's a significant piece of information. Let me show you some examples. Over here is Monday, then Tuesday, and then Wednesday, and then finally Thursday. Another example. Monday is the high, and by the time we get to Thursday, big move down, even though it was a gap up. Another good example, and I will show you bad examples too. This is not a one-way street where I'm just trying to present the facts in a biased way. No, I'll present it as is. Monday, Tuesday, Wednesday, Thursday. I call this scenario analysis, and I have never ever come across anyone dissecting the markets that they're trading in this manner. Let's carry on. If Thursday is higher than Friday, then what does Monday look like? Over the last 2 weeks, there were 21 instances where the price action on Friday was unable to trade above the highest point of the previous day, which was Thursday. I then looked at what happened on the following Monday, and if there was a holiday on the Monday, I would view the price action on the Tuesday. Considering the random nature of the markets, remember the random nature of the markets? Over the last 30 years, we've had 7,500 trading days, and out of those 7,500 trading days, half of them were winning days and half of them were losing days. That's random. Yet out of those 21 instances, what you're seeing here is Thursday and Friday, and then the subsequent Monday. And you'll see that's a rather sizable gap. One more example, Thursday, Friday, and on the following chart, Monday. A very recent example from 2 weeks ago, Thursday, Friday, and then a big gap down on the Monday. Do you think I go home short on a Friday night? Of course I do. Have I sometimes got my head handed to me on a Monday morning when the market opens? Of course I have. But the stats are outrageously compelling. 20 out of 21 times, based on the last 252 trading days, based on the last 21 observations, the market has traded lower on the Monday. As my friend put it, he was rather minion-like. What? Yes. Gaps. How often do gaps? I've investigated every single gap since 2008. And I found that the odds of a gap being filled on the day is 58%. And here I'm talking about gaps more than 10 points. We're not caring about a gap of a 5 point. But any gap more than 10 points, there's a 58% chance that the gap will get filled on the day. So that you'll have to admit with me, that's kind of random. That's the kind of statistics that you're thinking, I can't really use that. But that's okay. Oh my God, ladies and gentlemen, I once investigated the tide in the Hudson River and correlated with the S&P 500 futures. It was an immensely interesting project. Taking the tide table from the Hudson River, drawing it on a chart, and then correlating it with the S&P 500. Do you know what I found? There's absolutely no correlation between the tide in the Hudson River and the S&P 500 futures, but it was interesting. And I thought I was onto something there. And every now and then I thought, this is looking promising. But when I viewed the whole thing dispassionately, I came to the conclusion that there's absolutely zero correlation between the tide in the Hudson River. You may ask, how did you get onto such a crazy idea of the correlation of the tide to the S&P 500? Well, you've heard the idea that the full moon will influence the water. And, you've probably heard that notion of, lunar tech. It comes from lunar, full moon. And so the idea was thinking, hang on. If the moon can affect the waters to such an extent in the Hudson River, surely it must be able to affect us. No, it doesn't. I don't care. I actually studied this because I was quite curious, and this has got nothing to do with trading, but the evidence, the scientific evidence on the effect of the full moon on us, it is just rubbish. There's zero understanding, but that's the danger of half knowledge, half wisdom. So, well, a nurse comes out, that was a crazy night in this hospital. Oh my God, it's full moon. This is what we call an observational bias. So the next time, oh, that was a crazy night. But you're forgetting all the other nights that was absolutely quiet when it was full moon. Anyway, 58% doesn't really make a trend, does it? It's slightly biased to one side, but it's still pretty random. However, if I look at all the times when the gap is not filled on the day, I'm beginning to get something which is a little harder hitting evidence. I found that 78% of all gaps get filled at least within 3 days. So if you have an unfilled gap on day 2 and you're coming to day 3, you're thinking, well, there's 4 chances out of 5 that we're going to fill this gap today. It doesn't mean that I necessarily take a position according, but it's good knowledge to have in your background. See, this is what I call awareness, just like the mayonnaise example. I'm aware that it is there. Oh. The high of the day and the low of the day. No, I don't know if this is any interest to you, but when I trade, where I make my biggest killings isn't when the market is having what we call a trend day. A trend day is defined by that the high of the day or the low of the day, not that I know it at that time, the high of the day or the low of the day occurs very early in the trading day. And by the time the market closes, the market has moved to the exact opposite. It closes near the high of the day or the low of the day. So you're virtually just having a one straight line all day or one straight line. And I always play for that. That means it's very important for me to know what the odds are of the high of the day or the low of the day being made early in the trading day. And would you believe it? Out of 100 trading days in the Dow Jones, 20 of those 100 trading days, the very first bar that you see at 2:30 in the afternoon when the Dow Jones open is going to be the high of the day or the low of the day. I think that's quite interesting. I can see you share my absolute passion for that. That's quite all right. I know it's getting late in the evening. But by 30 minutes into the trading session, or what I call bar 7, bar 8, there's now a 50% chance that we have already seen the high of the day or the low of the day. And by the time we're getting to an hour and a half, there's now a 70% chance that we have already seen the high of the day or the low of the day. And by the time that we hit the 18th bar, now there's 12 bars in an hour, so this would by definition be an hour and a half into the trading session. There's a 90% chance that we at that point have already seen the high of the day or the low of the day.
Dive deep into the world of finance and economics with this comprehensive video course. Whether you want to make smarter investment decisions or you're looking to grasp the intricacies of global economies, this course lays a great foundation. The course combines theory with practical insights, paving the way for you to navigate the financial realm with confidence. Sri Ram originally taught this course in person and now has put together an excellent video course on these important topics.
Hello, everyone. My name is Shram Chandi, and I'll be taking you through this course on economics and finance and how they're relevant for businesses. Throughout this course, we'll be learning a variety of topics, starting with the key concepts for business, capital markets, valuation of stocks, business strategies and financial statements, how to analyze these financial statements, and things like capital budgeting and cash flow. We'll also discuss things like the business cycle and industry analysis, ESG, macroeconomics, portfolio diversification, and alternative investment types. Throughout this course, you'll learn a variety of different topics in all three of these disciplines and understand the interconnected nature of economics, finance, and business in this world. I also have a YouTube channel called Changemakers Media, which you can see in the comments. I would greatly appreciate it if you guys could subscribe there. I share stories on how teens are making an impact in the world and how you can go ahead and support them. Welcome to the first class on economics and finance. So, a thought experiment to start. Imagine you had a magic box and it outputs $1 a day, or $5, or $20, how much ever you want, and it runs forever. How much would you pay for this box? Some people say $1 million, some people say $1 billion. Well, let's look at it from a statistical standpoint. Instead of a box, let's imagine we have a savings account, and it gives you 1.05% interest annually. How much would you have to put into the savings account to generate $1 a day? Well, using Excel, we can identify that the principal, or the original amount we'd have to invest, is $34,761. This is a large amount, and fairly so. This is due to the small interest rate that we're getting in our savings account. Let's look at another example. Imagine you want to buy a house, and the market price is $100,000. You contribute $20,000 towards this down payment and take out an $80,000 mortgage, which is a loan. How much would you have to pay to get rid of the mortgage? Well, if you have an annual contribution of $9,396, you would assume it would take just about 8 or 9 years to pay off the mortgage. But in reality, it takes 20 years. And this is due to the interest rate of 10% applied on this mortgage. If you look towards the bottom, over the course of our payments, you notice that from 2019 to 2020, our balance, or the principal, only drops by $1,400-ish. This is because the majority of our $9,000 contribution is going towards paying off interest on the mortgage. And we see this effect persisting throughout the course of our payments. However, it does diminish as the size of the principal decreases and our interest payments decrease. So, our key concepts for today's class: return on investment and time value of money, and net present value. So, would you rather make a return of $1,000 or 25% on an investment? You can't really compare apples and oranges. So, what is ROI? ROI is a tool that allows you to compare the efficiency of one investment to another investment, thus allowing you to compare apples and oranges. ROI measures the amount of return an investment generates relative to the amount that you invested. So, this is the formula for return on investment. Current value of an investment minus the cost divided by the cost. So, let's take the example of the house again. Imagine you purchased it for $100,000 upfront, and now the market value of the house is $150,000. Using the ROI formula, we can deduce that you had a 50% return on investment. So, why is ROI important? Because it allows you to compare assets of different classes and express it as a percentage. It also provides a basic measure that's universal to compare an investment's profitability, and it's a basic element in all analysis and decisions for companies and individuals. But it is limited. So let's look at this example. In investment 1, you invest $1,000 in some real estate and sell it for $1,200 a year later. So your ROI is 20%. In investment 2, you bought $2,000 of stock and sold it for $2,800 3 years later. Using the formula, you have a 40% ROI. So according to ROI, the second investment is better. But when you look at the time considerations, you spend 3 times as much time to make that 40% ROI as you did for the 20% ROI. Hence, ROI is not the say-all, be-all measure of the value of an investment. Okay, now let's look at the time value of money. Continuous compounding. So let's assume you have a savings account and it generates 10% interest per year over 20 years. Initially, you invest $1 into this account. Over the course of 20 years, with that 10% interest rate, the value of your account will rise to $6.73. That's 6.73 times the amount you initially invested. And this is the power of continuous compounding, or compound interest. So, time value of money. This concept says that money is worth more today than in the future because of the potential earning capacity that money has, as seen in the example, and because the power of money decreases due to macroeconomic effects such as inflation. So, would you prefer $1 today or $1 in 5 years' time? With our previous example, we could deduce that we would like $1 today. This is because we have the potential cash flows that money can create during this 5-year period, as well as the avoiding of the potential effects of inflation. Now we have net present value, the last of our 3 key concepts for this section of the video. So, net present value is a pretty straightforward concept, and it's as the name suggests. the net of all cash inflows and cash outflows to determine the value of an asset. Cash inflows and cash outflows essentially represent the income and the sunken costs that an investment has taken. So, how do we calculate the net present value? But before we can calculate it, we need to understand net present value is an important tool to determine the value of an investment. If net present value is greater than zero, that means an investment was a positive investment generating good returns. Before we can calculate what net present value is, we have to understand something called the discount rate. Discount rate is the interest rate used to determine the present value of future cash flows in a discounted cash flow analysis. Essentially, it's the interest rate that the Federal Reserve charges on short-term loans. We use it to calculate the value of money in the future due to macroeconomic policies like inflation, which decrease the value of future cash flows. So, once we understand what the discount rate is, we can accurately calculate the net present value. So let's assume you purchased a vending machine. To purchase the vending machine, you had to spend $10,000. This is reflected in year zero with a minus $10,000 cash flow, which is a negative cost. In year one, your vending machine returns you $2,000 in profits. And in subsequent years, it returns $3,000, $5,000, and $7,000. So if you were to add up these numbers, it would give you a $7,000 net present value. However, accounting for the discount rate, which assumes the loss of money due to increasing interest rates, our net present value is only $4,704. Although it's less than the $7,000 that we would have received if money didn't lose value, it's still greater than zero, which indicates that the vending machine is indeed a good investment. Okay, so here we have a Google Sheets laid out with the payments of a mortgage you would make if you were to buy a house. So returning to a similar example, let's imagine we're buying a house for $150,000 this time. So you have a 20% down payment, which is $30,000, which leaves you with a payment of $120,000, which you're going to be paying off with a loan. So let's say your loan principal is $120,000. You have a yearly interest rate of 10%. This means your yearly payment for a 20-year mortgage would come out to $13,896. So as you can see here, over these 20 years, you're going to be paying off this mortgage with your yearly payments. So every year you pay off the exact same amount. However, the principal amount decreases. So in the first year, you start with $120,000. After your first payment, you're left with $118,000, and so on and so forth until you eventually reach zero at the end of your 20-year mortgage period. However, it's important to note the changes to the principal amount as time progresses. If you notice, from year 0 to year 1, our principal only decreased by just shy of $2,000, even though you're making a payment for almost $14,000. The reason for this is the majority of your payment is going towards paying off the yearly interest rate on your principal, which is 10% of $120,000, which is $12,000. So of your $13,896, $12,000 is going towards the interest, and only $1,896 is going towards paying off your principal. This goes to show you how interest rates can actually end up costing you a lot of money. So a $120,000 loan ends up costing $277,940 by the end to pay off the principal and the interest. So that means you're paying $157,940 on interest. All right, so what are capital and financial markets? What is capital finance and who provides it? And how do businesses and governments obtain financial capital through these markets? So, a financial market is a place where two or more people come together to exchange goods or services. They can be physical places, like a grocery store or supermarket, or virtual places, like, for example, the Netflix subscription page. Although this is less obvious of a marketplace, it is still an area where two parties, the individual purchasing the subscription and Netflix, come together to exchange goods and services, or in this example, a Netflix subscription, which is a service. So, the importance of financial markets. Financial markets are vital for growth of firms as well as achieving individual consumers' desires. Many firms produce goods and services that individuals would not be able to acquire themselves. As a result, it's important for financial markets to exist so consumers can have access to these goods. It's also important for firms. This is because unless they're able to trade their goods and services, they won't be able to make returns on what they're producing and grow as a result. So now we'll go over the stock and bond markets. So first of all, what is a stock? So a stock is a security that represents a portion of ownership in a company. So people can only purchase stocks from a public or private type of company. Public companies are companies that trade their stock on a public platform where anybody can purchase it. Examples are Amazon, Apple, and Tesla. If you wanted to right now, you could go and purchase their stock. Private companies, on the other hand, are held by certain owners, typically the people who started the company. In certain situations, they may choose to sell their stock, but not on a public platform, only privately to maybe their friends and family. So, what are stocks issued? Stocks are issued by companies to raise finances for their goals. These may be expansion, raising money for inventory, and so on. Stocks are also referred to as equity. And as many of you have seen in the Shark Tank show, we see the term equity thrown around. In this example, Kevin offers $400,000 for an $8.2 million valuation. So the company's total equity or stock is worth $8.2 million, and Kevin's offering $400,000, which represents 4.8% of that total equity. So he would be owning 4.85% of the total stock of that company. So now, what is a bond? A bond is an instrument that represents a loan made by an investor, which is you, and a borrower. So bonds can be issued by a variety of places, unlike stocks, which are only issued by firms. Bonds can be issued by firms, governments, states, and other government-affiliated organizations. Bonds have four main features. Their issue price, which is what you buy it for, the face value, which includes the price you're buying it for, as well as the interest payments, the coupon rate, or the interest rate, which is the set of payments you'll be receiving over the course of the bond, the coupon date, which is when these payments will be made to you, and the maturity date, which is when a lifetime of the bond is expended and the issue price is returned to you. So, bonds are used typically to fund projects for these organizations. They only last for a certain period of time, as determined by the maturity rate when the bond is issued, and they either have fixed or variable payments. Something interesting about bonds is that they're inversely related to interest rates in the market. This is because as interest rates rise, the lower coupon rate of the bonds become less desirable. As a result, bond issuers lower their price. An example of a government-funded project could be developing infrastructure, such as buildings, schools, paving roads, and so on. If the government doesn't already have enough funds to do this project, they may issue bonds to raise capital and pursue these projects. So, the differences between stocks and bonds. So typically stocks are more risky. This is due to the volatility of the stock market, resulting in companies' values appreciating and depreciating. Additionally, stocks are only issued by firms or companies. Stocks also give you ownership over a company, and you get paid in the form of dividends and appreciation in the value of the company. Dividends are when companies may choose to offer you some money that they make from their profits. And appreciation is when the total value of the company rises. As a result, when you purchase a stock, for example, when the company stock is worth $100 and it appreciates to $120, you make money off of that $20 appreciation. Additionally, stocks give you ownership over a company, and in some situations will give you decision-making power. So now bonds. Bonds are seen as less risky because they have fixed payments, which are determined when the bond is purchased, and they give you a maturity. Once they mature, you get your initial payment back. Bonds are issued also by firms and governments, along with other organizations. Bonds are in the form of debt, not ownership. So when you purchase a bond, the person that you purchase the bond from will be making you payments. Furthermore, bonds don't give you any decision-making power since they're only debt and not ownership. We can see the risk between bonds and stocks in this example. So here, the stocks are represented by the dark blue line, whereas the bonds are represented by the light purple. The stock prices are very volatile as they're swinging up and down, cyclically almost, whereas bonds are on a steady, much less volatile growth rate. This represents how stocks are much more volatile, and when at certain dates, if you choose to sell a stock, you may make a negative return. Whereas if you choose, bonds you can't sell. But once your bond reaches a maturity, you're almost guaranteed to make profits unless the company or organization that you purchased the bond from defaults or goes bankrupt. So how do we value stocks or any asset in general? Well, there's two main factors that we have to include when trying to value a stock or bond or any asset for that matter. The expected cash flows and the risk associated with the value. As we discussed earlier, cash flows are the total revenues we'll be making along with the sunken costs of purchasing an asset. And risk. Risk can be represented with the chance for financial losses or the chance that a company even goes bankrupt and you lose your value. Okay, so stock valuation. There is a lot of uncertainty when valuing a stock, and part of this is due to the fact that there's so many different ways to value a stock. For example, there's the discounted cash flow method, which we'll be looking into next. There's the constant growth divided by dividend discount method, and there's also techniques called comparables, which we'll also be discussing, such as price to earnings, price to books, and price to sales. As a result, there's no standard convention to measure a stock, and when people are comparing stocks, it's best to use the most information you have available to you and try and do all these techniques, which is, of course, unviable in the real world, though. So, the discounted cash flow method. Discounted cash flow method is similar to what we discussed in the previous section, where we take all the expected cash flows for an asset, including the sunken costs and the revenues that it's likely to generate in the future, and discount these values, meaning we adjust the value of money in accordance with macroeconomic features like inflation and so on to ensure that the future value of money is converted to the present value of money. So, what are the pros of this technique? Theoretically, this is the most sound method if the analyst is confident in their assumptions and forecasts. Additionally, it's not significantly influenced by temporary market conditions or non-economic factors. Like if the industry is suffering from a temporary lack of resources, this technique ensures that those factors are overcome when calculating the value. And this is especially useful when a company you're valuing is in an industry where there's no other competitors or very limited competitors. So that way there's limited or no comparable information. As a result, you only base your forecast off the individual company. The cons of this technique are that it can vary over a wide range of values because the predictions are based on forecasts, which are likely to be inaccurate. Additionally, it's very time-intensive compared to the other valuation techniques, which we'll discuss later. And additionally, forecasting future performance is very difficult since it requires lots of statistical tools, and again, it is likely to be inaccurate or imprecise. So, valuation frameworks, we'll be looking at comps now. So what are comps? Comps are also called comparables or multiples, and it is a valuation technique that is based on comparing companies within an industry. It involves using metrics such as price to earnings, price to books, and other relevant ratios to that of similar companies in the same industry. The rationale behind using comps lies in the principle that companies within the same industry tend to have similar financial and operational characteristics due to shared market and economic factors. By evaluating the valuation of a company against its peers, investors can gain insights into its performance within the industry and whether it's over, under, or fairly valued. So, the two most popular forms of comps are price to earnings ratio and something called enterprise value to EBITDA or EBITDA. So these are examples of certain types of comps. We have price to earnings, price to sales, enterprise value to earning before interest, tax, and depreciation, price to cash flow, and price to earnings. The reason these are better than discounted cash flow in terms of time is that they're ratios, so they can be calculated very quickly. All you have to do is go to the financial documents of a company, look at their numbers that they're reporting, and calculate them, which allows for swift and easy comparison between companies within the same industry. All right, in this section, we'll be going over business strategy and any of the financial documents related to it. So first, what is business strategy? Well, it's a plan of action or a policy designed to achieve the major or overall aim of a company. So it's the time to develop a coherent economic strategy and the plans to ensure the future success of the company in both its goals and financial success. So, one key aspect of the business strategy is the mission statement. The mission statement is the summary of the aims and the values of a company. The key elements of a mission statement are the purpose, the target audience, an explanation of the business, how the business is unique, and the values that the business has. And it has to do all of these things in just a couple sentences. So let's look at a couple examples. Here we have Microsoft, and their business statement is to empower every person and every organization on the planet to achieve more. We have Honda. Maintaining a global viewpoint, we are dedicated to supplying products of the highest quality, yet at a reasonable price for worldwide customer satisfaction. And Walmart. To save people money so that they can live better. Across these three statements, there's common features. 1, they're short. 2, they're easy to remember. And 3, they showcase the core values and missions of these companies. Okay, so the next part about a company analysis. There's various tools that companies include to create their business statement, and one of these principal tools is a SWOT analysis. A SWOT analysis helps a company position themselves and understand where they are in the marketplace against their competitors. There are 4 key elements to SWOT analysis: strengths, weaknesses, opportunities, and threats, which thus produce the name SWOT. So the strengths of a company are its competitive advantage, the assets that it had that are proprietary, and products that are performing well. These are the strengths because they are unique features of a company that other competitions don't have. The weaknesses of a company are things that they lack that their competitors have, things that their competitors do better, and any resource limitations that a company may be experiencing. So strengths and weaknesses are within the company and its operations. Then we have opportunities and threats. Threats are new legislation which threatens a company's operations, any new emerging competition, and changes to consumer attitudes and opinions. And opportunities are technologies that a company can integrate to improve its processes, emerging press and media which can help a company generate any publicity, and underserved markets that a company can integrate themselves into. Threats and opportunities are not directly involved in the company and are external and can be affecting the company over time. So here we have a bit more of a detailed explanation of what strengths and weaknesses are. So strengths are the internal attributes and resources of a company that propel the company towards success. That represents the area where your organization outperforms others, evident by both your competitors and your customers. Weaknesses are the facets that hinder favorable outcomes for your business. They pinpoint areas that require improvements, shedding light on where your company falls short compared to its competitors. Opportunities encompass external elements that can be leveraged to your advantage. These are prevailing market trends that, when capitalized upon using your strengths, can enhance revenue and provide a competitive edge. Threats denote external factors that jeopardize your organization's success. These encompass advantages held by competitors. To mitigate these risks, it's crucial to employ your strengths strategically. SWOT analysis, when used, can help a company understand where it is now in its industry and what the future holds and how the company can progress itself in a beneficial way. One more tool that a business can use to help it understand the importance of certain products or services it sells is the BCG matrix. So the BCG matrix, otherwise known as the Boston Consulting Group matrix, is a business analysis tool that helps organizations assess their product portfolio's performance and potential. So as you can see on the diagram, there are 4 different categories: stars, cash cows, question marks, and dogs. And you can categorize products depending on their market growth rate and their relative market share. So stars. These are products with high market shares that are growing in fast-growing markets. They have the potential to generate significant profits due to their position in this industry. So if a company dominates 90% of the market share for a niche that is growing very fast, the product that they're selling is likely to be a star. Cash cows are products that have high market shares in markets that aren't growing so fast. While they may not have as much growth potential, they generate steady cash flow, which is often desirable for businesses. So similar to stars, but they don't have the future potential, and instead they're making money right now. Question marks are products that company may have low market share in, however the market's likely to expand in the future. They require consideration as to whether a company should invest in it to develop its market share and potentially create it into a star, or to let it go and become a dog. And dogs are products that have a low market share and a market growth in a market that isn't growing. They won't generate significant profits for the company And if a company needs to reduce some of its products or services that it's offering, the dogs are the first to go. The BCG matrix can help a company allocate its resources effectively by suggesting strategies for products or services that fall into each specific quadrant. And the last strategic business tool we'll talk about is Porter's generic strategies. So Porter's generic strategies are a set of strategic approaches developed by Michael Porter, as the name suggests, to help businesses understand where they stand in the industry and to help them gain a competitive advantage. So again, there are 4 quadrants in this industry, diagram. There's cost leadership, differentiation, cost focus, and differentiation focus. So cost leadership is a strategy that focuses on becoming the lowest cost producer in an industry. This is achieved by economies of scale, efficient operations, and cost controls. This can attract a wide customer base and potentially deter new entrants from the industry. Then we have differentiation. Differentiation aims to create a unique or distinctive product unlike others on the market, and this can be achieved through unique product design, branding, or even customer service. By offering something that's valuable and unique, companies can often charge premium prices and customers will be willing to pay. And then as we move to the bottom, there are the focus or niche strategies in the niche market. These strategies often involve concentrating efforts on a specific market or a specific segment. This can be done either through cost focus or through differentiation focus, which mean becoming the lowest cost leader in a niche and offering a uniquely tailored product in a niche respectively. By focusing on smaller specialized markets, companies can build stronger relationships with their customers, and it's much easier to maintain these relationships. By choosing one of these generic strategies, businesses can align their operations, marketing efforts, and resource allocations to create a sustainable competitive advantage. So now we'll be looking at the 3 main financial statements that all companies need to report, or financial documents rather. So we have the statement of profit or loss, the statement of financial position, and the cash flow forecast. It's important to note that these documents do have different names that they're referred to, as I've indicated some of the popular other forms in parentheses. So if you do go on the internet and you come across an income statement or a profit or loss statement, please do know that they're the same thing. So each of these statements has a different purpose, which we'll be exploring soon. And when combined together, they provide an in-depth look at through the lens of finances and performance at how a company is performing and whether its stock is good. And also keep in mind that all publicly traded companies need to report these 3 documents to ensure transparency with the public and their investors, whereas private companies don't need to report this. Also note that in these documents, any negative numbers or losses will be represented with parentheses around them. In earlier examples, I used the color red. However, in financial documents, it's important to know all negative numbers are in parentheses. All right. So first we have the statement of profit or loss. The statement of profit or loss is a financial statement that summarizes the revenues, costs, and expenses of a company over a period of time. So just to start with, all of these financial documents have this opening section. It will, of course, include the title, the company, and what type of financial document it is. And more importantly, the period of time that it's coming from. So in this example, we have the end of the year at whatever year. Okay. So the statement of profit or loss is also known as the statement of operations, statement of financial results or income, the earnings statement, the expense statement, income statement, and so on. It's important to compare this profit and loss statement over time to see changes within a company. So in this example, we only have it for 1 year, but investors typically look at several years and compare it on a horizontal analysis, which we'll look at later, to see the growth of a company over time. So whenever we're looking at this document, it's important to start from the top. So we look at the sales revenue, and as we go, we slowly reduce the total sales revenue until we receive the retained profit. So starting at cost of sales, this includes the cost of manufacturing goods and the cost through which you would have to sell it. This includes lighting at the store and so on. This leaves you with your gross profit. Then after expenses, you get your profits before interest and tax. After paying interest, you get profits before tax. After paying your taxes, you get profit for your period. So this is essentially all the surplus that a company has left over. Then you pay your dividends to your shareholders, and this leaves the retained profit for the company. So it's important to note that this is for a profit-making entity. Even non-profit-making entities do report these statements. However, in place of profit, they use the term surplus, since they aren't, well, for profit, right? So the statement of financial position. This statement's a bit longer, so we'll look at it in two parts, assets and liabilities. But essentially, this statement says, at the end of a financial period, where do you as a company stand? So the first half, the assets. So again, looking from the top, we have the name of the company, the title of the document, and the period that is reporting for. So in this section, we look at the assets, and assets are split into non-current and current assets. So non-current assets are assets that a company will be holding for a period greater than a year. This includes things like the factory that it's built on, any of the technical equipment they have, and so on. Current assets, on the other hand, are things that are assets that a company will hold for less than a period of a year. This includes things like cash, debtors, and stock. So when you calculate the total value of your non-current assets, you get 800 here, and current assets is a 1,100. So your total assets add up to 1,900. One thing that you may notice is accumulated depreciation, and it's in parentheses, and it's a negative factor. Although it's beyond the scope of this course, I'll give you a quick look at what depreciation is. It's an accounting technique used by companies to reduce their overall assets, which can help them in terms of tax breaks and so on. But yeah, when you add your non-current assets and your current assets, you get your total assets of 1,900. Now, liabilities. Again, liabilities are split into current liabilities and non-current liabilities. Current liabilities are liabilities that a company will hold for a period less than a year. And non-current are liabilities that a company will hold for a period greater than a year. Things like bank overdraft, which are essentially drawing from a bank account until it gets to a negative point, is a current liability. Trade creditors is when a company is trading with another company and the person you're trading with allows you to pay later, essentially like an IOU. And we also have short-term loans, which will be paid back in a period less than a year. And these add up to your total current liabilities. Other non-current liabilities are just long-term loans, which you would take out from the bank. And these add up to your total liabilities. Your net assets are your total assets minus your total liabilities. So your total assets are 1,900 and your total liabilities are 800. So 1,900 minus 800 gives you 1,100, which is your net assets. And an important calculation to know to see if you've done this the financial position correct is to take your assets and equate them to liabilities plus shareholder equity. If this comes out equal, then you've done it right. Shareholder equity is essentially the share capital, the value of your shares, and the retained earnings of a company for the period. So yeah, that's your statement of financial position. And now we have the cash flow forecast. The cash flow forecast is for a shorter period of time, and it talks about all the money going in and out of a company for, in this case, 3 months. So yeah, it allows advisors to assess the individual inflows and outflows of a company to determine how important certain things in the company are and how expensive they are, and how they can be cut down to improve the total net cash flow of a company. It also allows for a month-by-month comparison to see the growing effects of the company's operations. So as you see here, in January, the opening balance is 800. However, the total cash outflows, which are 306, are greater than the inflows, which are 300. And as a result, the closing balance decreases by 6 million. So you have a closing balance of 2 million. And we see this negative cash flow going over a period of 3 months, which allows us to see that operating at this state for this company has negative effects. And then suggests that some outflows need to be decreased or inflows need to be increased. Otherwise, companies may need to take out incorporate other forms of finances. So the importance of these forms. These 3 forms, as I stated earlier, need to be made public for publicly traded companies. It's important that companies ensure transparency with their investors and with the public so that investors can make informed decisions whether they should invest in the company. These documents are also important for people within the company to ensure that to create calculations like return on equity or ROE. And you can only do that by comparing across these documents or cross-referencing. So yeah, even now, you can search up a certain publicly traded company and find these financial documents on the internet. However, you won't be able to do so with private companies. So now we'll be looking at how to analyze these financial statements that we've just discussed. So there's 3 techniques that we can use. You can use ratios, a horizontal analysis, and a common size technique. So first we'll go over ratios, which are, in my opinion, the simplest way and the quickest way to analyze. So there's 4 types of ratios. Profitability ratios, which measure your return on investment. Your liquidity ratios, which measure how easily you can move your money around. Activity ratios, which are a representation of your day-to-day operations. And leverage ratios, which represent how well you can utilize debt. So we have profitability ratios. Profitability ratios are financial indicators used to evaluate a company's ability to generate profits relative to its revenue, assets, and equity. Key profitability ratios include the gross profit margin, as you can see on screen, which measures profit after deducting production costs or cost of goods sold, and the net profit margin, which assesses overall profit after all expenses. We also have return on assets and return on equity, which are common ratios that show how efficiently a company generates profits from its assets and shareholder equity, respectively. These ratios help investors and stakeholders gauge a company's profitability and its effectiveness in turning revenue into earnings. So as you can see, I have the formulas for each of these profitability ratios listed on screen. And all of this information can obviously be found from the 3 financial documents. Next, we have liquidity ratios. Liquidity ratios are financial metrics that assess a company's ability to meet its short-term financial obligations. They measure the firm's ability to convert assets into cash quickly to recover or cover immediate liabilities. Common liquidity ratios include the current ratio, which divides the current assets by current liabilities, and the quick ratio, which excludes less liquid assets like inventory. These ratios provide insights into a company's financial health and its capacity to handle unexpected expenses or downturns. High liquidity ratios generally indicate better short-term financial stability and flexibility. However, they aren't the ultimate analysis technique for liquidity. Activity ratios. Activity ratios are also known as asset utilization ratios, and they analyze how efficiently a company manages to use its assets to generate revenue. They provide insights into how well a company utilizes its resources and operations. For example, we have inventory turnover, which measures how quickly inventory is sold and replenished, and things like average collection period. Activity ratios help businesses optimize their operations, manage working capital, and identify areas where improvements can lead to increased productivity and profitability. Finally, we have debt leverage ratios. Debt ratios are financial metrics that evaluate a company's level of debt in relation to its equity or assets. These ratios offer insights into a company's financial leverage and risk. Common debt ratios include the debt-to-asset ratio, which measures debt relative to the total assets a company has. This ratio helps assess a company's ability to handle its debt obligations and also provides valuable information for investors and creditors regarding the firm's financial stability and its transfer risk. All right, so there's nuances to these ratios. Although these ratios are super simple and easy to calculate, they aren't that useful when you're comparing firms across industries. So for example, we have Walmart and Honda. If we take the example of the liquidity ratios with the quick ratio, you can't compare Honda and Walmart. It's likely that one of the companies will have very different styles of inventory, and the ways they process their equipment is very different. However, these ratios are useful when you're comparing companies within the same industry in the same position. All right, so now we can go through a quick simplified version of a consolidated income statement and all these financial documents to calculate 2 ratios, the gross profit margin and the net profit margin for Tesla. So I got this data from the Wall Street Journal, and it's just a consolidated income statement of Tesla with all this information here. So to calculate the gross profit margin, I have the formula right here. So it's the revenues minus the cost of goods sold divided by the total revenues. So using Excel, we can use the minus function to take the revenues, which is right here, and subtract it from the cost of goods sold, which is right here. And this gives us 20,853. And now we can use the divide function to divide this value by the total revenues, which is the formula right here. And this gives us a gross profit margin ratio of 0.255 and so on. And now we can do the same thing with the net profit margin. But this is much more simple since it's just the net income divided by revenues. So we take the divide function and we look for the net income, which is right here. And you take this and you divide it by the revenues, which is right here again. And using Excel, we can calculate it to be 0.15446. So this is a super simplified example. The information on this Excel sheet is very basic. In reality, when you're calculating some of the other ratios, you're going to need to cross-reference these financial documents because lots of the information is located on the cash flow forecast, some is reporting the income statement, and so on. So as a result, it becomes a lot more complicated. But if you have access to all three of the files, which you should for publicly traded companies, you'll be able to do these calculations no problem. The next technique is horizontal analysis or trend analysis. So horizontal analysis of financial statements involves comparing financial ratios and benchmarks or any item over a number of accounting periods. This method is also known as trend analysis. So horizontal analysis allows the assessment of relative changes in different aspects of the financial statements to be seen over time. So let's look at this example. One thing to notice when you're reading these financial statements over time is that the most recent years represented on the leftmost column and the oldest years on the rightmost column, which kind of goes against our left to right reading style in English. So it's important to keep that in mind. But if we look at the numbers, we see a growth in the sales, a growth in the cost of sales, a growth in profit, and so on. So this can be calculated. So the change, the numerical change can be calculated and listed in this column. And the percentage change can be listed here. The percentage change is calculated by taking the difference and dividing it by the overall amount. So that's also called the year-over-year change. So returning to our consolidated income statement for Tesla that we saw in the previous example, we can see the same changes happening over time. So the leftmost column is the most recent year, which is 2022, and the rightmost column is 2018. So this records data for Tesla over the course of 5 years. Keep in mind that some of this data happened during the COVID-19 pandemic, which may have skewed results. So that shows you that it's important to realize that macroeconomic effects like a pandemic or other industrial shocks can affect this data. But in large, it's not that big of a contribution, at least to Tesla. So if we look, we see a growth in sales revenue. So from 21,000, 24,000, 31,000, and then rapid growth from 2020 to 2022 with 20,000 growth and then 30,000 growth. And the same processes can be seen across various other factors or various other items. And this goes to show you how this horizontal statement can be used to analyze growth over time, even with Tesla. The last tool we'll be discussing in this section is common size analysis, which is a financial The last technique we'll be discussing in this section is common size analysis. Common size financial statements show each line item expressed as a percentage of a base figure within the statement, and it's used for vertical analysis. So common size financial statements help to analyze and compare a company's performance over several periods. The common size percentages can subsequently be used to compare those of competitors and determine how a company is performing relative to the rest of the industry. A common size income statement is an income statement in which each line item is expressed as a percentage of the value of revenue or sales. A common size balance sheet is a balance sheet that displays both a numeric value and relative percentage for total assets. So in the following example, we'll be looking over a common size statement for an income statement or balance sheet. Okay, so here we have a generic example of what one would look like. As you can see, we have the normal side of a balance sheet or a statement of financial position, except one more column is added that expresses everything as percentages. In this example, you would think percentages aren't too helpful, and you'd be right. And that's because the numbers here are very straightforward. The total assets are 100,000, which makes 100%. And all these numbers are very straightforward. However, in a situation where numbers are much more miscellaneous and intricate, these percentages help to clarify much more information. Here, this is extremely helpful because it can show us what percent of our assets, for example, our current assets, are in which form. So in this example for our current assets, the majority is in the form of total cash and inventory, whereas the rest is in the form of prepaid expenses and accounts receivables. This can suggest that the company may need to invest its total cash into other assets that can generate revenue, and it may have an inventory issue, turning inventory into actual revenue. And if we look at our non-current assets, the majority of our assets are in our plant, property, and equipment, whereas very little is in our goodwill. This can help us identify what value certain parts of our business bring and what parts aren't as helpful. So in the non-current example, we see how we have so much value in our equipment, our property, and our plant, whereas the brand name and value, which is goodwill, isn't that strong. This can also help us identify which parts of our liabilities are the greatest and which parts are the weakest, and how we can take future steps to address these and prevent any other issues from rising. This same thing can be seen for other forms of statements like the income statement, which I mentioned earlier, but it's essentially the same thing just in another financial statement. All right. So let's say you have the opportunity to install solar panels on your house. The solar panel company says it's going to cost you $10,000 to install solar panels. But they say in the long run, you're going to be able to save money. Should you make the investment? Well, in this class, in this section, we're going to be talking about capital budgeting. So, what is capital budgeting? Why do we do it? And how is it done? And with these tools, we can answer whether we should make the investment for the solar panels. So first, what is capital budgeting? Capital budgeting is the process of evaluating and selecting long-term investment projects, like solar panels, that involve significant financial outlays. It's a decision-making process for businesses and individuals to determine which projects are worth pursuing based on their potential to generate returns or benefits over an extended period. Capital budgeting helps organizations and individuals allocate their financial resources effectively, maximizing the value of investments and minimizing the risk of making poor choices. It's a systematic approach that considers not only the immediate costs and returns, but also the long-term impact on financial performance and overall strategic goals of an individual or business. Okay, so first of all, why do companies even make investments in fixed assets? Well, investments can increase capacity, they can overcome some regulations, they are innovative, which can give companies a unique advantage, and there's so many other reasons. But why is capital budgeting important for valuation? Capital budgeting is important for several reasons, but I'll give you three main reasons. First of all, it helps with resource allocation. There's limited financial resources, and capital budgeting can help ensure companies focus on the most promising investments. It also helps for long-term planning. This is because it allows companies to plan for the future by considering the effects of their investment using tools that we'll discuss later over an extended period and manage risk while maximizing returns. And it also considers the time value of money, again, which we'll discuss further. But capital budgeting considers the time value of money, recognizing that $1 today is worth more than $1 in the future. This also ensures that cash flow predictions are properly discounted. Okay, so how do companies pay for investments? They pay for it in three ways, using cash flow, debt, and equity. So before we continue, there's two more concepts you need to understand before we're able to discuss capital budgeting and how to actually consider it. Internal rate of return, or IRR for short, and cost of capital. The internal rate of return, or IRR, is a finance term that helps us assess how lucrative an investment or project could be. IRR is the annual growth that an investment is expected to make. If the IRR is higher than what you could earn from a safe investment, like a bank deposit or investing in some safe stocks, then the project might be worth the risk. In short, IRR helps us decide if a business idea is a good investment. So, the steps of capital budgeting. First, a project proposal is developed. This involves either individuals or businesses looking at an opportunity to make an investment and thinking it's a good idea. Then, management reviews and prioritizes projects based on their economic viability. So after looking at the potential cash flow projections, management will either decide if an investment is positive or negative for the company and thus decide to prioritize or ignore it. Then funds are allocated on these projects to ensure the development, and the results are tracked to see if the projections are accurate. If projections are inaccurate, funds are either removed, reduced, or increased. After the investment is completed, companies can reflect on the process and decide whether future similar investments should be made. So, capital cash flows. The value of an initial investment is equal to the cost of the new asset plus the installation cost associated with the new asset minus the after-tax proceeds from selling the old asset. Keep in mind the after-tax proceeds from selling an old asset is equal to the sale price minus the tax on capital gain, which is a bit advanced for this course. But all you need to understand is that that is considered when calculating the price of the initial investment. So capital budgeting results in changes in working capital. If a current asset increases in value, it's a use of working capital. If current liabilities increase, it's a source of working capital. That means current assets are cash, or in inventory, which are uses of capital, and liabilities are things like and loans, which are sources of working capital. An increase in net working capital means it's a source of cash for the company, and a decrease is a use of cash. So, capital budgeting. The three main methods that we use to decide whether we should invest are payback period, which we'll discuss next, net present value, which we've discussed earlier, and IRR, which we've just discussed. So, payback period. It's a very basic concept, and it essentially discusses how long it takes for a company to recoup its investments on a fixed asset. So in this example, we have a Ford factory. Initially, it costs $5,000 to invest in this Ford factory. However, as the years go on, it generates positive cash flows. So payback period essentially looks at how long it takes for the company to achieve a net positive cash flow. And as you can see, initially, the cumulative cash flow is negative until year 4, when it finally breaks positive. Okay, so now let's return back to our example. Our solar panel costs $10,000. Should we make the investment? So using capital budgeting techniques, we can predict the cash flows. So the cash flows over the years are $2,000, $2,500, $3,500, $4,000, and $4,500, with an initial cost of $10,000. Should we install these panels? Well, if you look at the cost of capital, which is 12%, that means any other investment we could invest in would generate $1,200 in net present value. If our investment on these solar panels is greater than our other cost of capital, then it's a good investment. So discounting our cash flows, we find that the value of the solar panels, the net present value of the solar panels is $1,219, which is greater than the value of, which is greater than our cost of capital. So here we can see how we calculate our net present value and how it shifts based on our discount rate and our cash flows. So this Excel function is set up so that the discount rate is 12%, which is our cost of capital, and our cash flows are accounted for. And you can do this by typing equals NPV, selecting the discount, comma, and selecting our cash flows, which yields the same number here and here. So if we wanted to adjust our factors to see how it would be in different scenarios, we can change these numbers and see how it would work. So if our discount rate was instead of 12%, 20%, you can see how our net present value has decreased. This suggests that other investments which are better cost of capital could have been a better investment than investing in these solar panels. However, if we decrease our cost of capital to something like 5%, we see the net present value increases even greater. This shows how different costs of capital can affect the net present value of our investment by comparing alternative investments. Additionally, we can look at how cash flow affects the net present value. If our initial cash flow was $20,000 instead of $10,000, thus essentially meaning the cost was double, our net present value decreases significantly. This shows how the price of investment can also affect the value. And then increasing our cash flows significantly increases our net present value. All right, in this section, we'll be talking about macroeconomics. So first of all, what is macroeconomics? Macroeconomics is the branch of economics that studies the overall behavior of an economy, focusing on large-scale factors like economic growth, inflation, unemployment, and national income. It examines how policies and events impact the economy as a whole rather than individuals and individual businesses or individual markets. Some of the key factors in macroeconomics are the size of the economy, economic growth, government policy, fiscal policy, monetary policy, inflation, and international trades. Most of these which we'll touch upon. So one thing that we should understand is the business cycle. The business cycle is very intertwined with economics. Everything is cyclical. So the business cycle, also known as the economic cycle, is the recurring pattern of fluctuations in an economy's overall activity over time. It can be divided into four main phases, as you guys can see in this diagram. In this example, it starts with the trough or the lowest point. So the trough is the lowest point in the business cycle. At this point, economic activity is at its lowest, and economic conditions are the worst. However, at this point, the economy sets the stage for a potential turnaround as it moves into the expansion stage. Some of the features of this stage is monetary and fiscal policy employed by the central banks and government, which we'll touch upon later, starting to rise in economic growth, an increase in employment and manufacturing from this trough, and a gradual shift towards increases in profits. Next, we have the expansion phase. During this phase, economic activity, such as production, employment, and consumer spending, is on the rise, as set by the trough. Businesses are expanding, and there's a general sense of optimism and an increase in consumer confidence throughout the economy. Growth is driven by an increase in consumer demand, investment, and also by monetary and fiscal policy. As you can see, the effects of fiscal and monetary policy are starting to benefit. However, the governments and central banks are drawing back on their intervention. Economic growth is also still positive. However, it's not as rapid as it was during the trough. At this stage, companies are still hiring and manufacturing activity is ongoing, and margins of companies also start to increase. Then we reach the peak. The peak is the highest point of economic activity in the business cycle. At this stage, growth begins to slow and even starts to decrease, and the economy reaches a state of maximum output. However, signs of potential inflationary pressures may begin to emerge. At this point, fiscal and monetary policies employed by the central banks and governments may go in the opposite direction to prevent too much growth, which is inflation. Additionally, economic growth stagnates, and employers have trouble finding workers, and wages increase in value. This is an effect of inflation. Additionally, earnings start to disappoint workers against high expectations due to economic growth. This leads into a recession or a contraction. So following the peak, the economy enters this contractionary phase. Economic indicators like GDP, employment, and consumer spending, which we touched upon earlier, start to decline. Businesses cut down on production, start laying off employees, and this may result in a decrease in consumer confidence. This phase is commonly referred to as a recession. However, this term varies depending on the severity and duration of this period. The business cycle is driven by various factors, including shifts in consumer and investor sentiments, increased technology, and changes to monetary and fiscal policies. However, it is continuous and it always happens. However, one thing to note is that in this graph, we see the business cycle as reaching the trough again, right? But one thing to notice is that the economy is constantly growing, so it's on an upward trend. However, these cycles go throughout the upward trend, if that makes sense. If you look closely here, the trough in the original early cycle is a bit lower than the trough after we reach the recession. This shows that the economy is growing. However, while it's growing, it is experiencing cycles. Okay, so the key factors of the macroeconomy that we'll be touching upon: GDP, or gross domestic product, employment/unemployment, inflation, and interest rates, which we've already discussed. So first, what is GDP? GDP, or the gross domestic product of a company, represents the total cost of goods being sold in that country or in that nation in a period, typically 1 year. So GDP is calculated as consumer spending, which is C, investments made, which is I, government spending, which is G, and the difference between exports and imports, which is represented as X minus M. Okay, something to note about industries and the business cycles. Certain industries and companies are divided into categories called cyclical or defensive categories. Cyclical industries are industries which face the repercussions of the business cycle. During certain times, they will be in an upward boom, and during certain times, they may not be able to operate at all. Examples of this include the hotel industry, resorts, dining, and any other excessive industries that are created by consumer wants. Defensive industries, on the other hand, are things that aren't too heavily affected by the business cycle. This is because they're necessary for human operation. Things like this include health services, utilities, health technology, and so on. However, some industries are in between cyclical and defensive. For example, consumer services are somewhat cyclical and somewhat defensive. For example, things like accommodation are cyclical and defensive to some extent. Some houses in certain areas, which may be seen as luxury, may be cyclical when it comes to renting or on Airbnb. However, basic accommodation is defensive since humans need it at all times. So first, unemployment. So unemployment is split into three categories: cyclical, structural, and frictional. So what is cyclical unemployment? Cyclical unemployment results from fluctuations in the overall economy. When the economy enters a recession or a downturn, demand for goods and services decreases, causing businesses to scale back production. As a result, they lay off workers, leading to cyclical unemployment. Consider the construction industry. During an economic boom, there's a high demand for new homes and infrastructural projects. Construction companies hire more workers to meet this growing demand. However, when a recession hits, the demand for new projects drops, causing these companies to cut back on their workforce, resulting in cyclical unemployment for construction workers. Similarly, in the tourism sector, when the economy is thriving, people have more disposable income to travel and explore. This leads to increased demand for flights, hotels, entertainment like movies, and so on. Yet, in an economic downturn, people tighten their budgets, leading to reduced travel and low demand for these tourism-related services. And as a result, there are losses in jobs in this industry. In both examples, cyclical unemployment is closely tied to the fluctuations in the business cycle, which we saw earlier. As the economy contracts and expands, industries that heavily rely on consumer spending and investments can experience shifts in employment levels due to the changes in demand. Next, we have structural unemployment. Structural unemployment arises from a mismatch between the skills and qualifications of job seekers and the requirements of available jobs. This mismatch is often caused by changes in the economy, such as due to technology or shifts in consumer preferences, making certain skills obsolete or less in demand. For instance, let's consider the decline of the typewriter industry with the advent of computers. Skilled typists who were very proficient at using the typewriter might have found themselves structurally unemployed as the demand for their specific skill set, efficient use of the typewriter, dwindled due to technological advancements. This is because computers were much more efficient, much more accessible, and people could do the same job that typewriters could do at home by themselves. Another example could be seen in the decline of manufacturing jobs in certain regions. As manufacturing processes became more automated, companies may require fewer workers on the factory floor. This can lead to structural unemployment as individuals with specific skills to manual assembly or machine operations face challenges of finding relevant employment. In the modern context, rapid advancements in artificial intelligence and automation could potentially lead to structural employment for certain administrative roles, which do work that AI can easily replace. These include tasks like data entry or customer service, which AI, even at its current state, can likely handle, rendering these traditional jobs unnecessary. Structural unemployment underscores the importance of continuous skill development and adaptation to changing job markets. Individuals need to retain and acquire new skills to remain competitive in an evolving landscape and minimize the impact of structural shifts in the economy. Lastly, we have frictional unemployment. Frictional unemployment is likely the type of unemployment that most people will experience. It occurs when individuals are transitioning between jobs or entering the workforce for the first time. It's a natural and unavoidable aspect of a dynamic job market where people are constantly seeking better, higher paying jobs with better benefits, while employers are looking for better and better candidates. Imagine a recent college graduate entering the job market. They might experience frictional unemployment as they search for their first full-time position. During this time, they're looking for a job that aligns with their skills, interests, career goals, pay, and maybe it's even close to their house. This process of searching and applying and interviewing and negotiating tasks takes time and can result in temporary unemployment, which we refer to as frictional unemployment. Another example is when someone voluntarily leaves a job to pursue a new opportunity. They may experience frictional unemployment during the gap between leaving one job and starting their next job. This gap is often necessary to handle the logistics of transitioning, such as relocating or completing necessary paperwork. Frictional unemployment, while inevitable, can be reduced through effective job search strategies, networking, and the use of online job platforms. It's important to note that frictional unemployment is generally considered to be a healthy aspect of a dynamic job market, as it reflects the individual's ability to move and their flexibility in pursuing opportunities that best fit their skill sets and aspirations. So, inflation. When we're calculating GDP, as we learned earlier, the value of money changes over time. Money in the future is not worth the same as it is right now. As a result, GDP numbers, without being deflated, could show consistent growth, whereas in reality, the real GDP, which is what we refer to GDP with the time value of money taken into account, could be decreasing. As a result, to calculate the real GDP of a country, we take the nominal GDP, which is what would be reported, and we take away the impact of inflation. Okay, so who is really playing a role in the macroeconomy? So the two main players that control it are the governments and central banks, which implement and develop policies. And as a result, companies and consumers are impacted by these changes and need to react. So, governments implement fiscal policy, whereas banks implement monetary policy. So first, what is monetary policy? Monetary policy involves a bank's management of a country's money supply and interest rates to influence economic activity. By adjusting interest rates and employing tools like open market operations, central banks can control inflation, encourage borrowing and spending during slow economic periods using expansionary monetary policy, or cool down an overheating economy using a contractionary monetary policy. Expansionary monetary policy is when central banks reduce interest rates to make borrowing money easier for consumers. This is because the interest they would have to pay on a loan reduces, making taking a loan much more appealing. Contractionary monetary policy, on the other hand, is when central banks increase interest rates to make borrowing more expensive, causing borrowers to pay more interest on their loans, decreasing the appeal of these loans. An interesting example of monetary policy in action is Japan's use of interest rates to stimulate the economy. Typically, in a country that is using expansionary monetary policy, interest rates could be lowered from 3% to 2%, for example, to encourage borrowing. Japan, however, decided to take an unconventional approach. The Bank of Japan set an interest rate of negative 0.1. This is extremely unique and a choice made by Japan's government to meet their specific needs. This was their attempt to overcome deflation, which was a big issue in Japan. By making interest rates negative, it makes it more economical to borrow and spend money than just holding on to it. As a result, people kept taking on loans because it was generating that money, and as a result, they started spending more, which stimulated Japan's economy. And it has borne fruit for the country of Japan. Now, fiscal policy. Fiscal policy, it involves how governments use taxes and spending to influence the country's economy. By adjusting tax rates and government spending levels, governments aim to stimulate the economic growth during downturns using expansionary fiscal policy, or control inflation during periods of high growth using contractionary fiscal policy. So expansionary fiscal policy, similar to expansionary monetary policy, is when governments spend more money to increase the circulation of money within the circular flow of income, which creates jobs and more. Contractionary fiscal policy is when governments increase interest rates to decrease the disposable income of people to reduce their spendings. An example of how governments can spend their money is through investments in military, investments in infrastructure, or investments in social programs, which stimulate the economy and can be called injections. The ways they can influence tax rates are through increases or decreases in corporate tax and increases or decreases in individual tax, like income rates. Fiscal policy, as we mentioned earlier, can be expansionary to promote spending or contractionary to reduce spending. As you can assume, monetary policy, which is influenced by the central bank, is much more fast-acting than fiscal policy. Controlling interest rates is much faster than starting infrastructural projects, which can take years to see the effects of. Because interest rates can directly affect money circulation, they affect much faster. Whereas things like infrastructural projects, their benefits come from increased employment and injections into the economy in the form of available buildings where companies can relocate. This often takes time for companies to find these locations to relocate. And additionally, employment doesn't immediately increase the economy. In this section, we'll be going over ESG, or environment, social, and governance for short. ESG has become a topic of much concern in recent years especially, but has existed for hundreds of years and even beyond that. ESG is the social mission of a company and integrating social aspects and objectives within a company's goals. However, there is an increasing demand for ESG in the investing process from investors and stakeholders alike. However, there is so much skepticism regarding the role of ESG and responsible investing, and the idea that focusing on ESG means compromising returns. However, this isn't the case. In this section, we'll be going over what ESG is, why it's so important, and how investors should take into consideration ESG to not only advance social goals, but to ensure that their portfolios are profitable. All right, so first, what is ESG? ESG, which stands for Environmental, Social, and Governance, is a comprehensive framework that evaluates a company's performance and practices in three key areas. The environmental aspect focuses on how a company interacts with the planet, from how it goes about carbon emissions, to managing resources, to addressing waste and pollution. The social aspect revolves around relationships, including how a company treats its employees, fosters diversity and inclusion, and engages with local communities through initiatives and philanthropy, and CSR. Finally, the governance aspect examines a company's internal structure, ethics, and accountability. This encompasses everything from the composition of the board of directors to ensuring transparency, integrity, and adherence to regulations. ESG is more than just a trend. It's a strategic approach that considers the broader impact of business activities on the environment, society, and ethical practices. So the origin of ESG. Although ESG has become much more well-known with people outside the investing landscape in recent years, it's existed for so long. The origins of ESG can be traced back to the mid-20th century, when discussions about corporate social responsibility started to take shape. However, it wasn't until the 1960s and 70s, fueled by social movements advocating for civil rights, that awareness of corporate impacts began to grow. This era saw the emergence of ethical investing, where investors excluded industries that conflicted with their own moral values. Global crises, including environmental disasters and financial meltdowns, further highlighted the urgent need for responsible business practices. In 2006, the United Nations took a significant step by launching the Principles for Responsible Investment, or PRI for short, signaling a formal commitment to integrating ESG considerations into investment decisions today. These historical milestones collectively paved the way for development and widespread adoption of ESG framework that we recognize today. Okay, so the importance of ESG. The significance of ESG lies in its ability to guide businesses towards long-term sustainability and success. By integrating environmental, social, and governance factors, companies not only reduce their environmental footprint, but also foster innovation and adapt to changing landscapes. ESG practices aren't just about doing good. They're about managing risks effectively. Identifying potential environmental and social vulnerabilities can shield a company from future disruptions. Moreover, a robust ESG strategy enhances a company's reputation, building credibility and trust with stakeholders. This is especially crucial in an era where consumers and investors expect more than just financial returns. Beyond reputation, ESG practices ensure regulatory compliance as standards evolve, demonstrating a commitment to ethical conduct and transparency. In essence, ESG is more than just a buzzword. It's a strategic imperative that not only ensures businesses thrive, but also contribute positively to the world around them. So let's look at it in the modern investing lens. ESG has transformed the investment landscape by introducing a responsible approach to decision-making. Investors now factor ESG considerations when crafting their portfolios and align their investments with ethical and sustainable values. It's not just about these values, though. It's about potential financial benefits. ESG integration offers the promise of improved risk-adjusted returns, as companies with strong ESG practices often demonstrate resilience when faced with uncertainty. ESG-aligned companies also appeal to investors with a long-term outlook, as they prioritize sustainability in both environmental and self-sustainability and are better equipped to weather market fluctuations. Notably, research indicates that companies excelling in ESG performance can even outperform their peers financially. Beyond profit, ESG opens doors to impact investing, where investors actively contribute to positive societal and environmental changes through their investment choices. The integration of ESG factors signal a fundamental shift in how investors perceive value, emphasizing both financial returns and contributions to a more sustainable world. So, this is especially important in a modern world. With factors like social media, ESG has become even more important, and companies that fail to adopt ESG are placed under much more scrutiny, as we'll see in future examples, compared to companies who do adopt ESG. So, the impacts on stakeholders. ESG doesn't just affect a company's internal practices, it extends to its relationship with stakeholders. Employees, for instance, are more engaged and satisfied when they work for a company that prioritizes their well-being and supports a positive workplace culture through ESG practices. Customers too are drawn to brands that align with their own values, and ESG provides that connection. Companies with strong ESG values tend to attract and retain socially conscious customers, thus strengthening brand loyalty. Beyond employees and customers, ESG initiatives have a positive ripple effect on their local communities, contributing to societal well-being and forging deeper community connections. Investors and other stakeholders also expect transparency and ethical conduct, making ESG an essential aspect of building trust. Ultimately, effective ESG practices manage not only a company's reputation, but also its relationship with the broader ecosystem that it operates within. The global impact of ESG. As we said before, ESG is not limited to companies and not just communities either, and it has a significant effect on global outreach. By prioritizing environmental sustainability, ESG practices align with global objectives such as mitigating climate change and conserving biodiversity. On the social front, ESG initiatives address pressing challenges like poverty and inequality, contributing to a broader global development. The collaborative nature of ESG becomes evident through partnerships between companies, governments, and organizations across borders, all working together to address shared challenges. ESG encourages companies to innovate sustainably, develop solutions that can drive positive impacts on a global scale, and innovate more. So, as a financial investor, how do you assess a business's ESG? Now that we've established that ESG is important, how do we go about measuring it? Assessing a company's ESG performance involves evaluating its practices across environmental, social, and governance dimensions. ESG rating agencies play a pivotal role, providing scores based on established criteria that measure companies' alignment with ESG practices. In some sectors, specific ESG standards are in place, setting expectations for how companies should operate sustainably. As you can see on screen, there's something called the MSCI ESG rating, which is one of the ESG rating agencies. And additionally, transparency is key, as companies share their ESG data through reports disclosing their efforts and impacts. A critical aspect is materiality, which means focusing on the ESG factors most relevant to a company and its industry. This ensures that efforts are targeted where they matter most. ESG assessments serve as a dynamic tool for companies, not just to measure their current performance, but to identify areas for growth and enhancement. So, how can businesses incorporate ESG? Incorporating ESG into business operations requires a nuanced and comprehensive approach. It starts with strong leadership commitment, with top management actively championing ESG principles. It can't just be an afterthought. It needs to be integrated into the core business strategy, along with the business principles and the business plan, which we discussed earlier. Stakeholder engagement is critical. Involving employees, customers, and partners ensures that ESG initiatives align with their needs and concerns. To measure progress, establish clear ESG metrics and targets, or maybe consult ESG agencies. This helps hold companies accountable for their efforts. Additionally, awareness is key, so employees understand the significance of ESG and their role in its implementation. Innovation thrives when ESG goals are aligned, so companies should encourage research and development that supports sustainability. So, ESG versus non-ESG stocks. Although we've clearly established that ESG does have benefits, how does it really help in reality? Theory isn't always right. So let's look at in reality. The choice between ESG and non-ESG stocks has had significant implications for investors. ESG-aligned companies tend to demonstrate better risk management and resilience against market turbulence, as we mentioned earlier. Research indicates that over the long term, ESG stocks can potentially outperform their non-ESG counterparts, driven by sustainable practices and responsible strategies. Moreover, as the demand for ethical and sustainable investments grow, especially in the modern world, ESG stocks could experience increased investor interest. ESG-aligned companies may also face fewer regulatory hurdles and reputational risks, making them more potentially stable choices. For example, they may not be affected by laws governing carbon taxes, and they may not have fit quotas which most companies that are not ESG focused may fail to meet. Beyond just financial gains, investing in ESG stocks also aligns with broader trends in responsible investing and sustainable consumer behavior. So, let's look at a mock situation and compare two companies, one which follows ESG practices and one that doesn't. A company that produces renewable energy has a strong track record of reducing carbon emissions and promoting clear energy. As a result, they've experienced steady growth driven by an increased demand for renewable energy sources and favorable regulatory policies which may reduce tax or provide subsidies. Additionally, they'll experience positive media, which can also help boost the company. On the other hand, a company which relies on fossil fuels will experience criticism for their environmental impact and negative media due to their contributions to climate change. As a result, their stock is likely to be volatile due to fluctuating oil prices in a dynamic market, changing that market dynamics, and growing concerns about environmental sustainability. As a result, in this situation, it's clear that the prior case is better when they use renewable energy. Additionally, let's look at a second example, but this time focusing on the social and governance aspects. In a diverse workplace, a company that promotes gender and ethnic diversity and a workforce that represents a wide range of backgrounds is more likely to succeed than one that doesn't have these same practices. This is because employees are likely to be more motivated in the workplace, and media is likely to show companies that focus on diversity in a positive light, whereas companies that don't focus are likely to face criticism. However, this is a nuanced approach. We need to look at reality, and in some cases, companies that don't have ESG principles in the moment may outperform those which do. However, in the long run, it's important to note that as the world becomes increasingly focused on social objectives, ESG will grow in importance. And as a result, non-ESG companies that may be in a better position now may not be in that same position in the future. So in this section, we'll just go over how to construct a portfolio and diversification and the types of management and the basics of how you construct a portfolio. So first of all, what is diversification? Diversification is essentially the process of purchasing assets from different asset classes to expand the number and type of securities in your portfolio. So if we look at this diagram, we can see here that on the x-axis, there's a number of securities, and on the y-axis, there's the standard deviation of your portfolio's return. The height represents the total risk, and as you can see, as the number of securities in your portfolio increases, the amount of unsystematic risk decreases, whereas systematic risk persists, and we'll get to that in a bit. Essentially, by purchasing more securities, you're going with the concept of not putting all your eggs in one basket. And since you're spreading your risk over the portfolio by choosing companies in different sectors and industries, you're able to avoid your portfolio crashing if one of these things fails. Empirical evidence suggests that all it takes is about 30 to 40 different securities to achieve a fully diversified portfolio. Okay, so what are the types of risk? Well, there's systematic and unsystematic risk. Systematic risk is a market risk, which is non-diversible, which means you can't get rid of it if you diversify, and it stems from market-wide risks. Unsystematic risks, on the other hand, are company or industry-specific risks that are inherent to a specific investment. Systematic risks are non-diversifiable, which means they cannot be get rid of. This is a risk that remains after efforts have been taken to diversify a portfolio. Systematic risk incorporates things like interest rate changes, inflation, recessions, and wars, among other major changes. Shifts in these things can affect the entire market and cannot be mitigated by changing positions within a portfolio of equities, because it affects every single equity. For example, the global financial crisis is a great example of systematic risk. Anyone who invested in the market in 2008 saw the values of their investment change drastically from this economic event. The Great Recession affected asset classes in different ways, as riskier securities, typically those that were leveraged more, were sold off in large quantities, whereas simpler assets like treasury bonds became more valuable. Unsystematic risk is a company or industry-specific risk that is inherent with each investment. And unsystematic risk can be reduced by diversifying, as we've seen in this diagram. Systematic risks include things like inflation risk, interest rate risk, exchange rate risk, and things like pandemics and war. Unsystematic risks are things like business risk, financial risk, default risk, and liquidity risk, which are specific to certain companies. So how do you measure your portfolio's performance? Well, the best way to do so is using benchmarks. A benchmark is a standard tool or measure that you can use to analyze the risk of a given portfolio. Individual funds and investment portfolios will typically have an established benchmark that you can already use for standard analysis to check your level of risk. Okay, time-weighted versus dollar-weighted returns. Time-weighted returns are determined without regard to any subsequent cash flows from the investor. It measures the performance of the investment over a certain period of time, not the returns of the investor. Returns quoted by mutual funds and other investment managers are time-weighted because the portfolio manager doesn't have any control over future cash flows of investor dollars. In contrast, a dollar-weighted return considers subsequent contributions to and withdrawals from an investment. For example, it considers timings and sales of purchases. A dollar-weighted approach focuses on the returns of the investor over a period of time, and this will usually differ from the time-weighted return. So how do you measure portfolio risk? Well, to measure risk, we need to identify what risk is. As we mentioned earlier, risk is the chance that a stock might fail, or the risk of volatility. So to measure risk, we would measure the chance that the performance of your portfolio as a whole would differ from the returns of the market or the benchmark portfolio. And the best way to calculate risk is using a standard deviation, which gives you returns over a given period. Standard deviation is the measure of dispersion of a set of data from its mean. It measures the absolute variability of a distribution. In essence, the greater the standard deviation, the greater the deviation from the mean. And this is the formula to calculate standard deviation. If any of you have taken statistics before, you'd be able to understand it. But if not, it's not necessary that you understand how to calculate standard deviation to actually employ it. You can use any online calculator to actually figure it out. So here is a standard deviation bell curve. Essentially, the areas within the curve are the higher likely opportunities. So in this general area, 68.27% of opportunities will follow this. But as we go to the extremes, more and more situations will fall under the blanket. However, the rate at which it does so is diminishing. So active versus passive management. Passive investment strategies seek to replicate the constituents, weights, and therefore the risk and returns of a specific benchmark of index securities. It's a buy and hold strategy that does not seek to pick winners and losers among the securities, but rather just hold them and see how things play out. The benefits of passive management include low fees, enhanced tax efficiency that stems from low portfolio turnover, and a limited portfolio management infrastructure, essentially meaning it's easier to manage yourself. The most popular vehicles for passive investment include index mutual funds and ETFs, or exchange-traded funds. Active management, on the other hand, is based on the belief that risk-adjusted returns above the benchmark can be achieved through security selection, market timing, and sector rotations by highly skilled professional portfolio managers. Essentially meaning you pick and choose stocks based on how you think they're going to do. Actively managed portfolios generally result in significant portfolio turnover as the manager reacts to market and temporary trends, either observed or forecasted. This high turnover, combined with the costs to staff a portfolio and management team, requires the manager to charge significantly higher fees than they would charge for a passively managed portfolio, and generally results in poor tax efficiency, as frequent buying and selling of securities may result in something called a capital gains tax, which is essentially the tax you pay when you sell stocks. This capital gains tax is greater when you sell a stock within a period of less than a year, and it's less when you sell a stock that you've held for greater than a year. In the past, the S&P 500 has had significantly more success than actively traded portfolios. This has been occurring for the past 20 years, and you could replicate the index yourself. For example, you could buy all 500 stocks in the S&P 500 in the same proportion that they are in the S&P 500 index. But the issue with that is that you would have to constantly monitor the investments and buy and sell at the weights of these companies on the index. Some large institutional investors, like pension funds, do this, but it's more impractical for day-to-day investors like you and me. Especially when you look at just the S&P 500. When you look at things like the Russell 2000, it becomes even more impractical. For us, there are two options: index mutual funds and index ETFs, which are similar to mutual funds, but trade continuously over the course of a day, like a stock. But in reality, it's not best to stick to either passive or active investment, but rather to do a hybrid form of management where you incorporate both aspects, some index and some active stocks. Let's look at Yale. Yale, with their fixed income, had an internal team to buy securities and bought a number of fixed assets and active assets to generate revenues. If you've looked at the news recently or in the past, you may have seen how active managers are outpacing things like the S&P 500. For example, Peter Lynch racked up a 29% return at Magnum Fund from 1977 to 1990, including dividends, and he outpaced the S&P 500 by more than 13% a year during that time. However, his investing style was very lucrative during that period, and although some people may have praised him, we can deduce that to some extent luck was an important factor in his success. Although he did buy high-quality companies that traded at a reasonable price, he wasn't able to do this for a consistent period of time, unlike what you would be able to do with investing in the S&P 500 for a longer period of time. So although certain stock pickers are able to beat funds like the S&P 500, it's a mistake to assume that this success will persist into the future. As a result, it's important to diversify your portfolio by also including stocks that are passive that you don't need to manage as much, and active funds as well. Now, in this short section, after we've discussed all these financial investments, I want to talk to you about alternative investments. Throughout this course, we've talked about stocks, bonds, business strategy, the economy, financial documents, and so on. But there's so many different ways of investing beyond the traditional stocks and bonds that many people are limited to think are the only viable investment opportunities. As you go about investing as a business person and as an individual, you'll come by opportunities to invest in non-conventional investments. Examples of these include real estate, equipment leasing, hedge funds, and in recent years, things like cryptocurrencies and NFTs. It's important to realize these are viable investment opportunities. Although they aren't as commonly used as stocks and bonds, although some can argue they are alternative investments that can generate yields and profits if invested in appropriately. So this section is just to talk to you a little bit about what are these alternative investments and some of the characteristics of these alternative investments. So we've had the general investments like equity, private equity, and things like venture capital. Private equity being shares you've bought in a company, and venture capital being capital raised from venture capitalists who are people who are wealthy enough to invest in companies. But alternative investments like real estate include purchasing land or purchasing property. Equipment leasing can be when you lease equipment as a business, which can help you generate revenue when you aren't using equipment. Hedge funds, which are a little bit more complicated, but they're similar to investing in a group of stocks. Commodities or precious metals. Yes, you can invest in things like lithium or aluminum. Cryptocurrencies and collectibles. So things like Bitcoin, Ethereum, and so on, and NFTs. So what are some of the characteristics of these alternative investments? Well, if you look at real estate, for example, they're not very liquid, so illiquidity, which does increase risk. However, this varies from investment to investment. Additionally, they are sold by financial advisors or broker-dealers, mostly to accredited investors. As a result, they aren't as easy to come by or as easy to invest in like stocks and bonds are. Additionally, they're to either public or private assets, but they're rarely publicly traded like stocks are on the stock market. Something to note is that these investments are high risk, high reward. So they are likely to skyrocket in price, like we've seen with the cryptocurrency rises, but they're also likely to fall and cause you to lose a lot of money. So when you're investing in alternative investments, especially those with which you're not very well versed, make sure you make an informed decision and go about investing in a safe and ethical way so you don't miss out. All right, everyone, that's a wrap on this course. And just to summarize, we'll go through everything that we've learned. So we've learned about the time value of money, how a mortgage can rack up compound interest, things like how to identify if an investment's a good investment, the importance of capital markets, and ESG, all relevant in business. We've also learned things like the business cycle, fiscal and monetary policy, and looked at case studies like Japan to understand the basics of economics. For finance, we've looked at the various financial documents, how to diversify your portfolio, how to mitigate risk, and the basics of statistics. Throughout this course, you've realized that all of these three disciplines are highly interconnected, and you can't study one without understanding the basics of some of the others. I'd like to say congratulations to all of you who have made it this far, and this knowledge will serve you well as you go into the future and explore these concepts in further depth. I'd like to remind you one more time that I do have a YouTube channel called Changemakers Media, which you'll see in the comment section. I post videos on teenagers who are making an impact in their local and international communities. I would greatly appreciate it if you guys could go down there and subscribe to show your support for these teenagers and encourage these change makers to continue impacting the world. That's it from me, everybody. Thank you so much. I'll see you in the future. Bye-bye.
The AI story is so dominant right now.
The market is punishing anybody who decides not to play in AI.
AI is going to be a defining trend probably for the next 5, 10, 20 years.
You have to own a little bit of everything, not just tech. Earnings growth is going to be better next year than people expect. Right now, I think we're in pretty good position.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, stocks meet gravity. Equities pulling back following a mega cap tech rally as Wall Street bosses are putting a spotlight on extended valuations. The capital of American capitalism is on the brink of voting in a socialist. It's election day in America.
And a lot of focus here in New York City, especially just because of the sort of local bias. It was very interesting from a local perspective. There is a larger issue at play. We talk all about the K-shaped economy on this show. Every economist comes on and talks about that. How each party is dealing with that is fracturing the insides of both the Republicans and the Democrats. And right now, what you see is a fight for the heart of the Democratic Party in a very real way.
This is true, and it has been for a long time. It's an unequal economy. It's an unequal stock market as well. And we've seen that in the performance of the last week or so, dominated by mega cap tech.
What you're seeing is mega cap tech reporting earnings that have come in better than good and repeating the dominance that we've seen. Yesterday was a great example. ISM manufacturing came in weaker than expected pretty much across the board. The employment component pointed to job losses for the year when it came to manufacturing, the area that was supposed to be the bastion of the economy right now. And so you're seeing the rest of the 493 do poorly while the Mag 7 rally. This has been the story all year. And it's a question of, can it continue or is something going to break?
Broader market's starting to break just a little bit, a tiny bit maybe. We're down about a 1% on the S&P 500. The pushback begins. David Solomon of Goldman. Technology multiples are full. Morgan Stanley's Ted Pick, a gentleman you know well, Bramo. Markets seem expensive. They say all those things the day after we saw a monster debt issue come from Alphabet. The week after we saw the same thing from Meta.
Yeah, and you saw the pushback yesterday. Massive pushback from the investment-grade bond market. Spreads widened by 4 basis points in response to the latest huge issuance that you see coming out of big tech. Look, they're also talking their book. They don't sound pessimistic, these Wall Street CEOs. They're coming out and saying, it seems like things are a little frothy. No one wants to buy into valuations that are this high, and yet person after person has come on the show and said there is no alternative, because ultimately we don't see a reason for this to fall apart anytime soon. So to the extent that they're talking about a 10 to 15% drawback, oh, kel horror. The reality is they're all going to be jumping in to buy that, and it seems like none of them are saying this is something to really cry about.
We'll see if this pullback sticks this morning, at least so far. At 6:02 Eastern Time, Tuesday morning, we're down about 1% on the S&P 500. Coming up this hour, we'll catch up with Henry Allen of Deutsche Bank as the equity rally hits a snag, the former New York City mayoral candidate Whitney Tilson as election day arrives, and Torsten Slok of Apollo on the potential for further rate cuts. We begin this hour with stocks pulling back from near all-time highs as Wall Street bosses issue a fresh warning on rich valuations and a possible drawdown.
Of course, it is likely there'll be, a 10 to 20% drawdown in equity markets sometime in the next 12 to 24 months.
We should also welcome the possibility that there would be drawdowns, 10 to 15% drawdowns that are not driven by some sort of macro cliff effect.
Joining us now to discuss, Henry Allen, macro strategist at Deutsche Bank. Henry, I feel like this is a move looking to find a narrative. How would you describe this to clients this morning? What is this pullback so far today?
I think this is actually just a kind of normal, regular pullback that you're going to get in any normal bull run. I mean, at the end of the day, you're not going to hit all-time highs day after day after day. We've had over 30 this year. So getting these kind of pullbacks, which in the grand scheme of this relentless bull run are pretty modest, we're still only around 2% off the all-time highs to the S&P, is to be expected. But, if we look at the macro fundamentals right now, they do remain pretty strong. Clearly, with the US-China trade truce, the risk of near-term tariffs has been taken off the table. We still have the tailwind from the recent Fed rate cuts, another 50 bips already this year, even if they don't cut in December. And actually, a lot of the activity data at a global level has been pretty good. I was struck, for instance, in Europe, that the flash PMI, actually, the composite PMI, was at a 2-year high. So actually, the ISM manufacturing yesterday, yes, a little bit weaker than expected, but, I appreciate the data has been limited out of the US, but that has actually been the exception rather than the rule. And I think that fundamental bullish backdrop does remain in place.
Henry, at the same time, I think we have to take note when a stock falls on good news, not bad news. Palantir and the earnings from Palantir wasn't bad at all. If you go through the numbers relative to expectations, then you see the move this morning and the stock is down by 6 or 7%. Does that speak to full valuations? What do you think that speaks to?
I think you always get these moments where single headlines can create a lot of fear. I mean, I remember back in early in the year, before the Liberation Day turmoil, we had the DeepSeek AI model released, and there was a very big temporary pullback in tech stocks that proved to be very short-lived. People thought this might be a new big narrative shift, and it wasn't. But, thinking about those CEO warnings you played just before this, if you think about what has generated, 15% drawdowns for the S&P in recent decades, it's usually taken one of three things. One is a recession, which there's no sign of yet. The Atlanta Fed's GDP tracker actually at 3.9% in Q3. Another is fears of a recession, like we saw after Liberation Day, but no one's seriously talking about a recession right now. And the other third component that has gone with that is Fed rate hikes. So a lot of the sell-offs we've seen in recent years, so 2015-16, late 2018, and indeed 2022 most notably, have gone hand in hand with Fed rate hikes. But they're not talking about hiking anytime soon. And if anything, obviously with the new Fed chair coming in next year, the direction of travel remains pretty dovish.
We'll talk about the Fed in just a second, but it's not just the big Wall Street CEOs that are talking about this. I actually took more notice at a story that came out this morning that Michael Burry of The Big Short fame is shorting Palantir and NVIDIA shares. And he's coming out and talking about valuations, but he's also kind of leaning into a narrative that an increasing number of people have talked about, which is this K-shaped market can't continue. You have to see some monetization of the software, of the hardware, in order to keep this AI trend going. Do you think there's validity in that maybe some of the winners need to take a pause and there needs to be a transfer in terms of stock market leadership?
I think to some extent there is, but I think a lot of the comparisons to the dot-com bubble are really quite over-egged at the moment. So, for instance, the Nasdaq is up by 23% year to date so far. Now, that's very healthy. But in 1999, we had the Nasdaq up 85% that year. And in the final 7 or 8 months of the dot-com bubble, the Nasdaq literally doubled. So I don't think the gains we're seeing, can really be compared to what we saw at the time of the dot-com bubble. And another key difference between now and then is back then, a lot of the assumptions that valuations rested on was a belief that 4% growth as we saw in the mid to late 90s would continue forever. Forecasts from reputable people like the Fed were saying that would continue well into the 2000s. But then, as we know in retrospect, we had that downturn in 2000, 2001, and there was a recession. Whereas again today, valuations are not resting on continued 4% growth forever. We're kind of in a 2.5% to 3% range, perhaps with some upside if AI productivity does lead to a boost. And again, there's no recession on the horizon. So clearly, if that macro picture changes and we do get a growth downturn, then I think that would take some of the underpinning away. But for now, we're not seeing those relentless, remorseless gains that we saw at the time of the late 90s.
You talked about the other catalyst, the potential catalyst for an end to the rally, which comes from the Fed and a potential tightening in Fed policy. Seems like that is nowhere on the table, as you were mentioning. You did say that maybe inflation is underappreciated, and that's something that Deutsche Bank has been talking about quite a bit. What makes you think that, based on the ISM manufacturing, which was the opposite, based on the fact that there is this K-shaped economy that has put pressure on any additional price gains that we've seen in the consumer sector?
Well, I think there are still a lot of inflationary catalysts. I think the market has been a bit too reassured by the US-China trade truce we saw last week and some of the other recent data. But at the end of the day, for instance, tariffs, very still much in the picture. I know we associate a lot of the tariffs that have come in with April time, but actually a lot of the tariffs, for instance, the 15% on the EU and Japan, the 10% increase on Canada, the sectoral tariffs like copper, a lot of those tariffs only came into effect in August. And the data we've got only goes up to September. So that's still going to be a theme as we move towards year end, the Q4 data, and into 2026. On top of that, we still have the lagged impact of all the rate cuts. Indeed, it's worth bearing in mind the Fed have now cut rates by 150 basis points since September last year. That is the fastest pace of rate cuts outside of a recession since the 1980s. This is not a framework that we've been used to in recent times. You've got momentum there too. The activity data, still proving pretty resilient, so that suggests demand pressures. And at a global level as well, you've got factors like the European fiscal stimulus coming in. So as I look around the world right now, including in the US, I think there's actually still a lot of inflationary catalysts on the table. And I think markets risk ignoring that at their peril, because if we do see inflation start to tick up again more than markets expect, I think the risk is we get a similar hawkish surprise to what we saw last week, where markets were surprised when Fed Chair Powell took that December rate cut a bit off the table, put it in some doubt.
Henry, I know that Deutsche Bank just re-entered a short position on 10-year treasuries and have a target of 4.45%. I'm just wondering, is that enough to continue the sell-off that we're seeing this morning in risk assets, given the underappreciation, as you've been saying, of inflationary risks?
I mean, that's an interesting question. I think the key question, particularly as we move forward into next year, is do we get that reacceleration in the economy? Because one thing I've been struck by in this post-COVID cycle is that consistently, particularly in the US, the macro picture surprised on the upside. So even in 2022, though we had the fastest Fed rate hikes in a generation, which previously had always led to recession, they pulled off the soft landing just about. Then in 23 and 24, we had stellar equity gains. The S&P 500 rising back-to-back 20% for the first time since the late 90s. So again, that macro picture has been very strong. And again, this year, even though we had genuine fears of a recession around Liberation Day, the biggest trade shock since the 19th century, again, the economy has been remarkably resilient. So actually, I do think there is upside potential for yields as we look forward to the rest of this year into next year. And actually, I'm struck that last year when the Fed cut rates, actually, it was the point they were cutting rates that actually proved to be the low for yields. From then onwards, they picked up again. So I definitely think there's a valid case for that.
Henry, enjoyed this. Thank you, sir. Henry Allen there of Deutsche Bank. Henry touching on something super important coming out of the pandemic. We have consistently underestimated the strength and resilience of the US economy, and we've done it time after time.
Yeah, and this is the reason why some people are saying that maybe the inflationary concerns are going to cause some sort of sell-off in bond markets that have been pretty quiet. I mean, we've seen the Fed cut rates, and we've actually seen bond yields in the long end go down. So here's the question. Is the resilience in the right parts of the economy to allow inflation to keep going up? Because there is a huge bifurcation, and we keep talking about it, and we'll keep talking about it throughout the morning.
Bond yields down so far this morning by 3 basis points at the front end of the curve. We're down 3 on 2s to 357. On 10s, we're down 2 to about 4.1%. 10. That's the price action. Let's get you an update on news worldwide with your Bloomberg brief. Wall Street executives warning of an equity pullback. Goldman Sachs CEO David Solomon and the Morgan Stanley boss Ted Pick expecting a 10 to 20% correction in equity markets over the next 12 to 24 months because of, quote, challenging valuations. Elsewhere, President Donald Trump is threatening to withhold federal funding from New York City. It's a last-ditch effort to drive the city's voters to the former New York City governor, New York Governor Andrew Cuomo, and prevent Zohran Mamdani from winning the mayoral election. And finally, U.S. Secretary of State Marco Rubio reportedly helping persuade the president to leave NVIDIA chips out of last week's trade talks with China. The Wall Street Journal reporting that Rubio warned selling top-tier chips to China could pose a national security risk. That was in focus, Bramo, last week. That's why it didn't happen.
Yeah, and the idea that there are multiple voices pushing the win for Rubio versus Jensen Huang, who still is coming out and saying, we hope that he'll come to his senses and let us do this. And the rest of the administration is saying, please don't. So let's see how that battle continues.
It's good to see that Rubio's still in charge of foreign policy and not the NVIDIA boss, right?
For now. I mean, let's see.
At least that's something. That right there is your Bloomberg brief. Up next on the program, Election Day in New York City.
We know and have known for months that Donald Trump would favor Andrew Cuomo as the mayor. They share the same small vision.
Trump will go through Mamdani like a hot knife through butter.
Governor, do you accept
and we can't have that.
Up next on the program, the former New York City mayoral candidate, Whitney Tilson, joins us next from New York City this morning. Good morning. Live from New York City, welcome back to the program. Equity futures rolling over. We're down about 1% on the S&P 500, negative by 1.3 on the Nasdaq, on the Russell down by 1.3. If you switch up the board and get to the bond market, it's pretty defensive this morning. Equities selling off, bonds a bid, yields are lower by 2 basis points, 10s at about 4.08%. Lisa 2s back to about 357.
Yeah, and it follows what we saw from ISM Manufacturing. You could say it's ISM Manufacturing. It's not the big employment report. And guess what? It takes on that much more importance because we're not getting the big employment report. So here's the question. Are these peripheral data points indicating a real weakening in the underlying economy that's led to this K-shaped type of market in addition to a K-shaped economy?
That's the latest on the data front. ISM services still to come this week, about 24 hours away. Equities not doing so well this morning. Coming up on the program, under surveillance, Election Day in New York City.
We know and have known for months that Donald Trump would favor Andrew Cuomo as the mayor. They share the same donors. They share the same small vision. They share the same sense of impunity.
Mamdani cannot handle Trump. That's clear. And the next mayor has to be able to handle Donald Trump. Trump will go through Mamdani like a hot knife through butter.
Governor, do you accept
and we can't have that.
So here's the latest this morning. A record number of New Yorkers already casting early ballots for the city's next mayor. President Trump announcing his support for Andrew Cuomo, who is running as an independent, and threatening to withhold federal funding if front-runner Democratic Socialist Zohran Mamdani turns out to win. Whitney Tilson is a former hedge fund manager and was a 2025 New York City candidate in the Democratic mayoral primary. He joins us now for more. Whitney, good morning. It's good to see you.
Good morning. Thanks for having me.
Thank you for being here. What's at stake today?
Well, it's a big day for New York. I think there's going to be a big surge in turnout, and I'm glad to see New Yorkers are getting politically involved. Early voting was 4 times what it was 4 years ago. I wish that didn't favor Mamdani, but it probably does, as it did in the primary. But the polls show the race is tightening. It was 15 points, and now the latest poll, just yesterday, it's under 5 points. So it's not completely impossible that there could be a big election day surprise, though Mamdani's clearly up 5 is still a good place to be going into election day.
You're familiar with the headline on Wall Street that the capital of American capitalism is lurching towards socialism. Yeah. Does this tell you more about the mood of the country or the mood of the Democratic Party?
Well, and also it tells you something about the candidates. Mamdani is a gifted politician. He identified the key issue for New Yorkers is affordability, and he came up with some very clear, freeze the rent, free buses, free childcare, very easy slogans. And one thing I learned as a politician, if you want to win, promise the maximum number of people, the maximum amount of free stuff, and tell them they don't have to pay for it. And he nailed that, and he's been on message. And Cuomo thought he was going to coast to victory in the primary, and really didn't even campaign out there. And by the time I was raising the alarm in the late stages of the primary, it was too little too late.
It's simplistic, though, to say that it's just promising people freebies, and that's what got some of the attention. It's also that what Zoran Mamdani was talking about wasn't just the anti-Trump platform. It was the idea of trying to identify some of these needs. Have you been disappointed that the Democratic Party hasn't done a better job of crystallizing those issues and running on that and not an anti-Trump message?
Yes, very much. And I don't think it's just here in New York we're seeing it. We're seeing it nationally. I'm a lifelong Democrat. I ran the Democratic Party to try and drag my party, back to the center, to bread and butter issues for people rather than social issues and just attacking Trump. And Mamdani, to his credit, hasn't spent a lot of time attacking Trump. That was not his. It was affordability and a few key ideas. And in the same way, from the opposite side, he's a little like Trump. Trump was, we're going to build a wall and Mexico's going to pay for it. And I don't think his supporters it actually believed that, but it was a clear message on the issue that they cared about. And Mamdani took a page out of that book and has executed superbly. I got to tip my hat to him.
One thing that you do really well is that you're at the crossroads of Wall Street and the political scene. And I'm just wondering how realistic you think some of the threats are by your colleagues of leaving New York City if Zoran Mamdani should win.
That will depend on whether he governs as he has in the past few months, as he's promised to, sort of tacking to the center, and said, I will protect the Jewish population of New York despite his dangerous rhetoric in previous years. I will not defund the police, and to his credit, said he will keep Jessica Tisch. I'm going to embrace entrepreneurs and businesses as opposed to government seizing all means of production, which is what's on his political party. The Democratic Socialists of America says that. So I'm cautiously optimistic, hopeful, I would say, that if he is elected, he will try and govern from the center, keep us safe, and keep New York, the incredible center of entrepreneurship and finance and trade and all. But there is a risk that, a 34-year-old guy who's grown up with the rhetoric of the far left, if he governs as a radical, I think people will flee the city and businesses.
Elisa, it's already happening. You've been seeing it now for years. I think a great stat is that JP Morgan Chase now has more employees in Texas than it does in New York State, which 10, 15, 20 years ago might have been shocking to some people, but that's the reality of America in 2025.
A lot of it has to do with taxes. A lot of it has to do with certain business practices that haven't been as friendly. How much does this accelerate that move, as we've seen? And how much is Zoran Mamdani, if he does win, going to be sensitive to that, to want those people to remain an income base for the city? It's
not just making the city more competitive with global capitals, it's making this state more competitive with the other states across this country, which goes to Lisa's question. What's going to stop people from moving? Whitney, when you were going out there and campaigning, what are you campaigning for? What would you like to see change in this city, in this state, to make sure we attract the best of the best, not just around the world, but in this country too?
Yeah, well, it starts with public safety and not defunding the police. Defund and dismantle the wicked police are all things Mamdani had on his website. And I said, we need to do the opposite. We're at a 34-year low in the number of police officers, and we need 5,000 more police officers. I was going in the other direction on public safety. And then secondly, look, economic growth is the key to everything. It's the key to paying for all the things Mamdani wants. And I would love to deliver free child care to every New Yorker as well. It's that cost is crushing people, but you got to be able to pay for it. So under Mike Bloomberg, the taxes doubled, but that's because the economy doubled during his 12 years. Under de Blasio, economic growth slowed from 6% a year to 2% a year, and all of a sudden we're running budget deficits. So creating a business-friendly environment is critical, and unfortunately Mamdani's rhetoric is sort of the opposite, and rhetoric matters when it comes to making long-term investment decisions about where to locate your business, whether to invest in building and hiring people and so forth. That was a key part of my platform, but it turns out just affordability and promising lower costs in a few areas was the winning message this year. And Mamdani executed on it superbly. He was on message.
I mentioned JP Morgan. Jamie Dimon talked about Bill de Blasio, and he said something like, we survived Bill de Blasio, we'll survive this.
Yeah.
Is that too simplistic?
No, it's my model that my working scenario going forward is Mamdani will be de Blasio 2.0. Little left, too far left for me, but de Blasio did not mess up this city. New York is still doing incredibly well, and I'm actually much more optimistic on New York, having run for mayor and spent 7 months in every corner of the city. We're an incredibly rich, dynamic, entrepreneurial city, and I'm confident Mamdani is not going to drive everybody out and mess it up.
You know, this is sort of a sensitive question, but are you surprised to the degree that the politics around the Middle East are driving voters in New York City to a large degree?
Not really, because New York has the second largest Jewish population outside of Tel Aviv in the world. It's about 10% of the population here. And my wife and children are Jewish. We've been members of Central Synagogue for 25 years. And Central Synagogue, anytime you go to services now, there are not just a few police officers. Like, there's paramilitary people out there protecting us. We have to go through metal detectors. It's a fortress because of these mobs and the rhetoric, the anti-Israel rhetoric that Mamdani is trafficked in. You don't have to go very far before it becomes anti-Semitic, and some of these people are committing violent acts against New York's Jewish community. So it's a big issue. It's one I hit Mamdani hard on during the primary. And again, to his credit, he has said that, job one for me is going to be protecting all communities that are under threat, especially the Jewish community. I'm hoping he delivers on that.
Whitney, it's good to see you.
My pleasure.
Thanks for making time for us. We appreciate it. Whitney Tilson there, the former New York City mayoral candidate. It is election day here in New York City.
Yeah, and also in New Jersey, and also in Virginia, and also in California. A real question for the battle for the heart of the Democratic Party, and frankly, a question of whether this will be a referendum on what's been done so far over the past couple of years. Honestly, there is a fissure in both parties right now, and it has to do with the economic issues that we've been talking about, that K-shaped economy, and how there is disagreement over how to address it.
We've got to go way back and start with education. What happened in this country? Why are highly educated, wealthy, privileged kids voting for socialism with a complete lack of awareness about economic history and the last 50, 100 years every time that experiment has been tried?
It's actually a great psychology experiment. There are a number of studies. We can get into them, but I actually have been reading about this. It's pretty fascinating.
We'll have some fun at the commercial break. From New York City this morning, good morning. You're watching Bloomberg TV. A two-day rally hits a wall this morning. We're down by 1% on the S&P 500, on the Nasdaq down by 1.3. Kicking off November, adding to October gains, but some very narrow leadership on Monday. Through to Tuesday, the pullback continues across the board. On the Russell, we're down by 1.3%. In the bond market, yields pushing higher through yesterday's session, down this morning by 3 basis points at the front end on 10s. We're down by 2 to 4.089%. Data hasn't been great in the last 24 hours. In the next 24 hours, more data still to come. ISM services very much in focus.
Especially given the fact that ISM manufacturing isn't proving the sort of bastion of growth that some people were expecting. Do you see the same kind of softness, particularly on prices paid in services? Because prices paid went down when it came to ISM manufacturing, and it was in contractionary territory. None of this is talking to runaway growth or inflationary pressures that a number of people have been worried about.
What do you think was kicking around the Treasury market yesterday? Fed speak, data, or just the amount of issuance coming from corporate America? And by corporate America, I mean mega cap tech, Meta, Alphabet in the last week.
Call me a skeptic, but I don't think that the Fed speak is actually what's doing it, because right now it's hard to know how much of a difference any one person is going to make, given the fact we know the committee is split. So I don't want to put too much tension there. The glut of issuance has to be front and center, especially at a time when people are increasingly worried about high valuations. And you did see a little bit of digestion issues. I mean, this is like 1 ton. This isn't exactly like the full Prilosec, but this idea of 4 basis points of widening in the investment grade credit spreads speaks to the glut of issuance.
$90 billion of demand for a $17.5 billion debt issue coming from Alphabet yesterday, and they threw in some euro-denominated debt as well for good measure.
Why not?
Some unreal numbers coming out of that market. As we count you down to the opening bell a few hours away, about 3 hours away now, let's get some morning movers for you with Yahira. Hey, Yahira.
Hi, John. Palantir delivered one of its strongest quarters yet with soaring sales and a higher outlook, but you wouldn't know it by looking at the stock. It is down 6.4% in the pre-market as investors grow increasingly worried about its sky-high valuation, with its price-to-sales ratio sitting at 85, the highest in the S&P. So analysts in note after note are warning the numbers may finally be too rich, even for one of AI's biggest winners. And we move on to Tesla. The risk-off mood translates to that as well, down 2.3% after Norway's sovereign wealth fund came out against Elon Musk's proposed $1 trillion pay package. The fund cited concerns over the size of the award, dilution, and Tesla's growing reliance on Musk's leadership, highlighting some of the investor pushback we've seen from ISS and public pension funds ahead of that key vote this week. And we end on Denny's. Those shares are soaring nearly 50% after the diner chain, known for its Grand Slam breakfast, said that it's being taken private in a $620 million deal. This adds to the wave of companies we've seen leaving public markets as investors look to whip up value outside of the Wall Street spotlight. John?
Yahira, thank you. Appreciate it. More from Yahira in the next hour. On our radar this morning, some breaking news. In just moments ago, the former Vice President Dick Cheney has died. He was 84. Cheney served as the 46th Vice President of the United States from 2001 to 2009 under President George W. Bush. That news coming in just moments ago. Any further updates, we'll bring them to you. Elsewhere, it's election day in the U.S. and New York City voters will be choosing among Democratic candidate Zohran Mamdani, former New York Governor Andrew Cuomo, and Republican Curtis Sliwa to be the next mayor of the city. And finally, stocks pulling back this morning as Wall Street CEOs are waving a red flag for investors, warning an equity market drop of more than 10% could be coming in the next 12 to 24 months. Due to sky-high valuations. Stocks are down across the board this morning. It must be frustrating to be a CEO on Wall Street because you make headlines even when you just state the obvious, right?
I mean, 10 to 15% is almost like a knee-jerk kind of response. Yeah, sure, I could see the market going down 10 to 15% every 12 to 25 years. It's sort of like saying there's a 20% chance of recession. There's always a 20% chance of recession if you're an economist on Wall Street. Nonetheless, it speaks to the idea that we are seeing sky-high valuations. And you pointed to Palantir. I think it's a valid point. The fact that they've gained 150% so far this year. Palantir shares have been on a tear. They delivered another beat for the 21st consecutive quarter. The CEO said we are in a nosebleed zone. No one else is here. And the stock sold off, not because they didn't deliver, but because people are just worried about how far and how fast this has run.
I think it's fair to say that when a stock falls on good news, it tells you something about valuations
100%.
And how much we've rallied. And Palantir news yesterday, if I'd just given you that, didn't even show you the market move and just gave you what Palantir said, there's no way people would come out and say that was a bad earnings report.
They have a run rate of $4 billion, and they're talking about 63% growth. This is crazy in terms of any type of other company that is of similar size. So you start looking at this type of growth, and you start saying, well, maybe the valuations are warranted. At the same time, a lot of this is a guessing game. And the guessing game has gotten pretty frothy. And I think that's the reason why people are getting nervous. And frankly, the reason why some of the CEOs might welcome a sell-off rather than just simply this steady march upward.
Palantir down in the pre-market. Broader equities on the S&P 500 negative by 1%. Let's turn to trade. President Donald Trump deciding against allowing Nvidia to sell its top-of-the-line Blackwell chips to China ahead of his meeting with Chinese President Xi Jinping just last week. The Wall Street Journal now reporting Trump made the call after advice from top officials to protect U.S. national security. Joining us now to discuss the former NEC Deputy Director, Everett Eisenstadt. Everett, welcome back. This is, I think, for many people, particularly down in Washington, D.C., promising news that the president was responding to the advice of his State Department and not the advice from the Nvidia boss about what he would like to see. Is that welcome news for you?
Well, it's always good news when you have the experts weighing in on national security matters, and that's what they're there for. They're there to advise the president and give their best counsel as to what's in the interest of U.S. national security. The president always has listened to his advisors. Of course, he's the ultimate decision maker, and at this point, he decided that this was not the time to do this. So I think those who are concerned about national security risks, technology transfer to China, are going to be heartened by that decision.
Everett, do you think it's case closed, or is there still an open debate down in Washington?
It's never a case closed. This debate, it's a continuation of a conversation that's been going on for years. Is what's the appropriate level of technology? What's the type of technology? And it's a real tug of war between trying to sell and supply the world with our best technology, which we've created and earned, and also being sure that it's not getting in the hands of folks who are going to do things that are not in our national interest. So it's a continuous debate, and one that's going to continue to play out.
Everett, what do you make, though, of the idea that it's a national security issue not to provide China with some of these high-end chips because it will prompt them to move away from U.S. technology, deploy their own, and create an alternate system that could potentially be more of a threat than if we just gave them those chips? I mean, this is the argument that Jensen Huang has been making. Do you find it credible?
I think there's always a balance between how much control you contain over your technology and whether, I think you can also say it the other way, that if the other party has a technology and they're using it, they may be able to accelerate their imitation of that technology more rapidly. So I could see both sides. It's never really a super clear one or the other. There's always a balance there. So I'm not sure that withholding the chips necessarily would enable them to accelerate faster. I could even make the case that it might delay them or not having those chips.
Everett, there's also this issue right now that people have been rather sanguine about, that tomorrow we do get the Supreme Court decision, or arguments rather, not the decision, around the legality of the tariffs that Trump has put on. And I'm just wondering whether there really is a huge economic risk, as President Trump has said, if these tariffs are overturned, or do you think that there is an infrastructure of other levies that could take its place in short order?
Yeah, this is a big case. I mean, this is significant for a number of reasons. I mean, the president's really built much of his economic platform, both domestic, international, and even the foreign affairs, on tariffs. Now, he's been using several different statutes to do that. The one that's being debated here before the Supreme Court is the International Emergency Economic Powers Act. If that is struck down, it will limit the president's ability to impose tariffs as quickly as he has, although there are other tools. So go to directly to your question, the president can make up this tariff authority through other means. There's a lot of other statutes out there he could use. Some have been rarely used, just as IEPA had been rarely used before the president took office for tariffs this cycle. So there's a lot of other ways he could do this. So the tariffs are going to continue. But this case is very significant. It's going to have a big impact, as you noted, not only on the amount of revenue that's sitting there, but also on the ability of the president to really wield power in a very, very effective and efficient way. And it will have some constraints on that authority.
So, Everett, can I just pick up on the significance of this? What is the difference now compared to where we were in the president's first term? Why has he chosen to govern differently and use different tools to address the same problem?
No, it's vastly different. I mean, in the first term, we were talking about limited use of tools for very discrete purposes. We were using 232, a statute that targets imports on national security grounds to limit imports of steel and aluminum into the United States. And obviously, the 301 on China was very focused on China, on intellectual property rights, technology transfers, and unfair practices there. You compare that to where we are today, not only are the number of statutes being used, but the reasons and the rationales behind those statutes has expanded dramatically. We've seen them use everything from, putting tariffs on kitchen cabinets because the timber, the steel and aluminum, 301 tariffs potentially on Brazil. We've seen tariffs on India over secondary sales of Russian oil. So it's a vast expansion of tariff authority used by a president, and it's never been done in my lifetime. And I think you'd have to go pretty far back to find a similar dynamic in our history. It's quite dramatic.
Everett, as Lisa pointed out, we're here arguments. Might not get a final decision until the end of the year, maybe. But Everett, can you describe the period after? If this is struck down and we have to move in a different direction, what do those months, quarters, years look like in the president's second term for trade policy?
They're going to be I don't think they're going to fundamentally change. The policies will not change. They may be modulated a little bit. he will have to find a different way to achieve the same objectives. And as I noted, there's tools to do that. So he'll be able to recoup the revenue. He will be able to impose tariffs under other statutes. He'll be able to reshore manufacturing, raise revenue. I think one of the key questions is if the statute is ruled unlawful in this instance, what will the Congress do? And will the Congress come in and modify that statute? Will the Congress come in and perhaps retroactively approve the framework agreements that the president has negotiated? It's a really interesting dynamic because the authority the president has used for those framework agreements with countries like Japan and South Korea, United Kingdom, they are driven by tariff authority. That was the leverage, but they aren't necessarily sustained by that. The president has his foreign policy power. He has that executive authority. He's used it for those framework agreements. Will some of those be renegotiated? Will they be approved by Congress? We'll have to wait and see. But it's going to be a very significant ruling. And I think in many ways, once the ruling has been finalized, we'll probably get a more certainty as to the route of the administration for the remainder of the term. So it's going to make for some very, very interesting dynamics.
Everett, appreciate it. Thanks for jumping on. Everett Eisenstadt there, the former NEC Deputy Director. This market wanted to move on. Just shows the rules of the game. This would reintroduce a lot of volatility around policy and decision-making for the years to come.
And your question about what do the months after the ruling look like if it is overturned is a really important one because a lot of people think that they can come up with some sort of system of other tariffs under jurisdictions that will compensate for that revenue. And that's the reason why the Treasury market's not going to sell off. We'll see, right? We shall see.
That could be a messy few months, that's for sure. If you are just joining us, welcome to the programme. Equities recovering a touch. We're still negative across the board on the S&P 500, down by about 1%. Let's give you an update on stories worldwide this morning. Here is your Bloomberg brief. Apollo Global Management reporting third quarter earnings that beat estimates. Apollo seeing a 23% jump in fee-related earnings. Its assets under management topping the $900 billion mark for the first time. Elsewhere, BP is trading lower in London trading despite posting earnings that beat analyst estimates. The company saying operational improvements and higher oil and gas production outweighed lower prices. And finally, British Chancellor Rachel Reeves paving a way for tax hikes. Reeves blaming the previous Conservative administration and global trade frictions for hurting the UK economy. She's also pledging to cut UK debt costs. And that right there is your Bloomberg brief. Bramo, you caught up with Chancellor Reeves in the past few weeks. Those excuses are starting to sound a little bit stale now, aren't they?
I won't comment on the discussion around it, but it was very strange. It felt like asking one question and someone knows what you're asking and they just completely answer their own thing. And it doesn't happen that often. I think it's clear she thinks she's in a really tough position. She isn't being fully transparent. She didn't reiterate her pledge not to raise taxes more broadly. There is a question of how much she wants to build her buffer. Is the UK an anomaly, an idiosyncratic story, or is this something that really is a template for what could come of other countries?
The tax and spend doom loop is not one you want to go into, and it's looking more and more like they might have gone into it. It's a problem for the UK.
Watch this space and watch gilts. This is what people want to see.
Up next on the programme, building the case for a jumbo rate cut.
What matters for the stance of policy is where you are relative to the neutral rate. I think that we're a fair way from neutral, and I think that we could get there a bit faster. I could imagine getting there in a series of 50 clips.
That conversation up next with Torsten Slok of Apollo. Live from New York City this morning. Good morning. You're watching Bloomberg TV. Stocks are down this morning across the board on the S&P 500, down by 1%. On the Nasdaq 100, we're down by 1.3. Similar move on the Russell. Under surveillance this morning, building the case for a jumbo rate cut.
What matters for the stance of policy is where you are relative to the neutral rate. And if neutral is here and policy's up here, you're very tight. If neutral's here and policy's down here, you're very loose. But if you stay where you are and then neutral goes down, you've passively tightened because the neutral rate has shifted. And so policy has grown tighter over the course of the year. I think that we're a fair way from neutral, and I think that we could get there a bit faster. I could imagine getting there in a series of 50 clips.
So here's the latest this morning. Fed officials explaining their views after a very divided October interest rate decision. Joining us now to discuss is Torsten Slok of Apollo. Torsten, good morning to you, sir.
Morning.
Super divided Federal Reserve based on the communication we've had so far from the committee following that decision. This line here from Governor Myron to us just yesterday, that we're a fair way away from neutral. I think we could get there a bit faster. How close are we to neutral?
Well, the key question here, of course, is are we doing monetary policy according to some framework with R-star or some forecast, or are we doing monetary policy according to data dependency? Because it's very clear that a lot of the arguments that are being laid out for more cuts, of course, is really dependent more on the forecast, or is dependent on some framework about what do you think R-star is. So the discussion about R-star, which we now have had for many years, of course, is very clear. There's a lot of uncertainty. So with that backdrop, yes, some estimates are low. So you could argue that those are the ones you should be focusing on. But it's very clear that the divide really here among FOMC members in the last few days has been around, should we focus the policy decisions today on R-star and some forecast that we may have, or should we focus it on the incoming data?
Well, let's talk about the incoming data. How can we forecast anything if we don't really know where we are at the moment?
Well, we do have CPI, of course, before the last FOMC meeting. But what we also have is that a number of indicators for the labor market are also still showing that things are actually still okay. If you look, for example, at the macro edge job announcement cuts data, that's still okay. The Challenger Gray and Christmas job cuts data is actually also still okay. If you look at ADP, job creation is also okay. If you look at Revilio Labs, also job creation, also okay. If you also look at paychecks, that's also link up. That's also indeed job openings. Taken together, all these indicators are not showing a labor market where the bottom is falling out. So that's why the conclusion from Jay Powell last week was very clear. Inflation is still around 3. The labor market is still okay. So with that backdrop, what is the argument for cutting rates, at least when you look at it from a data-dependent perspective?
The argument is that you are passively tightening, as we heard from Stephen Myron yesterday, because of the demographics and because of the fact that inflation is coming down. And with a labor market that's okay, but relatively fragile in certain corners, why not give them a little bit of support if you are above neutral to get back closer to neutral? What do you make of that argument?
Because there's also a broader discussion around, it's not only about the Fed funds rate, it's about financial conditions more broadly. And if you look at my Bloomberg measure of financial conditions, it still shows me that financial conditions are very easy. So in that sense, companies, especially in the AI space, they're not borrowing as a function of the Fed funds rate. They're borrowing as a function of equity prices. And given where equity prices are for the Magnificent Seven, that's very importantly coming a very significant tailwind still to the economy and still even to hiring, simply because we now have that equity financing is getting huge help from the fact that equity prices are still as elevated as they are at the moment.
You've done a great job of talking about the K-shaped market. And this is sort of the conundrum for the Fed. They've got this blunt tool of cutting rates. And there's this question of, does that help the lower income consumers and companies that are catering to them more than it really risks creating a bubble in the AI names and those areas where financial conditions are very loose? How do you weigh in on that?
That's exactly right. And that's why what becomes exactly critical, Lisa, is to think about what is the weight in aggregate consumption from the bottom 20% of the population, which is roughly around 8% of total consumption, whereas the top 20% accounts for 40% of total consumption, according to the Consumer Expenditure Survey. So because of that, it still is the case that when stock prices are up, home prices are up, and when interest rates are high, the cash flow for those who own debt, who own private credit, is still strong. So for those households at the upper end of income distribution, things are still looking good, and that's a very important reason why the consumer still continues to do well. And critically, it's not only a K-shaped economy for the consumer, it's actually also a K-shaped economy for the corporate sector. If you look at EPS expectations since the beginning of the year, Magnificent Seven, the expectation is that earnings will grow further, but for the S&P 493, earnings expectations have actually come down. Likewise, the same thing for profit margins. For the Magnificent Seven, it's going up. For the S&P 493, profit margins expectations have been coming down. So we're seeing more signs of the K-shaped economy, not only the division in terms of the consumer side, but also on the corporate side, where it's more and more the AI story that continues to drive everything.
Do you see limits to that trend?
Well, the key issue, of course, is to what extent on the AI story, of course, the AI companies that the Magnificent Seven can continue to deliver the earnings that are priced in at the moment. If there, for whatever reason, is any slowdown in earnings growth in AI, it will certainly begin to create some wobbles, not only in the data center build out and also, of course, the challenges on the associated energy side, but it will also begin to have some wealth effects, especially if we do get the correction that we've had some conversations about in the last 24 hours.
Yeah, just to think through this in the ultimate extreme, you need someone to have a job to buy the product you're selling, like ultimately, don't you? And the fact that we've seen some decoupling between employment and corporate profits, I just wonder how much longer that can persist.
Well, a very important part of that is indeed that immigration has been slowing down. So the Dallas Fed is now saying that the equilibrium non-farm payrolls is 30,000. So think about the ADP that came out last week. The monthly number was around 50, 60,000. So that means that suddenly we have that 50, 60. It's actually not too bad when you think about that suddenly the Fed is telling us that the new going rate where we should be is 30. So from that perspective, we can have a slowdown for immigration restriction reasons. Also the 100,000 on the H-1B that will slow down job growth and therefore still create a labor market that's just having slower growth in jobs, but not so much because the economy is slowing in GDP, but simply because immigration inflows are a lot weaker.
Torsten, if the Fed were to cut by 25 basis points, does that cause the K-shape to get wider or narrower?
So that depends on, of course, for the consumer side, if we continue to have a rally in the stock market, if we continue to have a divergence in asset prices going up further, then we will continue to see the K get even longer on each side of the leg. So in that sense, cutting rates is certainly something that normally boosts asset prices and therefore makes the wider K a distinct possibility.
I think you should get very nervous when the Federal Reserve or any central bank for that matter involves itself in a wealth inequality game, because arguably they've exacerbated it for the last 20 years.
And how do they address an economy that's uneven? If they cater to the lower end but end up helping the upper end more, then you have an even bigger problem and you just add fuel to it. It just becomes a real question. Is it a dual mandate? Is it a tri-mandate? Or is it something even more?
I think Chairman Powell has got a divided committee, but he's also been very inconsistent about how he views the labour market this year. And we've talked about this repeatedly. Earlier in the summer, he anchored his view of the labour market around unemployment and then shifted towards payrolls growth. What I just heard from Torsten is you can still anchor it around unemployment. The payrolls growth has shifted lower, but you haven't seen slack increase that much, captured by an unemployment rate that's been pretty steady.
That's why this market is really struggling around the idea that there is no understood reaction function to data that doesn't even exist. So then how do you predict what exactly the Fed is going to do in December? And it's the reason why one person's commentary can swing things one way or another, because there really isn't any type of linchpin to the argument.
Torsten, good to see you. And congratulations on the numbers over at Apollo. Fantastic figures this morning. Torsten Slok there of Apollo. Coming up next on the programme, Aaron Canada, Clear Harbor Asset Management, Henrietta Trays of Veda Partners, Kennedy Goldberg of TD Securities, and Kylie Kohu of Jefferies. From New York City, this is Bloomberg.
What I see is just a very weird economic cycle. It's an unorthodox recession.
I think the Fed has to be careful here.
The job market is going to be the linchpin here.
There's more two-sided risks to the Fed's decision than the market was pricing in.
This really looks like a slowdown, not a reacceleration.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Here are the scores. We're down 1% on the S&P 500. On the Nasdaq, we're down by 1.3. The pullback continues on the Russell, negative by 1.36. The week ahead shaping up as follows. Some data in the next 24 hours, ISM, ADP, and in the next 12 hours or so, some earnings. AMD after the closing bell, seemingly this morning. I mean, pick your poison. The Palantir narrative, we can get into it. Numbers were pretty decent, but the stock's down on otherwise good news.
What we've seen is a number of companies that have done very well so far this year have been punished even for good results, because ultimately there is a question about how much reality is put into these numbers. The narrative that people are putting around Palantir is they didn't give a good enough guide for 2026. How do you guide a nosebleed moment, which is what the CEO talked about? And that, I think, is the difficulty. How do you guide on technology that's transforming so quickly that people really can't come up with feasible estimates going forward?
Stock is down in the pre-market by 7%. Another name for you this morning is Uber. How's the consumer doing? Uber just posted their strongest growth since late 2023.
And their shares are lower in pre-market trading. And what they're talking about is total gross bookings grew 21%. It's not exactly screaming some sort of recessionary tale for the consumer. People have seen the prices of each ride go up significantly. They're talking about technology and customers and increasing adoption of low-cost offerings and moderating insurance pressures. All these nice words. It's not working in pre-market trading. And I think that that's the tell in terms of just how much the stocks have rallied and how much expectations already were where they delivered.
A lot of people in this country still doing very well. You see that in the numbers that you get from Uber, the financials. Then some other people really, really struggling, and that's been consistent. And you see that in the numbers of the likes of Chipotle that we've seen in the last week, Bramo. That speaks to the politics and election day in America in this city, here in New York.
What you talk about with Chipotle speaks to New York City politics in a couple of ways. Number one, people are going to be using fast casual. It's not exactly the people who are making millions on Wall Street. It's younger also. They have catered to a younger demographic for Chipotle. And when you take a look at the younger demographic, unemployment rates are much higher. You look at satisfaction rates much lower. They're feeling like they're getting a raw deal. So they're the ones that are struggling to buy $20 burritos, and they're the ones that are going to the polls. And you're seeing that in a strong confluence today.
We'll get to the politics later this hour. Coming up, we'll catch up with Aaron Cannon of Clear Harbor Asset Management as rising valuations weigh on Wall Street. Henrietta Trays of Vader Partners as the government shutdown ties the longest in history. And Kylie Cohu of Jefferies on how retailers are gearing up for the holiday season. We begin this hour with stocks pulling back from near record highs. Aaron Cannon of Clear Harbor Asset Management writing, despite valuation metrics that screen above term averages, we believe the earnings foundation is fundamentally stronger than in prior valuation peaks. Aaron joins us now for more. Aaron, good morning. And good to see you in person, sir. Thanks for being here.
Nice to be here.
Asked this a few times already this morning. How would you describe the pullback early Tuesday, down about 1% on the S&P?
Well, we're due. I mean, pullbacks of 10% or more happen about once every year or so. And we're trading at 23 times forward price to earnings multiple. You look at the market breadth, it's quite weak. Yesterday, the market was up over 1% on the S&P, and the equal weight was off. You look at the equal weighted performance year to date of the S&P 500, it's only up about 8.5%. If you look at the S&P 500, it's up a little over 17.5%. So we have nice earnings growth, but it's being pushed by Mag 7, and it's been quite weak. In the 493 stocks are only growing about 2%, and the rest of the market is growing in the teens.
How would you frame that narrow leadership? Is it a feature or a bug?
Well, I think we've seen a massive amount of sizzle, rightly so, on the CapEx spending front. $400 billion being spent. It's impacting multiple sectors across the economy. And I think there's a question right now as to, how it's going to sort of trickle down in the years ahead.
Credit is very, very robust right now. Is it difficult to construct a bear case for equities when, Lisa, we're getting such limited pushback from credit?
Right now, credit is saying, please keep going. And at a certain point, you can imagine that a lot of the bond borrowing for the tech sector really has only fueled the equity side of things because they're ultimately borrowing money to pay for some of the expansion. So any pullback, is that just a great buying opportunity, or is there some warning sign about how far you can see the advancement of the tech sector without the rest of the universe catching up?
Yeah, well, I mean, I think, as it pertains to credit, you look at, the spending and the debt issuance of late, and I think that's a cost of capital question, just being smart as a CFO of a company, deciding, should you issue debt or should you issue expensive of equity to raise capital to grow. So, at the end of the day, we look at the credit side, credit spreads. They're historically extraordinarily tight. High yield is trading at nosebleed tight levels, and we have to be careful about that. So how are we allocating within the credit markets? We're staying very short. If you look at default rates, they tend to collapse inside of about 18 months. And yet we still think you can probably capture the coupon. Atlanta Fed GDP now is running at 4%. The economy going into 2026 looks okay. There's a lot of policy concerns, particularly as it pertains to the upcoming Supreme Court interpretation of the president's authority around tariffs. That could have a massive impact around volatility going forward. But the economic picture looks okay. The K-shaped recovery, on the other hand, is of concern. Lower rates benefiting the 40% of American adults who do not own financial assets. And that's a big issue. It's playing out in the election probably today in New York City.
It's really interesting to me that you saw Mike Wilson and Brian Belsky yesterday on this show talking about a broadening out in the stock market rally. This idea that, yes, Magnificent Seven have done really well, but people are getting worried about frothy valuations. And the idea that the Fed's going to cut rates will only edify some of those other areas. Do you agree with that? Or do you think that it's really too early and people have been trying for this bet for a long time? It feels good because valuations are lower, but it has been a widowmaker.
Yeah, it's a good question, Lisa. I think the idea that as rates trend lower, you can change your discount rate and you can justify higher multiples, ultimately what that narrative speaks to. But I do think that there's the other reality where that 40% that doesn't own financial assets, they do have something. They have credit card debt and they have auto loan debt. If they're lucky, they have mortgage debt, but the first two are not even deductible. And if their incomes are low, they probably can't deduct it anyway. And so lower rates benefit that 40%. And I think that's why there is that divergence in that debate around this issue.
Are you beginning to see credit stress in that cohort that's notable enough to make a more bearish call on the broader market?
It's tricky, Jonathan, because I think we're starting to see default rates rise on the auto loan side. And yet we look at other aspects of the economy, like look at MasterCard and look at Visa and look at the volume numbers there. They're very strong, and now they're talking about strong holiday sales. And so, things haven't fallen apart yet. The employment picture, as Torsten mentioned earlier, is still relatively strong. If that were to weaken, I think that clearly gives a very strong green light for the Fed in December.
So many people are still conditioned by the crisis of 15, 16, 17 years ago, almost 20 years ago now. I'm losing count. And they always believe that risk is just around the corner. Lisa mentioned Mike Wilson of Morgan Stanley. Mike's view of the world right now is actually the recession's behind us. So all this fear that the bad news is ahead of us, Mike Wilson's saying it's behind us. It was spring. That was the low. That was the worst of the jobs data. Move on. We're going to see that recovery. Does that stack up to you?
Yeah, I think there's some truth to that. I think we may see slower growth in 2026. If you look at Bloomberg average estimates, we're going to go from 2.8 this year to 1.8 or 1.9 next year. That may be undershooting. I mean, we could see productivity gains with AI. Does that start feeding through into the economic picture? I think the big question around AI, too, and as it relates to the economy and really your question, because that's still going to drive the economic growth question, is how is AI going to be applied across sectors, across healthcare? How is it going to advance solving for important health issues like cancer and drug discovery, and to accelerate that and add value to the economy and add value to the broader society? And I think that's a big question for 2026 and beyond.
How have you changed your positioning since earnings season really is getting to the latter end? Are you at all, or do you kind of just have greater conviction in how you've been positioned?
Well, I think the idea of just chasing this Mag 7 trade is something that we need to be really careful about. And I think the concept of owning more of an equal weight, or should I say actively selecting holdings in a manner that isn't just taking into account the Mag 7, which has contributed to 61% of the total S&P earnings this year, I think is really an important way to sort of think about it. Last week, we had earnings coming out in many of our portfolios that were very strong. A couple were weak. And the bifurcation of sort of the top line benchmark return relative to sort of the equal return is I think a theme that we're going to have to sort of ponder a bit more. And I think selective investments, not just home and abroad. We've been very focused on Japan this year. We've been very focused on Europe this year. And thankfully, we've gotten that right. And sector performance in those areas has been very strong, but very different sector exposures have led to those very positive returns abroad. So we're thinking globally in that regard.
Is there any theme in terms of the companies that are doing very well outside of the Magnificent Seven in terms of either the sectors they cater to, the clientele, or their size?
Well, it's interesting. I think recently we've seen things breaking out. There have been rolling recessions, rolling sector recessions as well. Biotech's breaking out. Healthcare, life sciences. We're starting to see in the earnings calls that China may be normalizing a bit. Look at even the semiconductor design companies that have reported. They're talking about the China business there, which they wanted to exclude from their earnings estimates going forward. Now they're saying they've normalized. It's business as usual. So will that be a theme that continues, and will that drive sort of beyond the Mag 7 going forward? We'll have to keep our eye out for that.
Aaron, it's good to see you. Let's do it in person again soon. Thanks for being here. Thank you, sir. Aaron Cannon there of Clear Harbor Asset Management. Futures are down this morning by 1% on the S&P. Aaron mentioned the equal weight, down 1%, Bramo, in October. The Nasdaq 100 was higher by almost 5.
Yeah, and this is something that we've continued to see. I mean, I believe that the equal weight has returned about half of what the market cap weight has so far this year because of that dominance of the Magnificent Seven and the K-shaped market, where everything else has really lagged behind.
We've got a pullback so far this morning. That's your price action on the screen. Let's get you an update on stories worldwide. Here's your Bloomberg brief. We start with the former U.S. Vice President Dick Cheney. He's died. Cheney served as the 46th Vice President of the United States from 2001 to 2009 under President George W. Bush. He was also a White House Chief of Staff, Secretary of Defense, and the CEO of Halliburton. Cheney was 84. Elsewhere, the Norwegian cruise shares falling in the pre-market, the company warning of a softer final quarter than expected. 2026 is set to be the fourth consecutive year of record cruise demand, with operators cutting prices to cater to budget-minded travelers. That stock is down by close to 10%. And finally, Yum Brands reporting third quarter earnings that beat estimates, the company launching a strategic review of its struggling Pizza Hut chain and possibly exploring a sale after 7 straight quarters of contraction. The name bouncing back in early trading, we're higher by 1.9%. And that is your Bloomberg Brief. Up next on the program, making the final campaign push.
We need a mayor who can stand up to Donald Trump, who can get the funding that New York deserves.
The MAGA movement's embrace of Andrew Cuomo is reflective of Donald Trump's understanding that this would be the best mayor for him.
Kind of odd that in the last 24 hours, almost at the same time that Cuomo's talking about standing up to the president's endorsing him.
I was wondering about how that was going to fly. How does he manage that one? He could say, you know, I can stand up to him because he wants me to be the mayor.
Yeah, with great difficulty. Up next on the program, we'll catch up with Henrietta Trays of Veda Partners, live from New York City this morning. Good morning. 2 days of gains on the S&P 500, running into this wall right here. We're down 1% on the S&P. We're pulling back on the Nasdaq. We're down by 1.35. Similar move on the Russell. Under surveillance this morning, let's talk about the politics, making the final campaign push.
We need a mayor who can stand up to Donald Trump, who can get the funding that New York deserves. I can stand up to Trump.
The MAGA movement's embrace of Andrew Cuomo is reflective of Donald Trump's understanding that this would be the best mayor for him. Not the best mayor for New York City, not the best mayor for New Yorkers, but the best mayor for Donald Trump as his administration.
So here's the latest this morning. It's election day here in New York City. President Donald Trump endorsing Andrew Cuomo for the city's next mayor as the former governor faces an uphill battle against the frontrunner, Democratic Socialist Zohran Mamdani. Tracking the story for us here at Bloomberg is Bloomberg's Miles Miller. Miles, good morning to you, sir. Just walk us through how these polls might be tightening up going into the final day of voting.
Right. The last polls we saw were that this was probably a 10-point spread. But when it comes down to it, when you combine the polls with the early voting turnout, you're looking at really the potential of just Mamdani getting to 50%, a 50% margin in this race. If he gets to 50% of the vote when 99% of the votes are counted tonight, that means he has a striking mandate to get past what he has called his progressive agenda. Free buses, we're talking about child care, universal child care for those who need it in New York, talking about taxing the rich. All of these proposals really have to get passed by Albany, but he says that he has a partner in Governor Kathy Hochul, a person who has campaigned with him, but he's going up against Andrew Cuomo, someone who people know really well. This is a campaign that has come down to really three big things. Faith, so New Yorkers of faith, whether Jewish or churchgoers, young voters, new voters to the electorate, and also a new majority in this city, right? We're seeing South Asian New Yorkers come out to vote, being a brand new voting bloc with a candidate who reflects them and reflects what they need in this city.
Miles, we played some sound just moments ago of the two leading candidates addressing the sitting president. Miles, is it slightly awkward that the former governor, Mr. Cuomo, is citing his ability to stand up to the president at the same time he's being endorsed by him? And how much of a feature has the sitting president actually been on the campaign trail?
Yeah, I mean, he definitely loomed large, right? He is part of the reason why Eric Adams dropped out of the race, because the president said this needs to be a two-person race. Then you look at Curtis Sliwa, who was pushed not only by the president, but by his boss at WABC Radio to get out of the race. When it comes to Cuomo and the endorsement, Cuomo says it wasn't an endorsement because I didn't speak with him, but it was a tacit endorsement saying if Mamdani gets in office, he will pull funds from New York City. And Cuomo can't walk back from that. But it is important to know, we talk about how Trump has loomed large in the race, that Mamdani has said, if Trump wants to work with me on affordability, that's something he ran for as president, I'll work with him. it's kind of crazy to hear a Democratic socialist saying he'll work with MAGA Donald Trump to make the city more affordable, because that's what Trump has said, right? He wants cheaper grocery prices, and of course he wants for prescription drug costs to go down. So could they work together? Remains to be seen. I think he'll be very ever-present in New York City if Mamdani is to win.
Politics in 2025. Miles Miller, thank you, sir. More from Miles a little bit later this morning and through the afternoon on Bloomberg TV and on Bloomberg Radio. Henrietta Trays of Vader Partners joins us now for more. Henrietta, something that Lisa and I have been wrestling with throughout this morning. Is this election here in this city taking the temperature of the country, the mood of the country, or just taking the temperature of the Democratic Party? And which argument's going to win out as we head towards the midterms?
You know, it's fascinating. I think you said Donald Trump's name, 15 more times than either of the Democratic candidates in the race today in the lead into here. And I think that just really exemplifies where the Democratic Party is right now. They're so bifurcated and so lacking in a cohesive message that they can really only be anti-Donald Trump. Now, for Democrats, that's a good thing because Donald Trump is a massive vote turnout machine. So for Cuomo, for Mamdani, they're both going to be taking exactly what they want, spreading it out to voters and making it all about Trump, which really speaks to the lack of comprehensive message that Democrats have struggled with since 2016, quite frankly.
That's the reason why I think, Henrietta, a lot of people think of this as sort of like a mini pre-midterms moment, especially given the fact that there are races in New Jersey and in Virginia and California. There's an initiative that people are going to be voting on about redistricting. How much are you going to take a big read through in terms of what type of mandate President Trump has? What kind of vision gets the most voters for Democrats? How much is this taking the temperature versus idiosyncratic races with a number of very specific inputs?
The off-year elections, this midterm is one of the best predictors of what will happen in the House of Representatives next November. It is an exceptional early indicator from New Jersey, Virginia, not just who wins, but what the margins are. And the reason that President Trump is so animated about the midterms, if you follow his social media feeds, it's been 48 straight hours of endorsements, is because he is very likely, Republicans are very likely to lose the House, just statistically, with such a tight margin. And that means, massive subpoena power for the House of Representatives next year if it is democratically owned. So it is incumbent upon President Trump to do what I just said he does best, which is turn out the votes, but in favor of the Republican candidates. He really needs to hold on to the House more than anything else. And it's going to be a very serious uphill battle that, statistics and history show he is very likely to lose. So California, Pennsylvania Supreme Court, Virginia, New Jersey, the margins are where wonks like myself will be watching just to see exactly what we should be looking for next year. Is it going to be a 7-seat margin in the House of Representatives, or are we talking like 30 seats? That's what today's election can tell us.
How much are national concerns feeding into the local races, given the fact that the government shut down? There's a lot of dissatisfaction on a national level. At a local level, there is more engagement, an increasing amount of engagement from residents. Is there a divergence here, or is there a pretty clear correlation?
That's a fascinating question. I think it's different for each party. So in this cycle, the Republican Party has continued to be led by Donald Trump, and he's not on the ballot. And so what Republican staff and campaign operatives I speak with will tell you is that Republican voters are tuned out. When we saw the returns on the national election last year, people would go to the polls, vote for Donald Trump, and then leave. So the fact that Trump is not on the ballot this cycle, he's not on the ballot in the midterms, and he won't be next year either. The Republican Party is trying to figure out how can I backfill that dearth and that absence left by Donald Trump himself, the plain leader of the Republican Party, and get our voters excited for J.D. Vance, for Marco Rubio, for any of these local politicians. So you see this depressed participation on the Republican side because Trump is not on the top of the ticket, and that leaves a vacuum for Democrats to turn out. So really it depends on which party you're talking about.
Henrietta, I understand the temptation whenever we cover these stories to group people into very neat groups, Republicans, Democrats, but is there another group, another set of individuals that can't be put into one bucket, that are pretty fluid, and they're willing to vote for someone who's got a solution to their problem? And right now the problem for a lot of people in this country, and it's persisted for a long time, is affordability. And those problems were exacerbated through the Biden administration. They're looking for solutions. It might come from the far left. It might come from the conservative right. Henrietta, I just wonder how much of a feature that's going to be in the elections through the next 12, 18 months.
Yeah, I think it's the biggest feature. You have 68% of the U.S. population that does not support the state of the U.S. economy and is very concerned about inflation and does not support the president's tariffs. So the president and his committee officials and cabinet officials are saying, give us another year. Let us bring prices down. But when voters are looking at their, grocery bill, their electricity bill, the cost of a new car, whatever they're looking at trying to buy, it's all more expensive. It's all because of the tariffs, and they know that. And they are seeing manufacturing, they are seeing grocery prices increase, but not their wages. So the president ran on, theoretically an inflation-related campaign. Inflation was high after COVID, but it remains on the upper rise today as well. And you can see that again at the grocery stores most plainly. So when we go to the polls in November of next year, that's going to be paramount. Are grocery prices high? Is it our number one issue? Or do we care about immigration or crime or healthcare or other tertiary issues? But it's really always the economy. And the president is underwater with the lowest approval ratings that he has ever had in this term or last because of the state of the economy.
Henrietta, thank you. As always, Henrietta Trace there of Vader Partners with the latest, setting up the politics not just for today, but I think for a generation in this country.
Well, and certainly this has been building for a long time, as you mentioned. This is really dated before the pandemic and then exacerbated by the pandemic and some of the policies during that. A real question here is, we can get into politics, but how much do we end up having cycles that don't adhere to actually creating solutions that are feasible to some of these issues, right? How much is it just promising people handouts versus coming up with constructive solutions that will take time, and it's a very difficult kind of quagmire.
Unfortunately, we've heard a lot of that in New York City over this campaign. Coming up on the program, Gennady Goldberg of TD Securities on the outlook for Fed rate cuts. Plus, Yahara has your morning movers. Uber shares falling on weaker than expected guidance. That stock is down by 4%. Counting it down to the opening about 2 hours away. Equities pulling back by 0.9% on the S&P. We're down by 1.2 on the Nasdaq 100. Pretty defensive posture across assets so far this Tuesday morning. Bonds a bid, yields are lower, down by 3 basis points at the front through the belly of the curve. Onto 10s, we're down about 2 basis points to 4.087%. Just some risk aversion brewing through the European session continues into the US morning.
Yeah, and ironically, you're actually getting some dollar strength on the heels of it. But what I find interesting is the risk aversion is coming on what? The idea of earnings that are really good, but maybe not as much visibility for next year. Are they coming from the fact that a couple CEOs said that they could see a 10 to 15% pullback in the next 2 years? Well, who doesn't say that, right? At what point does this just speak to this aversion of where valuations are and an excuse to maybe cash in just a little bit before other people come in and buy?
Should we finish on euro dollar?
Sure.
Just bring up the single currency. It's been such a bizarre year for euro dollar. We've had a break at 115. We're trading at 114.81. I just want to go through the first couple of quarters of the year. So for the first quarter, euro dollar was up by more than 4%. Then we had this additional move of close to 9% in the second quarter. And since then, Lisa, things have really been pretty sideways for the single currency. If anything, there's been a bias to sell it. So much of this year was defined. So much of the narrative around foreign exchange was defined by the first quarter and early into the second quarter for foreign exchange. And since then, that sell the US, sell dollar trade has lost a lot of steam.
Yeah, and a lot of the enthusiasm for all of the infrastructure spending in Germany has also lost some of its steam in terms of how much it can really edify the entire region. You've seen the weakness of Germany and France relative to Portugal and Italy and Spain and some of the other countries that are in the southern parts of Europe. So it raises a question, how much is this euro weakness and how much is this dollar strength? Right now, the Bloomberg Dollar Index is currently at its highest going back to May. So really, we're tracing a lot of the weakening that we had been seeing.
Euro dollar this morning, a 114.81. As we count you down to the opening bell, let's get you some single names, some morning movers. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. We start with Uber. Those shares are down nearly 4% in the pre-market, despite the company posting its strongest growth since 2023. Gross bookings jumped 21%, easily beating estimates, and trips soared both here in the U.S. and internationally. So why the dip? Well, the stock had jumped some 60% so far this year. Plus, Uber did highlight some legal costs that did cause a dent to profits. Meanwhile, turning to travel, we are seeing Norwegian Cruise Line holding shares down nearly 9% after the company warned that the final quarter of the year will be softer than expected. Plus, its yield growth, which is the amount of money they make from each passenger, will also be softer than expected. So some of that consumer strain showing up in these results. And we end on shares of Spotify. Those are in the green. They are up nearly 5% after posting a solid quarter. Monthly active users rose by more than expected, while revenue topped forecasts thanks to some price hikes it implemented this year. This comes as Spotify expands further into podcasts and video. It struck a deal with Netflix that will bring some of its podcasts exclusively to Netflix, but not Joe Rogan. John?
Yahara, important final point. Thank you. Spotify up by about 5%. On a radar this morning, US voters heading to polls across the country. Key races in New York City, New Jersey, and Virginia. The first major elections since President Donald Trump's victory last November. Where has 12 months gone? Just absolutely bizarre. Elsewhere, Norway's sovereign wealth fund will be voting against Tesla's proposed $1 trillion pay package for CEO Elon Musk, highlighting concern over its size and the, quote, lack of mitigation of key person risk. And finally, what are 24 hours? Alphabet selling $17.5 billion of bonds in the US after tapping Europe's debt market for 6.5 billion euros. The firm joining the likes of Oracle and Meta in utilizing multi-billion-dollar debt sales to finance AI investments.
This has been a story that we've been talking about throughout the year, and it's not just the big tech giants. And I think this is important to mention. It's easy to say, well, they're making so much cash that at a certain point you can understand why bondholders or bond buyers are thinking, okay, we can accept this risk. At the same time, it's not just them. It's a tsunami of other related tech issuance that's coming on the heels of them, of companies that might be more speculative. So here is the question. Is it really these companies that are the risk, or this proliferation of the AI trade? You say AI 3 times, everybody wants to buy your debt. And that, I think, is what a lot of people are examining with the cockroaches and the cracks and the 10 to 15% drawdown and all of the other rhetoric that we're hearing from CEOs.
One counterpoint, just one. And I'm going to use some of the things that you've often said, and Peter Cheer has as well. The risk is where the perceived safety is, right? And people always talk about the strength of the balance sheets of these particular companies as being the ultimate bastion of safety. That's why they trade within around 1 percentage point above treasuries, like the issuance we saw yesterday. So is this the one to track and not the other stuff?
It's a great point. The idea that the greatest risk is always in the debt that's perceived as the safest. A question, though, for that isn't necessarily whether these companies are going to go belly up or whether you're going to get a repeat of the telecom industry where all of a sudden AT&T bonds were trading at a very high level and then suddenly they sank dramatically because ultimately they didn't have the same kind of profit expectations going forward that they did in the past. And then all of a sudden they were downgraded with the debt and the sustainability there. So you're right, but that's not necessarily an overall bubble that's going to bust, that's going to create this total credit crisis, as much as you might lose your money, lose some money.
These companies right now are making a ton of money. And at the moment, just for an observation, there's no pushback coming from credit at all. The order book was absolutely massive yesterday. And that's the thing I'd be looking for. This is great for equity investors because this is going to be funded by the credit market. So maybe that's another feather in the bullish cap this morning. But for credit, I don't see the pushback. Do you?
I don't see any pushback. In fact, Meta's book was completely oversubscribed, something like $100 billion of offers for their $30 billion bond offering. I go back to what Bob Michael of JP Morgan Asset Management said, which is there is just so much money chasing yield, so much cash that is sloshing around from the pandemic, all the stimulus checks, all of the additional rounds of payments that are looking for something to earn some income. And that might be the biggest problem for some people because ultimately it keeps going into some of these instruments and you're going to reward behavior you might not like, but what is your other option?
This story's changed for the tech players. They used to issue a lot of debt and it was to fund capital return programs, buybacks, because they didn't want to bring the money home from abroad. That's a different kind of issuance. This is CapEx. And we talked about it yesterday. People like these companies and they came on this program for years because they were asset light and capital return heavy. That's not what these companies are going to be several years from now, based on the communication we've had from the likes of Meta in the last week.
These are going to be property owners, data center owners, energy plant owners. These are going to be building out huge infrastructure, making big bets because it is an existential threat not to. And so this is going to be increasingly a faith-based story where we all have faith in a future that looks similar to what we are extrapolating from right now, but where a lot can change.
Alphabet down this morning by close to 2%. The broader market not doing well. A lot of that driven by some of the major tech names that helped get us here. Equity futures down by about 1% on the S&P. Let's stay on the market and turn to bonds. The US 10-year yield ticking up following the Fed's October rate decision. Gennady Goldberg of TD Securities says lock in the yield. Writing, we expect 10-year bond yields to reach 390 by year-end, 350 by the end of 2026. Gennady joins us now for more. Good morning, sir.
Thanks for having me.
Why the bullish view? That glide path down to 350?
Well, a couple of things. One is we do expect the economy to moderate as we head into next year. So gradual moderation, not anything crazy, not a recession necessarily, but significant risks to both upside and downside, and we're leaning a little bit more towards the downside. Second is that wall of cash. And third, and I think this is a key point that's missed by a lot, is the Fed was a net seller, effectively, of treasuries all of the last couple of years. Starting next year, they're going to become a net buyer, whether it's through reinvesting MBS into treasury bills or doing reserve management purchases, which we now expect in the middle of 2026. They're going to be buying, call it $300 to $400 billion of treasury bills over the next couple of years each year. That's a huge bullish tailwind to the market where the treasury is already issuing at the front end.
Not QE or QE?
It's going to look, walk, talk, and quack like QE, but it's not QE, right? It is reserve management purchases. They will explain it. They will keep explaining it, unfortunately. But what we know is that it's only to keep the balance sheet at a constant portion to either bank assets or GDP, and it's to prevent a repo crunch. We are seeing some pressures at the very front end, so that could get pulled forward. Right now, our expectation is mid-2026 for those purchases. There is a risk that as we head into year-end, we might actually see some significant repo pressures, and they might be forced to pull that forward even more.
So how much is your bullish call an argument about the U.S. economy, and how much is it a bet in the 2026 Fed that has an inclination to suppress yields in whichever way?
A little bit of both. I mean, honestly, you've got the Fed quite significantly looking to cut rates. I would say, we do expect one more cut in December. So despite Powell pouring cold water on December, I still think it's a go. Next year, we expect them to switch to more quarterly cadence. So going once in March, June, and September to reach 3% terminal. And part of that's going to be driven by uncertainty on the economy. So if you've got an uncertain economy, you continue to gradually moderate policy until you get to somewhere closer to neutral, right? They don't want to over-tighten. And that's going to drive yields a little bit lower. And the closer you get there, the more likely you are for the market to kind of branch out their probability tree that more cuts could potentially be coming. So that's part of that.
I guess I'm struggling with this idea that some people are talking about caution in the economy, and other people, from Torsten Slok to Henry Allen, are talking about inflationary pressures and the fact that the economy is doing just fine. So how do you square these ideas? That early next year we're going to get the stimulus coming from some of the tax plans from President Trump, the rebates that people are expecting to get. You could get a reacceleration from more confidence around the tariff regime. You could get a lot more uncertainty. But this whole idea of a sense of reacceleration into next year, why do you push back so hard against that?
So it's going to be a fat tails type of year, right? Our base case is, whether mine or some of the other folks you were talking about, I think our base cases are fairly similar. The economy is doing okay. We think there's going to be some pressure at the very, lower tier of the consumer breakdown. Those are going to be folks, yes, they will get tax rebates, they will get more kind of relief in that sense, but we don't see enough for a full-blown reacceleration. You've got a labor market that's quite weak. You've got companies that are taking on some of this margin pressure, and it is feeding through into their margin. So look at where the inflation's coming from, right? It's going to be coming from pass-through, from goods prices. The question is it going to come from services? We think not. There are folks who think it'll be, just like COVID, where you'll get that contagion, basically, into the services sector. We don't think so. We think it'll come from goods. It'll pass through. The Fed will kind of look past it, kind of like Governor Waller's been saying, right? It's a one-time deal, this time for real, right? This time it is really transitory. But once we get through that, we should be easing to kind of take care of the softer labor market, because it is actually slowing down a little bit.
Governor Waller's not the Fed chair yet. Might be in the future. A lot of people come on this program say he should be. He's not the Fed chair. Does the heart of the committee, based on what you can see at the moment and hear, are they willing to look through that inflation hit?
I think so. I think they're cautious, right? No one's really pounding the table except for Governor Waller, and I think part of that is to potentially become Fed chair. But I do think that most of the kind of the core of the committee sees neutral at around 3%, not 3.75 or 4%. I think what you're hearing now is a little bit of a mixed message, because we're reaching into kind of the upper tiers of where folks expect neutral to be. Look at the hawks. Look at the four hawks who've spoken since since the FOMC meeting last week, all of them see neutral at around 3.50 to 4%. We're scratching into their territory. So they're saying, look, we're done. We're neutral. If you look at Powell, Waller, and some of the other core FOMC members, they're all thinking a heck of a lot lower from here. I mean, low threes, not high threes, is what they're thinking. So there's a lot more room for cuts. All they need is just that data, right? Which we've unfortunately been lacking to tell them that they should continue to cut rates.
How dovish do you think this committee is going to be in 26? Given the vote mix, the change, the new votes that we get on the committee, plus the new leadership in May and beyond. Just how much strength is that dove, that uber dove in Chairman Powell's seat actually going to have?
I think it's moderately dovish, right? Like we're expecting 3% simply because there is going to be that split. There will still be hawks on the committee. I mean, you'll have Lori Logan, you'll have Beth Hammack, both voters next year. And they'll be replacing a couple of hawks who are voting this year. So at the end of the day, you're going to have a lot of disparate voices. It's going to be, I hate to say it, data dependency. We'll have to decide. The problem with, government shutdown is you kind of have to do it on vibes and not on data. And the problem is the Fed is not very comfortable doing that.
Beth Hammack is just itching to dissent, right? You just get that feeling in every speech we get. Itching to dissent.
She just keeps reiterating the inflation concerns. And honestly, there is an argument to be made, Jeff Schmidt really also leaning into this, the idea that inflation has remained above 2% for more than 5 years. It starts to raise some concerns at a time when everybody disagrees on the labor market, considering the fact 5 people in a room, you get 25 views in the labor market.
We've got no data, at least not the official data anyway. Gennady, it's always good to see you. Thank you, sir. Gennady Goldberg there of TD Securities. If you are just joining us, welcome. Equity futures down all morning. We're down about 1% on the S&P 500. Some price action still searching for a narrative. We'll have more guests to weigh in and tell you why they think we're down this morning on the S&P and elsewhere. Let's get you an update on stories elsewhere. Here's your Bloomberg brief. Secretary of State Marco Rubio reportedly helping persuade President Donald Trump to leave NVIDIA chips out of last week's talks with China. The Wall Street Journal reporting that Rubio warns selling top-tier chips to China could pose a national security risk. Elsewhere, shares of iHeartMedia are surging in the pre-market. Sources telling us here at Bloomberg that Netflix is in talks to license video podcasts distributed by iHeart. Netflix is reportedly seeking exclusivity for the programs. That stock is up by almost 14%. And finally, Starbucks is selling a majority stake in its China unit to private equity firm Boyu Capital for $4 billion. Boyu will take up to 60% of Starbucks China retail operations through a joint venture. That's the latest in our Bloomberg brief. Up next, last-minute orders.
Companies have mitigated for the cost impact. What we have seen is that retailers have postponed their decision in making orders to the very back end of the year.
A conversation up next with Carly Kahu of Jefferies from New York City. You're watching Bloomberg TV. Live from New York City, welcome back to the program. Here are the scores so far this Tuesday morning. Equity futures negative by 1%, on the Nasdaq down by 1.3, on the Russell down by 1.25. In the bond market, a bid into treasuries, yields down across the curve, 2s out to 30s, 10s down by 2 to 4.09%, down by 2 at the front end of the curve as well, 357.79. Some pushback from some Fed hawks in yesterday's session. I think also, Lisa, coupled with the fact that we've had a ton of issuance on the credit side, and typically that kicks things around for treasuries as well.
You have heard from Lisa Cook, the first time that she's really spoken publicly. There have been some other officials that have come out and talked about the inflation risk. At the same time, that's been ongoing, right? We knew that this was the case, that there was a very split committee, that the supply, that was a big deal. The idea that you suddenly have $30 billion, $17.5 billion flooding the market. You have to think there's some competition from the tech sector.
Politics is well in focus today. It's election day in America. Can you believe it's been 12 months since the election?
I mean, it feels both like 10 years.
Where has the 12 months gone?
It's been on a hamster wheel that we're all trying to catch up with to try to understand what's going on.
Those of you that know me know that I like to put the Christmas tree up early, like really, really early, first week in November early. But this time around, first week in November feels very, very early. I can't believe we're almost there.
So what's really early for you? December 1st?
Typically, I like the first week in November. We're maybe going to push it to like middle of November. Next
True
weekend,
sign.
weekend after that.
True sign.
I don't wait for Thanksgiving.
That's just.
I like to have the decorations up at
I get
Thanksgiving.
it. It's
You know that,
beautiful.
right?
It's warm. It's festive,
Yeah.
especially with the cold air. I get it. It's lovely.
Precisely. Let's talk about holiday shopping. On the surveillance this morning, last-minute orders.
What we're seeing is that companies have mitigated for the cost impacts. Consumer demand for toys is growing, has been growing every quarter in the US and overseas. What we have seen is that retailers have postponed their decision in making orders to the very back end of the year. But seeing that there is demand, there is consumer demand, people are buying product at retailers, we expect to see a good holiday season.
So here's the latest this morning. Companies and consumers dealing with tariffs and now the government shutdown ahead of the holiday shopping season. Kylie Kohu, a consumer equity research analyst at Jefferies, writing the prolonged government shutdown appears to have been the primary catalyst driving consumer sentiment to a new post-election low. Kylie joins us now for more. Kylie, good morning.
Good morning. Thank you for having me.
Thank you for being here. Just frame the state of play for retail America going into year end.
Well, it's a big question mark, right? So what we're seeing is the consumer seems bifurcated overall. We have the lower income consumer who's clearly being hurt, and the recent SNAP benefits that may or may not be coming is a big question mark. Then you have the higher income customers. They seem to be doing pretty well, but the question is, how much are they going to spend on some of these goods that are really increasing in price due to tariffs as we head into the holiday season?
You heard the Mattel CEO. He's trying to work out whether people are going to buy and stock the shelves. Is that going to happen?
Well, right now the shelves in the toy aisles themselves look pretty well stocked. I wouldn't say that they're overflowing like we saw last year, so that is going to be a headwind to toy sales that we've seen in Q3. Now the question is this demand going to show up in Q4, and then will that flow through to the toy companies closer to the actual holiday?
It's surprising how little visibility even the CEOs have about just how much people are going to turn out and how much pricing power they have. What's the strategy that you're hearing from chief executive officers in terms of how much they're increasing prices, how much they expect consumers to absorb some of the tariff increases versus just accepting margin pressure?
Yeah, so overall what we're seeing is everyone's eating a little bit of the tariff, right? So you're seeing that both with the toy companies, you're seeing that with their suppliers, you might even see it with some of the retailers, and then ultimately what's left over is being passed on to the customer. How they're doing that, a lot of them are describing it as very surgical, right? So it's these items that are going to be the hottest toys with the latest releases, things like that, while keeping these core items under that sweet $20 price point.
So in other words, if you have popularity, use it, and you're going to be paying $2,500 for something, and then otherwise things will be discounted. Are there companies that are doing a better job of that than others, right? I mean, is this sort of a tale of two consumer retail companies, or is this pretty broad-based? Is this sort of the accepted practice?
Unfortunately, it's pretty broad-based. So we like both Mattel and Hasbro heading into the holiday season for different-ish reasons, right? Hasbro has that adult consumer that continues to buy, continuing to show up. Mattel, we really like the actual products, the Wicked dolls, the Jurassic Worlds, things like that. They're going to resonate well with the kids themselves. So overall, we like it. It's just a matter of, again, are these people going to buy into this holiday?
What are you learning from other industries? Do you follow the restaurant business, for instance? We've been talking about Chipotle loads and trying to figure out if that's a Chipotle problem or a broader issue with the economy. They've cited a younger demographic who aren't spending as much. Anyone who earns under $100K a year is struggling in this country based on their communication. Do you see that as a single issue at a single company, or are you seeing that across the companies you cover too?
I mean, really, we're seeing it across consumer, right? So just about any consumer, whether it is the really low end, the mid, or the high end, no matter what, we're seeing them become more choiceful. Now, how choiceful they're becoming really kind of does depend on that, all those kind of buckets, right? But no, unfortunately, we're having to trade out of, eating out, and then you're going to trade into eating at home. Same thing with kind of how the holiday shows up. People are going to buy toys for their kids. That's not necessarily the question. The question is, what are they going to buy and at what price points?
Fed's tracking the same thing. What is the consumer price tolerance right now? Which is why the governor Mara into this world are more concerned about labour than they are inflation, because they don't think you can pass this on in quite the same way as we saw coming out of the pandemic.
Yeah, and really, it's sort of frustrating because we're looking for the answer, right? Is the consumer strong or is it weak? Are we going to see that sort of a real clarity moment in this December when we have people going out and spending and accepting the price increases or not? And it's the same nuanced story that is so unsatisfying. I'm sorry, I don't mean to be complaining about this, but Kylie illustrated it. You know, they're doing it on the margins, they're being surgical, they're being smart about it. So there are price increases here, but not necessarily here, and some consumers are being choiceful. And it's not a story you could really be satisfied with because it doesn't give you a sense of what the policy mix really should be going forward. I am sorry for the rant, but it feels like this is going to be the ongoing story.
Kylie enjoyed it. Lisa did it on your behalf.
Yes. You agree, right? I mean, how do you have any conviction on anything?
Exactly. And I think that is the big question mark, right? I keep kind of saying that, but, you know, I keep telling my clients, I'm like, well, what are you seeing in the consumer? And then let's kind of build a framework from there. What we're seeing in the consumer is, yes, there is confusion. And to the point at the top of the segment here, you know, is this just the government shutdown? Are people just confused about that? And could this clear up in the next week? I don't know.
Kylie, I've got no idea how long the government shutdown goes on for. Might go beyond the next week. Kylie, thank you. It's good to see you. Kylie Gohu there of Jefferies on retailers in America. Up next, we'll catch up with Mira Pandit of JP Morgan Asset Management, Kathy Boshansik of Nationwide, alongside Bloomberg's Mandeep Singh and Michael Ball. From New York City this morning, good morning. The third hour of Bloomberg Surveillance up next.
The AI story is so dominant right now.
The market is punishing anybody who decides not to play in AI.
AI is going to be a defining trend probably for the next 5, 10, 20 years.
You have to own a little bit of everything, not just tech. Earnings growth is going to be better next year than people expect. Right now, I think it's, we're in pretty good position.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Pulling back from close to all-time highs on the S&P 500. We're down across the board, down by 1% on the S&P, negative by 1.4 on the NASDAQ. In the bond market, a rally. Yields are down across the curve. On a 2-year, we're down by 3. On a 10-year, we're down by close to 2, 4.09%. Going into all of this in the week ahead. Lots of economic data. ADP, ISM services, a sprinkle of earnings with AMD just around the corner as well. And we should not forget, it is election day here in New York City and beyond, Virginia and New Jersey.
Yeah, possibly a national referendum or possibly just local issues that are coming to the fore. A real question here for New York City for the fight for the Democratic Party, although ironically it's a fight between a socialist Democrat and an independent. But nonetheless, there is a real question here about whether this is representative of a larger question. I do think it will be very interesting in this mini midterm to see how much President Trump looms large and how much it's a referendum on some of the recent policies and whether that really plays into reopening the government or any of the potential policies.
Certainly loomed large yesterday, didn't it?
He did.
Wasn't that strange? Governor Cuomo, former Governor Cuomo, talking about standing up to the president and then the president coming out and endorsing him.
I mean, thank you, but at a certain point, you have to wonder whether it was a welcome endorsement, right? Because it gave Zoran Mamdani an easy way of saying, well, of course he wants him to win. He's going to be the one that's better for his policies. And then, of course, Andrew Cuomo is saying, well, we're going to at least be able to stand up to him because he wants us to be there and then he'll give us funding. I mean, it's very awkward. This really highlights how awkward it is for President Trump to be involved in this at a time where it is the key reason the Democrats have to have any unity whatsoever. Other than that, what do they have? And I think that's been one of the challenges. What is the more proactive message versus just, we're not Trump?
That's the politics for New York City and beyond, and we'll have more on the beyond later on this hour. Need to talk about this market too. Palantir came out with earnings after the closing bell. Earnings were okay. Stocks down on otherwise pretty decent news. Taking a broader market with it, we've had complaints, pushback from certain CEOs on Wall Street as well. We heard from Morgan Stanley, from Goldman Sachs, from others too. really pointing out the obvious. The valuations are stretched, valuations are full, the rally's sort of long in the tooth, and we've heard this a million times from a million different people.
And the Palantir earnings really highlight just how much these worries are coming to fruition. Give your narrative whatever you want for today's blip. But the fact that these shares are up 150% so far this year is the reason why they're down 7.5% right now after reporting earnings, the 21st consecutive beat, and going out and talking about Alex Karp, the CEO, saying we are in a nosebleed zone. No one else is here. Everyone coming out and saying, this is amazing. You have a company that's $4 billion in revenues and they are posting 63% growth. Oh my goodness, this is a moonshot. And yet the shares are down because they didn't give enough guidance about how much of a moonshot it was going to be next year. This just highlights people are getting nervous. They're taking some chips off the table. I don't know how much we can extrapolate out beyond
Let's
this.
take a step back. How difficult is it to construct a super bearish argument right now, given the limited pushback that we're seeing in places like corporate credit? When these companies come out and issue the kind of debt they have, Meta last week, Alphabet in the last 24 hours, and the order book is loaded up to the extent that it was. How difficult is it to sit here and say, yeah, we're on the precipice of something really bad happening with the credit market just sucking it all up right now?
Very difficult, which is why every dip has been bought. I think the bigger question is, will there be a deep-seek moment where some of the big build out in infrastructure gets called into question, akin to back in the 1950s when computers came out and there was an entire room the size of this room that was needed to house a computer, and now we have it on our phones. So this is sort of some of the discussion, but we're not there yet. The demand is just still so outpacing supply.
At these levels, I get it. Our capacity to absorb bad news is somewhat limited. We've pulled back by about 1% on the S&P 500. Coming up this hour, we'll be catching up with Mandeep Singh of Bloomberg Intelligence. As AI bubble concerns continue to grow, we'll speak to Mira Pandit of JP Morgan Asset Management, with stocks pulling back from all-time highs, and Kathy Boszczanczyk of Nationwide as traders turn to private data for rate cut clarity. We begin this hour with stocks falling as Palantir's earnings, despite an increased revenue outlook, failed to meet Wall Street's lofty expectations, fueling concerns that the stock might be overvalued. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, welcome to the program, sir. Stock is down, and down hard. Is that validated? Is that move justified by the numbers you heard yesterday?
I mean, look, it was a nice beat and raise quarter, but right now I would compare Palantir to someone like OpenAI, which is also valued at, $500 billion in market cap in private market. And when I look at the growth trajectory of OpenAI, I mean, look, that company is almost, 13 billion plus in ARR. Palantir is more like 4 to 5 billion in revenue. So from that perspective, why is OpenAI not valued higher than Palantir? And that question comes up. Even though Palantir's growth is stellar and the quarter was great, but it's just not growing as fast as an OpenAI or Anthropic is. And so that's why I think you're seeing this kind of a stock reaction this morning.
Mandeep, we were just speaking moments ago. Lisa was talking about it, the lack of pushback in credit. We have had a little bit of pushback in equity in the past week. We saw that with Meta. We've seen it again with Palantir. Is there a broader story beginning to build in the equity market?
Well, I think the ROI question is getting asked more and more. And so what this earnings showed us was the hyperscalers that were not showing clear ROI, notably Meta. I think that's where you saw a negative stock reaction. The other ones, Alphabet, Amazon, Microsoft. Microsoft, I think, was more of kind of a reflection of the whole OpenAI situation right now. But overall, I think the hyperscalers with public cloud revenue did get rewarded in terms of positive stock reaction. So to my mind, the ROI question is front and center, and companies that are showing ROI and valuation is not stretched, you are still seeing upside to estimates and valuation.
Mandeep, thank you, sir. Mandeep Singh there of Bloomberg Intelligence. Palantir down in the pre-market by about 7%. For the broader market, Mira Pandit of JP Morgan Asset Management writes the following: AI is not a bubble, it's not a boom, it's a boom and bust. Tech drives sweeping secular trends and structural change, but it's also inherently cyclical. Mira joins us now for more. Mira, good morning.
Good morning.
Where are we in that so-called cycle?
I think we're sort of mid-cycle still. We've seen some of the heady increase from 2023 and 2024 in terms of the build up to this technology. But what we should remember is when we see any sort of innovation, yes, it can lead to a secular bull market within that theme, but there's going to be some fits and starts. We saw in January pullback. We saw in April a pullback there. If we looked back to 2022 before a lot of this AI really took off, even within the Mag 7, you saw the maximum drawdown that year in that cohort of companies of about 43%. So investors should still expect that there can be some volatility within this theme, even if the overall trend is to move higher. Because these are cyclical assets, as you guys have talked about here, we've moved from a very capital light industry to something more capital heavy. And there is a chip cycle, there is a CapEx cycle. I do think that these companies will be subject to the ebbs and flows of those types of cycles over the arc of time.
How do you understand when we're reaching the limits of valuation? Because that's ultimately what the market seems to be questioning this morning.
It's a question that's not only around the AI stocks, it's for the broader market, and we do find some justification for the higher valuations that we're seeing. But ultimately, when you look at the bull case for some of these AI stocks, you're still seeing that revenue production. You're still seeing that overall leverage is low. Yes, some of these companies are increasingly tapping the bond markets, but that is smart capital allocation. When you think about if you were a home buyer, you may not buy your house in all cash, even if you had the wherewithal to do so. That financing still does make sense in this environment. You think about the demand that is there and the demand that is being monetized. So I do think that you're getting what you're paying for at this stage. It's just important to watch, how does adoption evolve in some of these AI applications? Are people paying for them? Are people using them to make poems and memes? Or are they actually using them for business purposes and enterprise purposes? Again, are they being paid? Are they being used in the right way? Are they gaining that traction? Is there any drop off in adoption? Because some of these companies may be very cash rich, but not all of their buyers are. We have to think about the power limitations. We have to think about that circularity of deals. Is this a game of dominoes where if somebody falls down, everybody else does? Or is it a game of musical chairs where if somebody doesn't get the chair, everybody else is still okay? So a lot of considerations within this theme, but overall, we still do feel confident at the stage we're in coming out of earnings season where we've seen what we've seen from some of these companies.
To be fair, some people think that poems and memes are work, and that actually could be the way that we all put our analyst notes out in our discussions.
AI for poems? What's going on here? Where's this
Roses
come
are
from?
red, violets are blue.
Oh, it's that kind of thing.
Yeah, we're
okay.
so happy. We hope you are too. I'm just curious.
Sorry, I've cut in. All right.
No, but I agree. I mean, I don't know that anyone's using it for their poetry, although I do know that my oldest son is in a poetry class, so I can't promise that he is not using it for his poetry. I am curious, though, at what point do you see warning signs versus doubling down and seeing a sell-off and saying, okay, I need to buy more?
I think the market reaction right now is actually reasonably healthy, because when you think about the earnings that were produced, they were still overall pretty good across the board. And you actually continuously over the last 3 quarters have seen earnings surprises for the Mag 7 as a cohort above 10%. So very elevated levels of surprise. And yet the market is still being somewhat punishing where the guidance doesn't look as strong as it could. So you do see that the market, while it continues to rise and it continues to rally around AI, increasingly where the investment is going from the average investor is actually to some of the broader AI themes. It's not just the AI innovators, it's the enablers. When we think about things like industrials and utilities, look at some of the growth rates this quarter in terms of earnings on utilities, which used to be a pretty sleepy sector, but you're seeing 20% growth rate in earnings in that sector. So you're seeing that broadening out. Again, I think that the area that we'd watch for most is, can you get to the AI adopters? And what are people willing to pay? Are they adopting at increasing rates? That is the question mark. And I think that's where some of the broader concerns that may not be within the AI companies could extend out. And it maybe won't be a credit issue, but if we do see a slower economy at some point and people are pulling back on what they're planning to spend on their AI, then that could be a sign that things have been overbuilt for a time period. Again, these are cyclical. You can see a downswing. You can also potentially see an upswing. But right now, when we look at that earnings contribution from the Mag 7 that have reported so far, they make up 4 of the strongest upside contributors from a company perspective, but also one of the weakest. So that bifurcation, I do think, is a healthy sign that investors are responding accordingly.
It sounds like at the moment you've got a lot of the clarity that you need, even without the official economic data. Are there any blind spots for you at the moment?
Certainly, we would like to see what that economic data is showing, because as I think it relates to the rates picture, there's a lot of question marks. I don't know that the rates picture flows in as neatly into the AI story, because it is pretty rate insensitive given how some of that is being financed. But if you then move over to the macro picture and you think about the Fed and how they're making decisions, this tug of war that we're still in between hotter inflation, weaker jobs is a huge outstanding question. And you could say, well, maybe the data is not showing anything new underneath the surface, but that wasn't the case this summer, where we saw meaningfully weaker demand for labor and didn't really see it coming, or it was also not the case with inflation, where we expected to see more of a bigger pickup from tariffs, and yet you've seen core goods in a reasonable spot, maybe some hot spots like apparel, but overall not a huge pass-through effect. So I think understanding on the margin where some of those issues are would be incredibly helpful for us as investors as we think about the rate environment.
That debate's not going to be resolved by year end because we don't have the economic data. And based on the division at the Federal Reserve, I'm not sure that 2 payrolls reports, even if we get them, are going to change many people's minds.
Yeah, the problem is it's not just that we don't have data. We don't have a reaction function. Right now, can anyone describe what exactly this Fed committee is looking at that will determine what exactly will make the difference between a rate cut and not? And I don't think anyone has a good answer.
They're all looking at different things at the moment. Mira, you're going to stick with us, I'm pleased to say. Mira Pandit at JP Morgan Asset Management. If you're just joining us, welcome back to the programme. Equity futures at the moment on the S&P 500 negative. We're down by about 1%. That's the price action. Let's get you an update on stories worldwide. Here's your Bloomberg brief. We start with the government shutdown in its 35th day. One area that's been hard hit, air travel. According to trade group Airlines for America, more than 3 million passengers have faced cancellations and delays related to staffing since the shutdown started. Elsewhere, Spotify shares rising in the pre-market. The company reporting monthly active users grew 11% year over year in the third quarter. Spotify's 713 million active users and 7% revenue increase beat analyst expectations. That stock is up by close to 6%. And finally, shares of Uber falling in early trading. The ride-sharing gap posting its strongest quarterly growth since late 23, while also delivering a beat on gross bookings. Uber also announcing it will change how the company reports profitability starting next year. That stock is down by 4.5%. Up next on the programme, the Morning Calls, plus an update on the race for New Jersey governor as Election Day heats up. That conversation just around the corner.
Of course, it is likely there'll be, a 10 to 20% drawdown in equity markets sometime in the next 12 to 24 months.
On the near-term valuation side, there's some challenges.
We should also welcome the possibility that there would be drawdowns, 10 to 15% drawdowns that are not driven by some sort of macro cliff effect.
Can we call this pushback, or just sort of stating the obvious that you get a 10 to 20% drawdown sometimes?
I'm actually laughing because I'm thinking people are using that discussion as justification for what we're seeing this morning.
Yeah, no.
Yeah, thank you. I think that sums it up.
I'm right there with you. I'm struggling with it too. Here's the price action, and we've said all morning, price action struggling for a narrative so far. We're down about 1% on the S&P 500. On the Nasdaq 100, down by 1.4. Similar move on the Russell. We're down by 1.3. That's the price action into the opening bell. Let's get you some morning calls with one stock in focus, Palantir. First up, Bank of America raising its price target on the stock to $255, saying it has, quote, a winning differentiated formula. Elsewhere, Mizuho raising its price target on Palantir to $205, expecting it to benefit from long-term AI trends. And finally, Jefferies also raising its price target, citing strong fundamentals, but seeing an unfavorable risk-reward. So we've got a stock that's down hard in the pre-market, and the analysts are basically boosting their price targets on the stock.
Because ultimately what Alex Karp talked about was this nosebleed moment and the fact that you're seeing really rapid growth. So either people don't want to bet against it because it's career risk, or there is some sort of dissonance with concern about valuations where they are versus the analysis community that sees a real upside.
Stock is down by 6 to 7% through most of this morning. Broader market at the index level on the S&P 500 negative by about 1%. Let's turn back to the politics and the elections. The New Jersey gubernatorial race between Democratic Representative Mickey Sherrill and Republican Mike Ciattarelli is tightening. Bloomberg's Romain Bostick, charged with following the story throughout this morning and into the afternoon, joins us now from New Jersey. Romain, what's at stake in New Jersey today?
What's at stake is really a referendum to a certain extent on the national political climate. John, here in the United States, election cycles are every 4 and 2 years. These off-year election cycles, like the one we're in right now, typically aren't all that notable. But this one's different. We're 1 year removed from one of the most controversial U.S. elections in history and 1 year ahead of what could be even a more controversial midterm election. And that puts a governor's race like the one here in New Jersey highly in focus. Jack Ciattarelli, he's a Republican candidate. He's run twice before and lost, but each time he's picked up ground here, and so too have Republicans. Remember, this is a heavily Democratic state, at least in terms of the way it votes, John, but not necessarily in terms of the actual registered voters. This is a state where independents outnumber Republicans by a significant margin and pretty much keep sway with Democrats on pace, about 38% to 35%. And those folks are the ones that are going to decide this elections. Those are the folks that Jack Ciattarelli has been courting, and so too has Mikey Sherrill. And now Sherrill's lead, a commanding lead that she had just a few weeks ago, 10 plus percentage points, that is now narrowed considerably. The most recent polls, John, now showing that she has a lead in some cases of as little as 3 to 5 percentage points.
Remain 12 months since the national general election, and you helped lead our coverage, our swing state coverage, just 12 months ago. Do you get the sense that this race in New Jersey actually takes the temperature of the mood of this country, or is it specific to this state?
A little bit of both, John. It's hard to say. When you talk to people here, they say that, yes, this is basically a centrist state, and maybe it will give us a little bit of a sense as to whether this nation will continue to move to the right or maybe swing a little bit back towards the center. The president of the United States, Donald Trump, and his surrogates, they seem to feel that they can actually turn what has been a blue state for at least the last 3 to 4 decades into a red state. Remember, John, in the last election, Trump really narrowed his support here in this state. He lost to Biden 4 years ago by 16 percentage points. He only lost to Harris by 5 percentage points. So the Republican Party actually thinks that they have a chance to actually flip this state, not only at the governor's level, but maybe potentially come in about 3 years' time in the next presidential election cycle.
Remain looking forward to your coverage. Thank you, sir. Remain Bostic on the ground over in New Jersey. He'll be tracking that race throughout today on Bloomberg TV and on Bloomberg Radio. Affordability, Lisa. I've seen some of the campaign ads from both sides, and a lot of this comes down to affordability. We've seen the same thing in New York City. That is a national issue right now. In fact, for a lot of the West, including Europe, it's an international issue.
It's the economy, stupid. Again and again, this is a reason why there's been such a focus on housing from the administration. This is why people are talking about the grocery stores. A question here about what approach is going to actually win out and what that means for how politics are going to be colored going forward, because ultimately it's just a disagreement on how to solve the problem, not necessarily what the problem is.
Mira Pandit at JP Morgan Asset Management still with us. Mira, let's talk about this economy and what it means for this market. We've got a K-shaped economy. We've got a K-shaped market as well. That's fueling the politics that Remain and the team were just talking about throughout the most of this morning. For you, does that matter? Is that a feature or a bug of the equity market? We can park the inequality, the politics, let the politicians take care of that. For the equity market, is that necessarily problematic?
It's not necessarily problematic for the equity market. Of course, it is more problematic for the overall economy. But I think from an equity market perspective, we tend to see that investors are upper income, upper wealth, and so some of that wealth effect is certainly accruing there. But equally, you still see that it impacts people in the long term at every income level when you think about pension funds, retirement. And the structure of the equity market has also changed over time in the fact that we do see more passive flows, 401k flows, and the retail investor becoming such a more prominent market participant. So to the extent that some of the lower parts of the K are involved in that market, it's helpful, but it's really more of an economic question than it is a market one when we think about what can continue to drive the market higher.
At the same time, there's a real question about whether you can get a broadening out in the overall market performance if you don't get a broadening out with the overall economy. We were talking to Torsten Slok earlier about a K-shaped market in tandem with a K-shaped economy. At what point do you think a rate cut is needed to get that broadening out, or do you see it happening or expect it to happen even without it?
We are seeing some degree of broadening out. So if I look at the best 50 performing stocks in the S&P 500, you can see that 9 out of the 11 sectors are represented. And of those best 50 stocks, only 2 are Mag 7 right now. And last week, or about 2 weeks ago, none of them were Mag 7. It's really been a result of earnings that have boosted them back into those top 50, which I think is a good thing because they've earned their way back into that cohort. But the biggest is clearly not the best right now. However, the concentration issue there is less about Mag 7, non-Mag 7. It's about the AI theme, because you still do have a sort of K-shaped market in that the AI stocks and beneficiaries, whether they're in tech or not, because you see them in industrials and utilities coming into the fold, are the ones benefiting over the rest of the market. So I do think as investors, we need to look for opportunities outside of that. And one of the biggest ones I've seen coming out of earnings season is within financials. It's been an area over the last couple of weeks and months that has softened a bit. And yet, if you look at the fundamentals there, if you look at that increase in S&P 500 earnings over the course of this quarter and that growth, the largest contributor in terms of sector is financials. All 5 of those subsectors are seeing double-digit earnings growth. And when you think about some of the broader drivers, macro environment still at a high level is okay. Look, financials are exposed to that lower income consumer because they do offer debt. So if they're getting a decent read right now and are not so worried about loan losses, that's a good sign. And then what you're seeing from a deregulation standpoint is you maybe don't see these sweeping proclamations of deregulation like you've seen in other areas of policy. But that passive deregulation, when companies feel more comfortable about the regulatory environment, certainly does seem to be helping.
Best performing stock on the S&P this year, Robinhood. Doesn't that speak to the moment?
Yeah, the Robinhood and sort of the meme stock trend and how much that's driven all volumes.
Mira Pandit, thank you. It's good to see you, as always. Mira Pandit at JP Morgan Asset Management. There's another man looking to take from the rich and give to the poor. It's the main event a little bit later in New York City. You didn't like that, Bramo?
I think it's,
no.
Isn't
that the moment? That's what I was trying to speak to.
Yeah,
like,
I think
Robinhood,
that's good. I think that that's,
Okay.
I don't know. Yeah, maybe he would embrace that.
That's what I was trying to get at.
I think that's
Tried and
clever.
failed. I'm sorry.
I think that's
All right,
good.
we're going to move on from New York. You're watching Bloomberg TV. This move is sticking, at least for now. We're down by more than 1% on the S&P, down 1.5 on the Nasdaq, down by 1.4 on the Russell. The opening bell about 60 minutes away. In the bond market, shaping up as follows: 2s, 10s and 30s. 2s at 358. Very defensive this morning. Yields down by 2 basis points on 2s, down by 1 basis point on 10s, on 30s. Just about stable. This came from Andrew Hollenhorst of Citi just moments ago. Send in the doves, where Hammock, Schmidt and Logan are more concerned about upside risk to inflation. Daly and Cook are more focused on downside risk to employment. Throw in Myron as well. This committee is as split as it's ever been.
And right now, Fed Chair Jay Powell is not exactly controlling the message when it comes to giving some unity to all of them. So that's why we keep talking about what's the reaction function. We don't have data. We don't have a reaction function concept from the Federal Reserve. So people are looking beyond 2026 and saying we will have a reaction function then, and it will be very different than trying to parse all the differentials here in this particular committee.
I've got a little bit of sympathy for Chairman Powell right now. It's difficult to reflect a consensus that does not exist on the committee, 1 and 2. As Bob Michael at JP Morgan put it, we know he's a lame duck Fed chair going into May, and we know there's going to be a change at the top of the committee.
Honestly, it's clever that he said we're in a foggy street, so we might as well drive a little more slowly. I mean, when you're in doubt, just, delay. And that seems to be what they're doing right now.
December is not a foregone conclusion. Far from it. It was scripted. It was repeated. It was heavy in intention. And you get the feeling he wanted that to be the headline in the news conference last week.
He wanted to push back. He wanted to inject some uncertainty into the market pricing, which had been an incredibly high chance of a rate cut in December. When you take a step back, it raises a question about what this committee is looking at the labor market, how much they're looking at actual weakness, how much they're finding it in the actual numbers versus the unemployment rate, and whether they actually care about inflation. Beth Hammock, yes. Lori Logan, yes. Some others, not so much. They're saying it's going down, and that is the direction that will keep on heading.
That headline from Chairman Powell was the most accurate thing he said in that news conference, given everything we've heard since then. December is a far gone conclusion. Far from a far gone conclusion. Right now, we're negative by about 1% on the S&P 500. Let's get you an update on single names. Your morning movers with Yahara Anand. Hey, Yahara.
Hi, John. We are seeing shares of Hertz soaring 22% in the pre-market after a big turnaround quarter for the company as it returns to profitability. Adjusted EPS coming in at 12 cents a share, handily beating the 3 cents expected. The company says its fleet refresh and a back-to-basics strategy helped get more cars on the road than ever. Remember, Hertz struggled significantly as it overestimated how many people wanted to take EVs on road trips. Moving on to another transportation name, Uber. Those shares falling 8.4% in the pre-market despite posting their strongest growth since 2023. Gross bookings jumping 21%, handily beating estimates. So why the dip? Well, expectations were high with the stock up 60% year to date. Plus, Uber did highlight some legal costs that put a dent on profits. And we end on Norwegian Cruise Line Holdings. Those shares also down more than 8% in the pre-market after the company warned the final quarter of the year will be softer than expected and that its yield growth, so the amount of money that it makes per passenger, will also be softer than expected. So another sign of consumer strain showing up in earnings results. John?
Or just improving taste. One or the other. Yahara, thank you. You don't have to comment on that. You know how I feel about cruises. Foregone conclusion. I can speak now. Far from a foregone conclusion. Anyway, let's turn to the Federal Reserve. Governor Lisa Cook giving her first policy speech since President Donald Trump tried to remove her from office back in August. Bloomberg's Mike McKee joins us now for more. Mike, give us a summary of the communication we've had from the Federal Reserve in the last 24 hours.
Well, it's a little more than 24 hours, John, because we go back to Friday when the blackout lifted. We have had a number of Fed officials giving their spin on what happened at the October meeting. And we've put together, in honor of Election Day, a sort of political poll of what Fed officials are thinking about right now. You've got 3 who are voting pause, 3 who are undecided, and of course, 1 who we know is going to want to cut no matter what. You're right about Lisa Cook. She made her first remarks since the president started going after her job yesterday, and we put her in the undecided category, even though you might make the case that she's leaning towards hold, because she says, I see the current policy rate as remaining modestly restrictive, which is appropriate given that inflation remains somewhat above our 2% target. What she did not talk about, of course, was her legal case. She thanked people for their concern, but said because it's an ongoing legal case, I'm not going to talk more about it. We do have a number of Fed officials speaking the rest of this week. We'll be able to fill out more of that survey, although I do want to ask why people on Wall Street care so much right now, given the fact that we're more than a month away from the next Fed meeting. And if we do get a government shutdown ending, we're going to get an awful lot of data between now and December 10th, and a lot of people could change their minds.
Mike, how reliable would that data be? Given data collection issues, you know this better than most. Can you just describe the process to collect the data from the previous few months?
Well, of course, it depends on the data that you're collecting. The September data is pretty much all in, and so we should get September data relatively quickly, including the jobs report. The issue is going to be in the jobs report and the inflation numbers for October. Inflation in particular, because BLS officials, workers were not able to go out and collect the prices that they normally get. They can get a certain percentage of them via the internet, and so they may be able to put out a somewhat truncated CPI report. The jobs report, we can get the number of people who are on payrolls. That most of that comes in electronically. It's the unemployment report, which is a telephone survey, which could be a bit of a problem. So we're not exactly sure when we would get anything from October and how valid it's going to be.
Mike McKee, thank you, sir. Tracking the Fed speak from the committee following that decision last week to cut interest rates, but plenty of debate by whether we should have cut at all or should have cut more. Kathy Boshansik of Nationwide writing, we maintain our forecast for an additional 25 basis point rate cut at the December meeting. However, given the deepening split within the FOMC, it looks to be a closer call. Kathy joins us now for more. Kathy, good morning.
Good morning, Jeff.
That word, you're precise, more precise than me, deepening. Things are getting worse. You actually think they're becoming more divided on the committee, not less?
Oh, absolutely. And it's been a progression. You've seen that, right? And it makes sense as you start to decide, how many more rate cuts you get to neutral, and do you even eventually need to get accommodative? The first rate cuts are easy, and then it gets more difficult. But this is, I think, the most divided Fed I can recall, frankly, at a really pivotal time, at the same time. And we lack the data, as you mentioned. So it makes it even more difficult, I think, for them to gain a consensus on the committee.
You could make an argument it's not just a political division, that this really is a division about what's going on in the economy. You talk about a deepening strain in the labor market. Other people say it's actually reaccelerating and it's poised to reaccelerate further at the beginning of next year. How do you gauge the depth of the weakening that some people are saying is a reason for the Fed to be cutting interest rates?
Yeah, so I think, it comes down to two things. I think one, it's the employment and the inflation picture, right? Do you think inflation the increase is going to be temporary? And I think also the degree of that. So far, it's been moderate. And then on the labor market side, are things really softening to a degree that warrants, further rate cuts? And we think so. And it's not just a supply story. You're seeing it on the demand side. And that means it's more cyclical. And we saw this even before, the most recent rate cuts and before AI really came onto the scene in a big way, right? We were seeing that the cyclical parts of the economy were not hiring in a very big way. So I think that's the concern. And I think policy has been restrictive this whole time. And we're just not as worried. Inflation's something to watch, but we're not worried that this is the start of a new inflation cycle.
How do you reconcile the fact that you see it as a restrictive monetary policy from the Federal Reserve? How do you pair that with the financial conditions that we're seeing, which is record highs, not today, and a very open credit market? How do those two stories square?
Yeah, so one of the things I think has really been interesting is Fed Governor Waller has spoken about a difference between overall financial conditions and financial conditions for the consumer or everyday Americans. And we're building that indicator just because he mentioned it. And I think it really is worthwhile. If you look at auto loan rates, right, or mortgage rates, the fact that the Fed is far from a foregone conclusion, yields backed up. So that means auto loan rates went higher, mortgage rates move a bit higher, and other consumer rates. So yes, credit conditions, bond spreads are narrow. The equity market is soaring overall. That doesn't mean that borrowing rates for the average consumer is low, and their financial conditions, I think, are tight right now.
Kathy, can we address something Lisa's asked quite often? How much influence do they have over Main Street borrowing and those kind of indicators, those kind of measures?
Well, not directly, right? Of course, they directly impact the Fed funds rate and then maybe influence rates directly out through 2-year yields. But it does feed through, right? And it's a series of rate cuts. It's not just do they move today or in December. It's more about the trajectory. And I think they have influenced. We have seen 5-year note yields come down, 7-year. That's where auto loan rates are based off of. And so I think it is important that they look at that as well and consider that when they're debating.
You've identified another split because on the committee, we saw from the Kansas City Fed President Schmidt, he came out and gave a big statement. And in that statement, basically identified financial conditions, the one that Lisa looks at, as being problematic and saying there's no sign that things are too tight. Governor Waller saying something completely different. Governor Waller also coming on this program, he sat in your chair, in your seat, and he said, I don't think that's my mandate. That's not the dual mandate. We shouldn't be focused on those financial conditions, whether equity markets are at record highs or credit spreads are super tight. Do different officials interpret that mandate differently?
Well, it's appearing that's the case more so. I mean, because it used to be, and I think really Fed Governor makes a good point. I think it used to be that you would look at overall financial conditions. And I think it's not just members of the committee, but I think in general, economists were looking at that. But I think when you look at, the bifurcation, the K-shaped economy, you're seeing that in financial conditions right now, too. And when they suggest they're not going to cut rates, we saw the backup in yields immediately.
So will 25 basis points a rate cut actually help consumers that much? Or will it just inflate a bubble that you're seeing or inflate whatever you want to call it, elevated valuations in the rest of the market, right? Does it actually help narrow or widen the K?
So in my view is it does help. And again, it's not just the 25, let's say they go in December, but if we get further rate cuts next year, it's again, if you go out along the maturities, the 5-year, the 7-year, 10-year, they're pricing in future Fed policy, right? So that path, that does have a big importance. I think what's happening in the equity market, I think a lot of it's driven by AI, right, and tech. I don't think it has anything to do with interest rates, or very little. There's this euphoria that's taken over the equity market.
So, John, let me get this straight. We don't know the reaction function from the Fed.
No.
Not getting data, not understanding exactly what the mandate is of the Fed, and we don't know what the Fed is going to look like next year. Just want to make this straight. So we're trying to game out Fed policy, and there really is not a lot of guidance here.
I think you're describing a leadership vacuum.
Thank you. That's probably a more concise way of saying it.
It's the one criticism that people might have for Chairman Powell right now. In fact, Bob Michael of JP Morgan alluded to that last week, that the division you're seeing on the committee, the fractured news conference we got, all the Fed speak you're hearing right now, for Bob, he believes that's a sign of a Fed chair that's lost his grip on this committee.
Yeah, and on some level, part of that is by design because he is a lame duck. But at what point does that raise the possibility of a policy mistake?
Well, I agree with you. I think he has lost some control of the committee, and he is somewhat of a lame duck. So you're looking ahead to next year, who fills his seat, right? And what's the other composition? And how does the data play? I mean, I think at the end of the day, the data is going to really call the tune. We do need the government to reopen. In the meantime, we do have private sector data, and I think that is useful. It's not the gold standard, but it's useful. But I think at the end of the day, we'll see what the data tell us. That will clear up things greatly.
Look, we hope, because we've been looking at a low churn labour market for years now, not months, and I think it's to state the obvious that this cuts one way or the other, but it's difficult to know which way this breaks. We have equity investors on the programme who believe the worst of it is behind us and 2026 is going to deliver a re-acceleration. If that's the case, half the committee is going to look really, really stupid. And if they're wrong, the other half is going to look really, really stupid. And in about 12 months' time, we'll look back and say it was all so obvious 12 months ago. How did they get it so wrong?
To me, the message is going to be, it's not obvious. This is the biggest muddle I've ever seen. And frankly, I think a lot of people are trying to come up with some conviction. Their conviction is to trade around the margins. So if there's enough of a dip here, do the technical buying here, because there is such a lack of clarity over which way this labour market is going to break.
Kathy, good to see you. In person too. This was nice. Thanks for being here.
Thank you, John.
We appreciate it. Thank you. Kathy Bosjancic there of Nationwide. In the equity market at the moment, pulling back on the S&P 500 by about 1%, about 47 minutes away from the opening bell. Let's give you an update on stories worldwide. Here is your Bloomberg brief. President Donald Trump threatening to withhold federal funding from New York City. A last-ditch effort to drive the city's voters to the former New York governor, Andrew Cuomo, and prevent Zohran Mamdani from winning the mayoral election. Elsewhere, First Brands suing its founder, Patrick James, for allegedly misappropriating hundreds of millions of dollars. Lawyers for the company alleging James borrowed funds on fraudulent terms and diverted cash for himself and his family. And finally, Norway's sovereign wealth fund coming out against Elon Musk's $1 trillion pay deal at Tesla. The fund is planning to vote against the package, saying it is worried about the size. Norway's $2 trillion fund is among Tesla's top 10 shareholders. More on that story throughout the week. That's your Bloomberg brief. Up next, we'll set you up for the day ahead. Plus, we'll catch up with Bloomberg's Michael Ball with the latest tech rally on pause. Palantir down in the pre-market. Equities down across the board on the S&P 500 negative by 1%.
Financial traditions are very easy. So in that sense, companies, especially in the AI space, they're not borrowing as a function of the Fed funds rate. They're borrowing as a function of equity prices. And given where equity prices are for the Magnificent Seven, that's very importantly coming a very significant tailwind still to the economy.
Torsten Slok of Apollo following Alphabet's big issue yesterday, $17.5 billion bond issue, $90 billion order book. Just stellar, absolutely stellar demand for that. And likewise Meta last week. Seen it from Oracle in September. It's just been building now for months.
If there is demand, supply will come. At least that is the Wall Street rule, and that's what we're seeing in the credit markets, because there is a lot of demand, a lot of cash, which is looking for income. And a lot of these tech players are saying, we are happy to give you that income because it is peanuts for us, and we need to build out huge data centers, and that's what's going on in credit.
We'll get into the competition between credit and treasuries and the broader fixed income environment in just a moment as we count you down to the opening bell. Equity futures at the moment down by about 1% on the S&P, with the cash open about 50 minutes away, 41 minutes away to be precise. On the Nasdaq 100, we're down by 1.5%. On the Russell, we're down by 1.4%. That's the price section. Here's the day ahead and a trading day for the week ahead too. Today, election day in America. Key races in New York City, New Jersey, Virginia. Elsewhere, earnings from AMD after the close on Wednesday. More data, ADP data, ISM services, and earnings from Qualcomm. Plus, a Supreme Court hearing on President Trump's tariffs. Thursday, a Bank of England rate decision and a slew of Fed speak. More to come, believe it or not. On Friday, UMich consumer sentiment going into the weekend. Going into the opening bell, let's stick with markets. The rally on pause leading up to the cash open, with Wall Street bosses warning that tech valuations may be too high. Bloomberg's Michael Ball joins us now for more. Michael, good morning. It's good to see you.
Morning.
Thanks for dropping by. Look, we've got some pushback, and it's interesting to get the pushback when we get good news. And Palantir is a decent example of that this morning.
Yeah, here we go again. We had this last week, a lot of beats, and yet the next day the trading was underperforming the SPX. And Palantir clearly doing that this morning, showing that the price was already a little too high and the results were baked in. And although they met on all metrics in many ways, people were stretched.
Is something building here, Michael? Palantir this morning, Meta last week. Lisa was mentioning we're not getting pushback in the credit market, but we're seeing pushback in equities to the valuations.
Yeah, I think so. And I think everything is actually going kind of as planned because the numbers are really good. And it is showing there is something tangible here. We're not yet at a point where the narrative is becoming decoupled from fundamentals. There is a strong story here for growth in the AI sort of world, and it's going to be going on for a while still. But as always, equity markets tend to get ahead of things, whereas credit can be more constrained. And that's why we're seeing some of these massive pullbacks after earnings where you're buying kind of into it, you're stretched with either call skew going up or people generally being overlong, and then boom, you get your results, you take your profit, or it just basically means you were in a weaker hand.
It feels like there's a technical underpinning here too, because a lot of the momentum trades have been flagging over the past couple of weeks. I'm talking about Bitcoin and gold, and we're seeing a reversal of a number of these trends, in addition to some of the meme stocks that have arisen over late. I'm just wondering, is this a technical trade, or is this something that has legs? I mean, is there something built in the pipeline that you could see pushing this trade continue to drive this market lower just on the basis of positioning?
Yeah, I think it is a little bit technical because positioning, like we just said, was stretched. And I saw that often in the option markets when you'd have vol up, spot up days, which indicating people were buying into sort of a higher VIX and bidding up the vol aspect of that. Not to get too technical on that. But to me, it means just weaker hands. And again, this is what we see when we have the sell-offs off the earnings results. But as far as the fundamental story, no, I think there is a tangible story. I think there will be ebbs and flows, as we've heard from other guests this morning. And ultimately, where it goes, anyone can guess, because this is such a pivotal new thing.
Another way of saying this is how much more unwind is there, right? So how are hands still weak, right? Is there still more to go for people to get blown out of their positions?
Right. So I guess as we've gotten through most of these earnings now, one would think that as most of the bellwether mega caps have resulted, you've now cleared out positioning better. From what I see on the screen, call skew has come off, put its back, so people are bidding up downside protection, creating a floor, at least at the index level, and individual stocks are a little bit different, so we don't need to go into that. But yeah, I think we've seen a little bit of froth come out. Does that mean there's more to go? Yes, but what are the catalysts next? That's what I've been questioning, and I'm not quite sure.
Should we turn to credit just briefly? Sure. The amount of issuance we've had, Alphabet, Meta, Oracle before that. Do you think this was pushing treasuries around yesterday?
Yeah, I had a couple conversations with traders. They're definitely worried about the longer term theme of being crowded out. Interestingly, now we have kind of a risk-off bid back into treasuries, so that should work in favor. But yeah, look, there's a lot of paper coming. And when you start talking about some of these 40, 50-year deals at the sizes they're coming in, that's going to impact and that's going to affect auctions in the future.
How helpful is it that the Fed's ending QT?
It's actually pretty helpful for the front end. We've clearly seen a lot of kind of volatility there. That's put the basis trade again back in focus as kind of you can't really have repo vol. They're going to be buying a lot of bills, so let's be clear. This isn't necessarily going to make its way out the curve as they come in with open market operations. It's going to be very bill heavy, as we would expect. But it does set a level on the kind of the rate vol complex in the front end that will help benefit the curve.
Can we just say that the Sell America trade has ended and is dead and that is buried? Because what we're seeing right now is people going into treasuries as a haven trade again, not even questioning it.
Dollar this morning.
The dollar this morning.
At 100.
Right. The Bloomberg Dollar Spot Index at the highest level going back to May. Is this the end of that?
Yeah, it's a great question. And, everybody's sort of tuned out President Trump in a lot of ways as we've come through now the tariff noise with China finally being kind of the last big leg there. Obviously, there's still some more details to be hashed out. And that's what really kicked it off, right? Because we're going to attack our capital accounts. And was sort of this Stephen Myron plan to come in. Now, he's obviously changed roles now and changed his tune. But overall, that story now has definitely come off. And just real quick, we haven't seen Sovereign Wealth Fund. We haven't seen these other tools that the administration was going to use to basically affect our trade account, which would then be the Sell America kind of oomph.
So has that been unwound in terms of the pent-up shorting and the hedging and the ways that people are trying to do it without actually having to sell U.S. assets? I mean, has that been blown away?
That's the question, because we were all still expecting a lot of hedging from some of the pensions and some of the bigger institutional money in Canada and Europe. Look, that's slow moving, and we don't really get a sense of when that comes in. But to your point, is that done? Maybe, maybe not. Now that we've seen some strength in the dollar, there's probably less urgency. Who knows what those conversations are around the board? But again, it takes a while for these decisions to be made.
Michael, good to see you. Thanks for dropping by. Michael Ball there of Bloomberg breaking down some of the price action. It was like a heartbeat in April, wasn't it? Sell America. Here we are 6-7 months later. It's like the world's moved on again.
Well, people were saying it in a lot of board meetings, especially outside of the U.S. They were angry. But those conversations are, we should probably diversify. Okay. And then maybe we'll take it up in 6 months. And so now the 6 months is coming up. And now the question is, do you actually do it?
Price action shapes narratives. We had this massive outperformance in the rest of the world, European banks, to be very, very precise, at the very start of the year. And that collided with this conversation about Sell America. Here we are, 40% rally later. That's gone.
Especially with the AI trade. And how much does that dominate everything else?
Coming up tomorrow, Cameron Dawson of New Edge Wealth, Jim Zauter of Apollo, Matt Stuckey of Northwestern Mutual, Mike Gapin of Morgan Stanley. Looking forward to seeing you tomorrow morning from New York City. Good morning.
Day 3 at the WTA Finals in Riyadh. Elena Rybakina clinched her spot in the semis with an impressive 3-set win over Iga Swiatek. The number 6 seed continuing her excellent run of form. Amanda Anisimova kept her hopes of advancing alive as she won the All-American matchup against Madison Keys. The defeat eliminates Keys from the tournament. Anisimova will face Iga Swiatek for a spot in the Final Four.
benefiting at all, down through $100,000. Well, there is a significant growth in energy demand due to emerging economies. That's according to Musaba Al-Kabi, ADNOC's CEO of Upstream. I spoke to him on the sidelines of ADIPEC and began by asking him about AI in the oil and gas sector.
Well, we're executing a long-term strategy based on what we announced already, building the capacity to a 5 million barrel of oil per day. And that by itself is, of course, a major challenge. But we're committed to achieve that by end of 2027. As you highlighted, we're deploying capabilities, technologies across the board in ADNOC. We have an ambition, of course, to become the most AI-enabled energy company globally. And the AI is going to play a big role in fulfilling this vision for building capacity in the oil, but also continue expanding our gas value chain.
And your current capacity is 4.85 million.
Yes, today we have a capacity of 4.85, and as we highlighted, we're building that capacity to 5 million barrel by end of 2027.
Yeah. Could that 5 million target perhaps be revised higher because of, again, the artificial intelligence incorporation that you just highlighted, but then equally, some of the new development plans around Upper Zakum?
Our strategy is very clear. We have stated this multiple times, building capacity to 5 million. But let me highlight, building a capacity to a 5 million is going to be a challenge. Sustaining that for as long as commercially possible is going to put another challenge. So the likes of Upper Zakum and other fields, of course, Upper Zakum is going to be an integral part of our P5 or 5 million barrel capacity expansion. And it's going to play also a big role in sustaining that production for the future.
What about in unconventionals? Where do you stand in the exploration phase of potentially shale?
We are making a remarkable progress with the unconventional resources. We have recently, this year, signed with one of the best-in-class operators in the unconventional, EOG. Previously, we also announced partnership with Petronas. We are, as ADNOC, for a de-risking program that we announced earlier. And the results we see so far are very promising, in par or some areas exceeding what we see in the U.S. I think the story of the unconventional in the U.S. inspired a lot of people around the world. And I think the lessons learned, the technology deployment, the capabilities developed in the US and other places put us in a very strong position to capitalize on these capabilities and deliver a successful story.
Yeah, what would you say would be, are you envisaging, are going to be some of the biggest challenges in getting it up and running?
Look, when it comes to the unconventional, it is completely different game. The requirement to integrate your services, to have the right resources in place, to take the quick decisions when it comes to the unconventional is completely different than the way we used to run, or we are running the conventional oil and gas business. So for the unconventional, again, let me re-emphasize that we're making the right steps. The results are very promising, and we are embarking on first phase. Let me highlight the first phase of the gas development. We have a clear sight on developing a minimum of 300 million scf per day in the near future based on the result we achieved so far and the cost reduction we achieved also.
Yeah, how much of a bottleneck would water supply be?
Look, the beauty of Abu Dhabi and in general the region here is similar to what you see in the US. You have an established oil and gas infrastructure. That infrastructure, you have facilities, the water, you have accessibility to water. And let's remember also part of the oil production, there is a significant water comes with the oil. So there is also a synergy that we can repurpose, produce water to serve the unconventional. So there are a lot of ideas. How do we introduce more efficiencies in the system and create the right ecosystem that will support the development of the unconventional.
Yesterday in the opening ceremony, His Excellency Dr. Sultan was talking about the signal and the noise, and that the long-term signal is positive for energy demand. But noise, there's a bit of volatility. So let me ask you about some of that noise and how you see the oil market dynamics playing out in the next 6 months, because there is a huge part of the analyst community that are expecting a big supply glut to hit.
As you highlighted, and as the opening ceremony, Dr. Sultan was very clear, if you focus on the signal, let's talk about the signal. The long-term fundamentals of the energy sector and the energy outlook remains the same. There is a significant growth on the energy demand, driven by, of course, emerging economies, certain sectors like aviation sector or airline fleets. The number thrown yesterday or mentioned yesterday, we're moving from 25,000 to almost 50,000 airline fleets globally. Petrochemicals is going to drive demand as well. So in the long term, the demand is going to continue growing. And based on a lot of consensus, outlook consensus, by 2040 and beyond, the anticipated oil demand will remain above 100 million. That put a lot of, responsibility on an integrated producer like ADNOC. We are producing one of the lowest costs, but more importantly, one of the lowest carbon intensity barrels globally. So it is in the interest of this energy system that producers like us continue producing reliable and secure and the lowest carbon intensity barrels to the market. Power, also electricity, is going to expected to increase significantly. Data centers and power demand for data centers is expected to increase by 4x. So the picture is very clear, the signal is very clear, and the commitment on energy producers is very clear. We will maintain our strategy to continue fulfilling the growing demand for energy going forward.
That was Musab Al-Kaabi, ADNOC Upstream CEO, speaking to me at the ADIPEC conference here in Abu Dhabi. Well, coming up, Nigeria is moving ahead with a $2.3 billion Eurobond sale, even after Trump's threat rattled markets earlier this week. We'll discuss that next. This is Bloomberg.
Technology is embedded in every aspect of our lives
and laying the foundation for the future.
From finance to defense, AI to entertainment,
and from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
and the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Tehran, and this is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Abu Dhabi, where we're live from the trading floor at ADNOC Global Trading. Well, Nigeria is open to selling its state-owned refineries as part of efforts to boost downstream competition. Alo Verheyden, Nigeria's special advisor on energy, told me it's an option if they find the right partner. She also weighed in on Trump's threats to use military action against Islamist militants in Nigeria.
I think we don't really understand the complexity, and so there's a lot of education that needs to happen so that people really understand it. The president's most senior appointee in the energy sector, I'm Christian, but the president is Muslim. He's married to a Christian. A lot of members of my family, whether they're in the U.S. or in Nigeria, we coexist peacefully as Muslims and Christians. So there's a small group of terrorists that equally attack, not really based on religion. And so it is to make sure that there is an understanding of that particular problem and that it's appropriately targeted. It's unfortunate because that level of sentiment and coming from the presidency in the U.S. means that a lot of the hard work that we've done over to reform our economy and attract capital from all sectors of the world could be in jeopardy because this is an issue that is not well understood. But we're going to take on that challenge. We've done it before. We've educated many people about the complexities of Nigeria and, more importantly, the opportunities of Nigeria. And there's a lot to learn about the way that we coexist peacefully across multiple religions.
I was going to say, as it pertains to the work that you do, and specifically in the energy industry, how important is it that the relationship is mended with the U.S. right now?
Oh, really important, yeah. So we've done a lot of work to make sure that we're attractive as an investment destination, not only to U.S. investors, but to global other investors across the globe. We're making new friends, keeping our old friends. We have Exxon, we have Chevron, who've operated in Nigeria for decades, and we hope they will be there for decades to come. And they will also be good ambassadors about the opportunities that they've realized, jobs they've created for Americans, and so that they can help us attract additional American companies from the private sector to participate in the opportunity that is Nigeria.
So let's talk about that. I believe recently you said that you're expecting $20 billion of oil and gas investment by 2029. Where is that investment expected to go?
So we've done a lot. The president has done a lot over the last 2.5 years to make sure that we improve the investment climate in Nigeria. So we've improved our fiscals to make sure it's a lot more competitive. We're now top 3. In 2024, we're considered the top 3 destination amongst 14 peer countries. A lot of those investments are going into oil, gas, and increasingly that's going to enable us power our industries, homes, businesses, make our exports more competitive. So although it's going into the upstream, so we've catalyzed about $8 billion so far in 18 months. All of those have come from international investors, big international investors in our markets. And the next 20 is also going to come from those investors and some also indigenous independents that are emerging that we've created as a result of those reforms as well. A lot of those investments are going to go into gas as well as oil. When we enable supply of gas, we are hoping to catalyze midstream, downstream that will deepen access and affordability for the Nigerian businesses, ensure that we are also able to diversify our gas exports, make sure we're not so commodity dependent, that we start to add more value to our gas and petrochemical, make sure we create petrochemicals, agricultural inputs, things like that.
So that $20 billion is essentially a tally of the commitments?
It's a tally of the commitments. There are 2 major final investment decisions that we're expecting over the next 12 months. So in oil and gas space, but it's a tallying of all of the opportunities that we see along the value chain.
That was Olu Verheyden, Nigeria's special advisor on energy. Meanwhile, Nigeria is pressing ahead with its $2.3 billion Eurobond sale despite market jitters sparked by Donald Trump's threat of military action. The offering will test investor confidence just days after the sell-off in Nigerian assets. Our chief Africa correspondent Jennifer Zavazaja joins us now. Jen, really fascinating conversation that I had with the special advisor on energy there, talking through, again, some of those threats that have come through from President Trump over the course of the weekend, but then also the huge amount amount of reforms that Nigeria has undertaken over the last couple of years, specifically in this case, obviously in the energy sector. Interesting to see that the finance ministry has actually looked past some of the short-term noise and is deciding to come to the market with this Eurobond issuance, perhaps an affirmation of sorts of the fact that their reform strategy seems to be paying off for the international community.
Yeah, absolutely, Jumana. And that seems to be the sentiment that we're getting from a number of investors that we've spoken to. And what Olu was telling you sort of echoes what we've heard from other Nigerian officials over the past few months, really, is that finally, potentially, we're seeing if, in fact, we don't see any sort of direct strikes, are some of these international players who Olu was just mentioning there, but even some of the indigenous players, do they halt production? Then what does that then do to the export revenue? We should also mention, of course, we've paid quite close attention to the Dangote refinery, which has, over the past year or so, made Nigeria into a net exporter of oil versus being a net importer. So potentially, could we see some sort of disruption just given the uncertainty and the questions around will they or won't they, or as it pertains to President Trump? But at this point in time, many people are just trying to pay attention to the facts on the ground and whether or not we'll actually see any sort of follow-on from President Trump. At this point in time, we have not heard anything.
Jennifer Zabazaja, our Chief Africa Correspondent in Johannesburg, thank you so much. Well, coming up, Abu Dhabi's AIQ is betting big on agentic AI to boost efficiency in the energy industry. That conversation next. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg. Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Agentic AI frameworks, or the development of these agents to help support everything from upstream to downstream to other energy verticals, is a key focus for AIQ, not only within the Abu Dhabi ecosystem and not only with our key shareholder and partner ADNOC, but also exporting that knowledge and experience and those solutions to the global world. We are right now actively participating in discussions with Kazakhstan's energy giants through our strategic partner and our shareholder Presight. We're utilizing Presight's ecosystem in Southeast Asia with Malaysia, Indonesia, and of course we want to make sure that we export that knowledge as an Abu Dhabi product.
So it's a product that you could also partner with third parties?
Yes, absolutely.
Okay.
So this product is being developed by G42 in partnership with ADNOC, Microsoft, who are helping us develop a very sophisticated OSDU platform. So we're very honored to have strategic partners in this journey.
Yeah. You talked about the efficacy of your models earlier, and I guess one of the questions people ask is just how reliable, how accurate are the models that are coming through, and how robust is your testing system before you actually take this, you take your findings and apply it to real-world applications, in the context of ADNOC and its activities.
So when you work with petabytes of data, we're first of all honored and truly, truly blessed that ADNOC have a very, very sophisticated data logs and data lakes. So the data is very clean and we are able to augment the value from it relatively quickly. We always go through a series of testings before any model is rolled out. We do it in secure environments provided by G42, which means sovereign cloud environments.
Yeah.
And we use these agents as co-pilots to date. So that means they give suggestions, they advise, they're able to support, but they are not taking the action because we want to empower the field engineers, the people who are working day to day on the fields, from the control room to the boardroom, in order to make executive decisions in a much better way.
Yeah. How important is it, do you think, for oil companies today to have intelligent energy systems in gaining a competitive edge?
It's absolutely important. As His Excellency Dr. Sultan referred to yesterday, Secretary Bergen said that power equals knowledge. And that is a very powerful statement. AIQ is front and center of that statement. We want to empower the energy providers of the globe in order to optimize their production, to increase their efficiencies, to enable them to power this global trend of the AI revolution.
Well, that was Magjan Kanesbey, Managing Director at AIQ, and that rounds up our show for today. Horizons Middle East and Africa, thank you for tuning in every day.
NYK sustainability efforts have produced a breakthrough. The tugboat Sakigake is the world's first ammonia-powered vessel in commercial use.
LNG can decrease emission of the carbon dioxide compared with the heavy fuel oil, the 25% more or less. But ammonia, 95% decrease can be achieved.
According to Bloomberg NEF, ships powered by LNG and other alternative fuels make up nearly 40% of the global shipping order book.
This is funded by the NEDO, so-called Japanese agency. And also the NEDO has the kind of the GI funds and the Green Innovation Funds. And also the Japanese government is supporting the usage of the ammonia as the power-generating fuel.
It's more expensive than normal standard fuels.
Yes, it is. And at this moment, the supply of the ammonia volume is very much limited compared with the LNG and also the heavy fuel oil. But in order to promote ammonia as a marine fuel, together with the other industry players, and we can have the kind of the mass production, then the cost will be decreased. Then the next 10 years, we try to increase the number of the vessels powered by the ammonia.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. Happy Wednesday. These are the stories that set your agenda. Democratic Socialist Zohran Mamdani sweeps to victory in New York, becoming the youngest mayor of America's biggest city in 100 years. Elsewhere, Trump's Republicans suffered in key local contests as the government shutdown becomes the longest in history. Global stocks fall for a second straight day on worries over lofty valuations for chip stocks. But Chinese markets tip into the green as Beijing suspends tariffs on US farm exports. Plus, European corporate heavyweights in focus this morning with earnings due from Novo Nordisk and BMW this hour. So it was a brutal session on Wall Street yesterday, with the Nasdaq closing lower by more than 2%, the S&P losing more than 1%. Is this the start of a healthy pullback or something of a deeper sell-off? The sell-off, when you look at the futures, the US futures and European futures, pairing some of the heavier losses, so maybe there's a bit of stability, maybe there will be dip buying that comes back. US futures still in negative territory, though, after the losses of yesterday. S&P futures pointing low by 0.3%, Nasdaq 100 futures pointing low by 0.4%. $500 billion wiped off the Philadelphia Semiconductor Index just yesterday alone. European futures, after losses of 0.3 yesterday, pointing low by 0.8%, a bit of a catch-up to the sell-off that came through on Wall Street. FTSE 100 futures here in the UK looking to drop 31 points. Let's flip the board and have a look cross-asset. There has been a move into safe havens. Treasuries are bid, gold as well, and the Japanese yen. 153 on the yen, just up 0.1% versus the US dollar, but it has benefited to some extent from that risk-off move. 406 right now on the benchmark US 10-year, which was bid yesterday as well, along with the selling of equities moves into treasuries, and that continues marginally in the session today with yields down close to 2 basis points. Bitcoin crossed below $100,000 yesterday, 101,000 right now. A big knock to crypto after the last few days, just gaining 1.5% so far in the session, but you would have gained almost as much by exposed to treasuries year to date as Bitcoin, gaining just around 6% so far year to date. Today in the session at 1.5%. Gold just below $4,000 per troy ounce, up 0.9% so far in the session. Again, benefiting from that haven move. But the US politics is firmly in focus, and some pretty remarkable results coming through in the last hour or so. Big gains for the Democrats after Zohran Mamdani wins New York's mayoral election, beating former Governor Andrew Cuomo and Republican Curtis Sliwa. During his victory speech, Mamdani challenged President Donald Trump, saying the city is helping dismantle the very conditions that gave him power, while Andrew Cuomo addressed a booing crowd, calling the Democratic win their night.
If anyone can show a nation betrayed by Donald Trump how to defeat him, it is the city that gave rise to him. This is not only how we stop Trump, it's how we stop the next one. So, Donald Trump, since I know you're watching, I have 4 words for you. Turn the volume up.
Congratulations to Zohran Mamdani. No. That is not right. That is not right, and that is not us. That is not us. Tonight was their night, and as they start to transition to government, we will all help any way we can, because we need our New York City government to work. We want it to work for all New Yorkers, because our city is the greatest city in the world.
While the celebrations continued for the Democrats, winning governor races in both Virginia and New Jersey. Bloomberg's Kriti Gupta joins me now, has been watching all of the results. Kriti, what does the Mamdani win signal then, historic in its nature as it is?
I mean, historic in that it's the first Muslim mayor. It's the youngest mayor we've had in the 400-year history. I say we as I'm claiming my New Yorker title despite living here in London.
Can do that.
I think I'm going to. And then, of course, the first of the South Asian descent as well. So he's breaking several records here. But I think what is perhaps most at the top of everyone's mind is that he is coming. He's not just a Democratic candidate. He's a Democratic socialist candidate. And this is really crucial because at a time where the American electorate, and I would argue the global citizenship, is really very sensitive to the cost of living, affordability to energy costs. And New York has one of the biggest affordability problems famously in the world, but also recently, just given that you have seen rental prices increase, you have seen food prices increase. So the people in America who are feeling the pinch and feeling the kind of pressure on their paycheck every day, a lot of them are coming from urban cities like New York. So he's coming in, running on a campaign that suggests universal health care, free groceries, rent freezes for rent-stabilized apartments, which is a big, big issue in New York where there is a massive housing shortage, and pushing those prices up. He is also talking about taxing the wealthy, and this is where you start to see a lot of Wall Street folks get a little bit nervous. He's talking about increasing the tax on people who make $1 million or more a year. Now, given that New York City is the financial capital of the world, there are a lot of people in New York City who make above $1 million. A lot of people who don't make $1 million. That wealth gap is basically what he's trying to address at the same time while addressing the city's kind of finances, because at the end of the day, the infrastructure of New York City is also very old, is collapsing, and needs quite a bit of help. So he has quite a lot of things to accomplish here. But ultimately, I think it really speaks, and you heard it in his speech, he's addressing the very concerns that, frankly, helped Donald Trump win as well, because Donald Trump also ran a year ago on the promise of making life more affordable for Americans. It's just interesting that the pendulum is now shifting in the Democratic camp about a year later.
And Mamdani is front and centre this morning, but there were also victories for the Democrats in Virginia, in New Jersey, but also redistricting in California as well. Yeah. Talk us through the implications there and what's come through on this night of success for the Democrats.
Well, this ends up becoming a global story because at the end of the day, I think a lot of the financial audience and the global audience is looking for signs of what power Donald Trump will have in the remainder of his term in the White House. So he has about, we'll call it 3 years to go. There's still a little over 3 years to go. He still also has to go with the midterm. So in about a year's time, we have the midterm elections, which could really change the makeup of Congress. And this is significant because a lot of the things that Donald Trump is passing include a potential shutdown aversion bill. Right now, he has a Republican majority in both the Senate and the House right now. So anything, well, I should say in the House, in the Senate, it's tied. So right now, he is able to pass legislation fairly easily relative to some of his predecessors. If this is a litmus test, what you're seeing in the Virginia special election and the New Jersey special election, both of which have gone to Democratic candidates, as a suggestion that maybe in a year's time you could see the pendulum again shift more to the left, could that then change the congressional makeup and make his legislative ability a little bit harder? It also brings up the question of who could be frontrunners, not just in 2026, but in 2028 as well. And by this suggestion, again, we're only a year into Donald Trump's presidency, it is starting to suggest that some of the very issues that got him elected are also the ones that are quite literally helping support some of his rivals on the other side of the aisle.
And with potentially 5 additional House seats for the Democrats out of California, and we'll see how that unfolds during the midterms, of course. But today the focus on New Jersey, New York, Virginia, of course, and California. Kriti Gupta breaking it all down for us on a day, of course, when the US government shutdown enters a record 36th day. Kriti, thank you very much indeed. Let's turn our focus back to the markets and see how things are faring then in the Asian session after a very challenged day on Wall Street. Winnie Su is in Hong Kong. Winnie, what's standing out to you?
Yeah, it really is a sea of red in Asian markets today, as you mentioned. So, it is mainly dragged down by the concerns around the high valuations of these technology shares. But not just that, beyond that, also the prolonged U.S. government shutdown you talked about just now, and these Wall Street CEO earnings as well. Here on the board, you can see that the MSCI Asia is now down 1.2%. So very volatile session today because we did pair some of the earlier losses. And it's, we are are seeing a bit of a dip buying coming into the market. Investors have also been buying these haven assets. You see the Australian bonds being bought and also the Japanese dollar strengthening a bit. Now we flip the board and take a look at what's going on in the South Korean market, because that's where we're seeing the most actions when it comes to the Asia session. The Kospi here now is down slightly more than 3%, but earlier today it was down around 6%. So lots of volatility there. Here on the screen you can see chip makers including ST Hynix and Samsung also leading losses. So based on our calculation, the Asia chip makers along with the SOX index yesterday wiped out a combined 500 billion of market share. So that's what's been really driving markets today. But also similar story when it comes to the Japanese market. If you flip the board and take a look at the losses there, because we are seeing both the Nikkei and the Topix down. Yes, we are erasing some of the losses from earlier in the session, but still Nikkei leading more losses compared to the Topix just because of the drag of these technology-driven names, especially here on the screen again, SoftBank and Advantest leading losses here. Now, we've been talking to fund managers throughout the day, and many have been suggesting that this is not yet the best timing to buy the dip yet because more corrections may be coming, and they are still watching opportunities for further buying. Back to you, Tom.
Winnie, thank you very much indeed. Look at that move on SoftBank, down more than 10%. Winnie Su in Hong Kong, thank you for that update. Let's get to the semiconductor space then. AMD, the main contender, of course, to NVIDIA in the AI chip market, a rival, still a large gap between the two, of course, in terms of market share. But AMD failing to impress investors with its latest revenue forecast. AMD then joining the global sell-off in semiconductor stocks on concerns over lofty valuations. We're joined now by Matt Bloxham, Senior Tech Analyst for Bloomberg Intelligence. Matt, we really appreciate your insights this morning on what was another significant day for the tech story in the semiconductor space, particularly on the downside. AMD actually beating in terms of its results, but it's all about the forecast and just not matching the highest end in terms of some of the analyst expectations.
Yeah, that's right. I think, probably if you're at the AMD management team, you're kind of wondering, what do we need to do to kind of get the kind of share support? Because as you say, the numbers themselves were pretty much a little bit ahead of expectations, I think, and they beat where people expected them to, which is in terms of demand for like the kind of PC and the server side of it. And we'd seen that in Intel already, so kind of think it was what people were expecting. And as you say, the kind of range they gave for the forward quarter guidance on revenue was better than expected. As you say, I think, some of the more optimistic analysts were kind of stretching the top end of that. And so, I think if you had to point to something, it would be that. I think that AMD is expected to be the kind of big challenger to NVIDIA's throne on the AI accelerators. They are making progress there, but I think, the expectations in the background have been that the people want to see quicker progress than that they're making, and they didn't quite live up to those expectations.
And the Philadelphia Semiconductor Index falling, or at least seeing about $500 billion of market cap wiped off just yesterday. NVIDIA earnings out later this month, always slightly later than most of the earnings coming through from the US. How much should we read across from AMD to NVIDIA? Does NVIDIA ride to the rescue with its own earnings in terms of the sell-off that we've seen across the chip space?
Could do, but I think it would be probably quite specific to NVIDIA. Right. I think what the market will be looking for is another kind of very optimistic outlook about the mid to long term from NVIDIA. But at this point, given where valuations are, it's difficult to see what they can really do. I mean, what we need to see is more tangible near-term progress, not more kind of optimistic talk about the mid-term. And I think it's going to take a little bit of time for some of this stuff to ramp up. Obviously, NVIDIA is a kind of direct or secondary beneficiary of a lot of these deals that OpenAI is doing. But a lot of those won't ramp up fully until we're into next year. So I think, there's a bit of a kind of reality and expectations gap at the moment that needs to be filled.
Yeah, and that was pronounced yesterday when it comes to AMD, wasn't it, Matt? Matt Bloxham, thank you very much indeed with the latest in terms of the semiconductor space, the chip moves, of course, the tech moves, and AMD front and centre as we look ahead to NVIDIA later this month. Here's what else to think about today, though. 6:30 a.m. UK time, a big earnings update from Novo Nordisk, of course, one of the most valuable companies, despite the around 50% drop in the stock year to date. We will be breaking that for you and bringing you a key interview as well from Novo. And at 6:30 a.m. UK time, we'll also be breaking earnings from BMW, the German automaker. Of course, at 8:30 a.m. UK time, it is the Riksbank decision as well. So a central bank decision there from Sweden. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB, Dayb Go. And, of course, the sell-off, the equity market sell-off, but also US politics front and centre. Coming up, Siemens Healthineers reporting fourth quarter revenue that slightly missed estimates. We're going to be joined by the CFO of that business, Jochen Schmitz. Next, this is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Used to be, one would say, what's that got to do with the price of tea in China? When they wanted to poke holes in the relevance of something. Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome back. We've had earnings coming through from Siemens Healthineers, the Frankfurt-listed business, coming through with fourth quarter revenues just below estimates, 6.32 billion euros. The estimates had been for just shy of 6.5 billion euros. In terms of adjusted earnings, 1.1 billion euros, just a little softer than the estimates as well. Let's bring in the CFO right now for a view on how this positions the business going forward. Of course, the maker of health devices with big exposure to the Chinese and US markets. Jochen Schmitz, thank you very much for your time. CFO of Siemens Healthineers. Jochen, how challenging is the environment right now? We have the tariff regime with the US, of course. We have an anti-graft crackdown in China. What's the biggest headwind at this point?
Maybe before we go there, first of all, I'm very happy what we achieved in this fiscal year. We got to our guidance well. Yeah, we ended up at the upper range, end of the range on revenue growth on a comparable basis, as well as on earnings. So a good finish to a very, very good year. Now, talking about the challenges, obviously tariffs are in general a topic for global companies, yeah, because ultimately it limits the flow of goods and services, but also of knowledge, and that will be to the detriment of patients, and it created also financially for a certain period of time a headwind to us. Secondly, on China, China was coming in as expected for us. We have also for the future de-risked our outlook on China, so we expect no big change in the near future. But what is important, we still believe that the Chinese market will come back at some point in time, and then will be also a source of healthy growth for us.
Could you quantify for us the tariff impact on the bottom line for the fiscal year that closes out in September?
Yeah, for sure. We had a headwind of about 200 million euros in fiscal year 2025, and that is primarily affecting two businesses which have a lot of value add in Europe and sell a lot of good stuff in the United States. And we expect for this fiscal year, our fiscal year 2026, roughly double the amount, 400 million.
What are orders out of North America looking like? Your competitor Philips is seeing a bit of a pickup in terms of that region. Are you seeing a similar story?
We are very, very happy what we see in the US market. When you look at our equipment book-to-bill ratio for last fiscal year, it stood for the full fiscal year at 1.14. That means 14% more orders than revenue. I think it's a very strong number. I would say clearly leading the pack in the industry, heavily supported by our success in the US market, in a very healthy market. And we see this, we see a lot of good prospects there. Yeah? So very good.
Would it help in the US to have a major production facility when it comes to those conversations with the Trump administration about tariffs? Would it help to have those kind of investments in the US market?
I mean, first of all, when you look at our value-add structure, we have more employees in the United States than we have, for example, where our legacy comes from, out of Germany. We have 2 of our 4 segments headquartered in the United States. And even if you double-click on imaging, we have 2 of our 5 product lines in imaging headquartered in the United States. So it's significant value-add. When we look at value-add structure and how to mitigate tariffs over the midterm, I think it will relate more or less to 3 things. Yeah, we will look into, I would say, market adaptive pricing. Yeah, we will look into tight cost management, obviously, and we also have, I would say, all the means in our hands to think about potential value-add shifts if they make economically sense. Yeah.
Okay, interesting. You make and sell MRI scanners, of course, and you need those batteries, or those magnets, I should say, for those machines. Are you seeing any supply constraints from China when it comes to those magnets?
No, not for the superconducting magnet. They are not dependent on rare earth materials coming from China. We have very, very small topics on certain motors, which also need magnets. Yeah, but I think we have for most of the stuff our arms well around it, and we are not a large user of rare earth material. Yeah? It's a smaller portion of what we do. Yeah?
Can you give us an update in terms of the potential spin-off that our team has reported on at Bloomberg around the diagnostics segment of the business? Have you made any progress on that front? What kind of investor would make sense for that business?
I mean, first of all, we have never said that we want to divest that business. Yeah? We have a clear transformation agenda for this business. Yeah? When you look at our 4 segments, 3 are clearly market leading by top line, by bottom line, and diagnostics is a strong number 3 in the market. We are going through a major transformation in this business. Yeah? We change the most important platform in the industry in clinical chemistry and immunoassay to the platform called Italica. This is moving very, very well. Yeah? And we are, over the years now, improving bottom line. Yeah? We came from break even. We are meanwhile in the high single digits. And this transformation is working well. And we give the business the freedom it needs to get back to where it deserves. Yeah?
Okay, Jochen Schmitz, CFO of Siemens Healthineers, on the back of those results. We appreciate your time this morning. Thank you very much indeed. Coming up, China suspending some tariffs on US goods in a sign of further easing of trade tensions. We're going to have the details next. This is Bloomberg.
bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
China says it will continue to suspend its 24% tariffs on some US goods for 1 year, starting next week. For more, we're joined by Jill Desis, our senior editor in Hong Kong. Jill, what more do we know about this? The announcement then on levies related particularly to US farm products. How significant a move is this from China to de-escalate?
Yes, that's right, Tom. So this is essentially a confirmation of some of the big things that we had heard out of the Trump-Xi meeting that happened last week. So what this latest announcement does is essentially confirm that they're going to be suspending China, meaning they're going to be suspending these retaliatory tariffs on U.S. products, including soybeans. There was some other things included in there as well. I'm looking at corn, wheat, some types of chicken. So these are all tariffs that it seems were, or these are all measures that it seems were essentially agreed on during that Trump-Xi meeting, trying to de-escalate tensions here, really kind of ramping back, what we've been seeing is this escalation of tensions over the last several months. So I think at this point, this is all something that we can really expect to, continue to be part of this easing of tensions going over the next year. Remember, as an outcome of that meeting, these two world leaders essentially agreed that they were going to put on pause for the following year, a lot of the most major issues that they've really seen. I will, though, point out, though, that, Tom, there's still, when you're comparing the statements and the various announcements that have come from China versus the U.S., it does seem like there's still some question over what exactly is happening with some of these rare earths measures. Remember, these are critical minerals China has a large supply of, that they've been restricting and curbing the export of. While there are some retaliatory measures that China launched in October that have been scaled back, I think there's still an open question as to whether China is actually going to follow through and sort of rescind some measures that they had announced earlier this year. The U.S., I think, certainly expects them to. So, we see this trickle of new announcements that's coming out of China that, again, does seem to be upholding a lot of what was agreed during that Trump-Xi meeting. We'll see if there's going to be more that, essentially confirms that at least there's not particularly high tensions at this moment.
Jill Desis out of Hong Kong, thank you very much indeed for that update. Meanwhile, President Trump says he's held trade talks with Swiss officials, and there are more discussions ahead with his trade representative, Jameson Greer. Donald Trump has slapped a 39% tariff on goods from Switzerland. Pharma makes up nearly half of Swiss exports to the US. Pharmaceuticals, of course. Other key sectors include chocolate and watches. Coming up, Danish drug maker Novo Nordisk has seen its shares fall 50% this year as competition in the weight loss space heats up. The company reports crucial earnings in just a few minutes' time. We will bring you those numbers as they cross the terminal. This is Bloomberg.
bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising chorus conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Democratic Socialist Zoran Mandani sweeps to victory in New York, becoming the youngest mayor of America's biggest city in 100 years. Elsewhere, Trump's Republicans suffer defeats in key local contests as the government shutdown becomes the longest in history. Global stocks fall for a second straight day on worries over lofty valuations for chip stocks, but Chinese markets tip into the green as Beijing suspends tariffs on US farm imports. Plus, European corporate heavyweights in focus this morning with earnings from Novo Nordisk and BMW crossing the terminal right now. Let's start on Novo Nordisk. The stock is down about 50% year to date. The competition with Eli Lilly and the bidding, of course, for the drug maker Metsera. Novo seeing full-year operating profit at a constant FX level increasing between 4 to 7%. Here's the redhead then across the terminal. Full-year sales. Novo sees full-year sales increasing between 8 to 11%. So at the high end of the range, up 11%. That is slightly below the previous forecasts in terms of the top end of the range. They had forecast sales at a constant FX rate of between 8 to 14% growth. Now they've moved that slightly lower to between 8 to 11%. So that is a key redhead for Novo Nordisk. The stock, of course, down around 50% year to date. Full-year operating profit, again, seeing full-year operating profit in a range of between increases of 4 to 7%. Wegovy sales coming in slightly below the estimates in the third quarter, and we know that's key for analysts as well. We're going to be speaking to the CEO of Novo Nordisk at 9:15 a.m. UK time. A crucial conversation for you not to miss. So mark that one in your diaries in the next couple of hours. BMW, meanwhile, coming through with a focus on the margin story. Third quarter margins coming through with BMW, 5.2%. 5.2% is the margin in the third quarter, slightly softer than the estimates. The stock is up about 7% year to date. The competition, of course, from Chinese competitors, but also the potential tariff impact is a factor for this company. In terms of revenues, they came in slightly below the estimates, 28.5 billion euros in the third quarter, the auto revenue, versus estimates of 28.8 billion. Sales coming in a little softer as well. So it's a miss in terms of revenue, modest miss, and it's a modest miss in terms of sales in the third quarter for BMW, 32.3 billion euros, slightly below the estimates. Again, it's the guidance around the margin that will be interesting when it comes to the earnings call. In the most recent quarter, the margin a little softer than the estimates. Let's get to the broader markets right now. And earnings will, of course, be a factor. But you saw a significant sell-off in terms of US stocks yesterday. The Nasdaq 100 closing lower by a little over 2%. The S&P closing down by 1.2%. Futures looking to further losses today, but they have paired some of the heavier selling. So maybe this sell-off and this pullback is starting to moderate right now. European futures pointing lower by 0.5%. Here in the UK, FTSE 100 looking to drop 12 points. S&P E-mini is currently flat. Nasdaq 100 futures lower by 0.1%. Again, it's a less ugly picture than than it was at 4 a.m. this morning when I got on at least. Flip the board and have a look cross asset. You have seen a move into havens. The yen has benefited, as has gold. Interestingly, Bitcoin, after dropping below 100,000 yesterday, is currently up 1.7%. The US 10-year Treasuries have been bid as well. Stabilisation in the Treasury market right now, fairly insignificant moves right now, having seen a bid for Treasuries yesterday, 407 on the benchmark 10-year. The yen is largely unchanged, and gold is up close to 1%. Let's go to take now and a deep dive on the market reaction. The market action yesterday. Lale Akona, market strategist at eToro. And I want to start on yesterday and how it ties into the moves that we're seeing today. Again, the future story is less bad than it had been earlier this morning, but the sell-off was pronounced on Wall Street yesterday. What for you stood out? What do you think is the key catalyst? Is it valuations? Is it concern about Fed? Is it the earnings mismatch in terms of expectations? What for you stood out in terms of yesterday's sell-off?
Yeah, I think several factors. As we know, the market is priced for perfection, so that's number one. If you are giving less than stellar earnings guidance, then your stock price is going to suffer, right? The second one is obviously election uncertainty in the US. And the third one, I would say, monetary policy uncertainty, both here in the UK, but in the US. So I would say multiple factors coming together. Yeah. To put some pressure on the markets. But I do believe that breadth is still very strong. Equal weighted index is still trending higher on a long-term basis. We have more than 50% of S&P 500 trending above their 200-day moving averages. It's just some parts of the market we need more participation. Consumer names, in my opinion, oversold, both on the discretionary and staple side, and obviously energy names are quite weak.
So was this a healthy pullback that we're seeing? Is it a healthy pullback, or is it something a start of something more pronounced in terms of a deeper sell-off?
I would say it's a healthy pullback just because fundamentals are very strong, right? So we are expecting 11% for S&P 500 earnings growth for this year. Put on top of that 4% of Atlanta GDP Now tracker, which is a high-frequency tracker for the U.S. economic growth. That tells me that actually the corporate America sees a soft landing plus disinflation, right? So I think any pullback here would tell us that, a dip buying could come. And we've seen also gold as well starting its uptrend as well. So I think, again, a healthy pullback. Fundamentals are strong, monetary policy easy, fiscal policy easy as well. They will come more to the picture in terms of seeing it in macro in the next year.
It's interesting that you focused in your first answer on breadth and that being a positive, because so many analysts that I'm reading are saying they're concerned about the concentration of the gains in a small number of mega cap tech names. But that's not a picture that you're seeing.
I don't see that. I think, again, some of the names need more participation, such as consumers, such as energy, such as healthcare, such as staples. But again, the tech names are getting obviously much of the headlines. But and also we need more participation from Russell 2000, given the fact that the environment is so positive for Russell 2000. Given
is the environment positive for those small cap names if the Fed is on hold in December?
Well, the Fed also said that they will end QT at the end of this year, basically. So that tells me that that's very positive for these small and mid cap stocks. Overall, easy monetary policy is still in place, and fiscal policy. The tax bill allows expanding of R&D, of capex, of interest rate deductions as well. These are all very positive for those very R&D intensive firms in small and mid cap names. So I would say that yes, and obviously they are very reliant on short-term debt as well. So any easy policy would help.
What have we learned from this earnings season, Lale?
I think we learned that, again, overall, earnings growth, again, at 11%, quite healthy. Tech names are either guiding higher capex or higher spending. What is going to be more important for us is how that spending will be funded, right? So we are seeing it funded by cash, but free cash flow growth ex-Nvidia is negative for these big tech names. So many of them will go to the public markets, and more worryingly, they might go to off-balance sheet. So that's what I'm worried about more than the capex headlines, is how are they going to fund these expenditures.
Okay, that's interesting. So look for the off-balance sheet funding from some of these big tech players as they're trying to fund that build out. Before we let you go, that links maybe to a question on what's happening in the credit space, and that debate continues around whether or not these are ring-fence risks or something more systemic. Where do you stand on the kind of bankruptcies you've seen in the auto space, Tricolor and First Brands? Is that idiosyncratic, or is there a bigger risk in credit at this point?
Idiosyncratic at this moment, but as we move closer to the end of the cycle, and as we will see the Fed start to tighten rates, then they could become more systemic in nature. I'm not too worried about it right now because we're in overall easing monetary policy cycle at the moment. There are some, obviously, pockets of risk, such as subprime auto, distressed commercial real estate, some pockets of consumer credit as well. But I wouldn't call that a systemic risk at the moment, given, again, that we are in an easy policy cycle at the moment.
Lale, thank you very much indeed with your insights on these markets and a healthy pullback. That's the view from Lale Akona, market strategist at eToro. Now, on the earnings story, and a specific name that stands out to us this morning, of course, Novo Nordisk has pared its forecast for a fourth time this year, citing lower than anticipated sales of its blockbuster drugs Wegovy and Ozempic. Sarah Sjolin, Bloomberg's Copenhagen Bureau Chief, joins me now for the details. Sarah, what stands out to you then from the third quarter earnings from Novo?
I think you just mentioned a few of them. When I'm looking at the earnings report, I can see that they're missing on almost every single number in there. They're missing analyst estimates on EBIT, and this is the second quarter in a row they're doing that. So they're also issuing this warning that they're going to have lower sales than previously anticipated. So overall, we're just looking at some of the same old, weak stories that we've seen for the last few quarters for Novo Nordisk.
The same old weak story. That's pretty damning, Sarah. The competition is clearly there with Eli Lilly. How much of this is about the competitive threat versus demand in key markets in the US? And is there an opportunity? If Novo gets this deal across the line with Metsera and they're bidding fiercely alongside Pfizer and the clock is ticking, does that put a floor under things for Novo?
Those are really, really good questions. I think at the moment we're just looking at this bidding war. We're asking questions. Can they win? Will they get it through the FTC? Why are they doing it? Is it really because they want Metsera badly because it fits into the pipeline? Or is it also to take Pfizer out of the competition? Some of the things I'm hearing a lot from analysts at the moment. We have a media call later today. There's also some interviews with the new CEO. And this is the first quarter where he is CEO, Mike Duster. So all these questions will undoubtedly be some of the main focus for him today. This is a company where we're looking at Novo Nordisk. Over the last 6 months, they ousted their CEO. They have a new CEO that's come in quite aggressive, all guns blazing. They had a major reshuffle of the board. They laid off 9,000 people, and now they're also trying to get into a bidding war with Pfizer. So some people are worrying they're trying too much too fast and may break something along the way. Other people are saying this was necessary. Novo really needed that shakeup to become competitive again.
OK, well, we'll be hearing, of course, from the CEO later in the show. Bloomberg's Copenhagen Bureau Chief Sarah Sjolin with the take there, the details, the context around the earnings from Novo Nordisk. Sarah, thank you so much for that update. We're going to speak, as I mentioned, to the CEO of Novo Nordisk, 9:15 a.m. UK time. Do not miss that interview. Now to some other stories making the news today. Norwegian lawmakers have approved changing the ethics rules for the country's $2.1 trillion sovereign wealth fund to reduce the risk of a forced divestment of holdings in global tech companies. The measures pave the way for raising the bar to sell out of companies like Microsoft, Amazon and Alphabet. Such a step could be prompted by the fund's external ethics advisor. That advisor is currently going through big tech holdings to ensure the fund meets UN rules for ethical investment over the war in Gaza. UK Chancellor Rachel Reeves is expected to meet top insurance chiefs in Downing Street today. She seeks to encourage more investment in the city ahead of her budget later this month. The talks with leaders from Lloyd's of London, Swiss Re, Aviva and others will focus on unlocking capital and boosting growth. Separately, a think tank is warning Reeves will need to run primary budget surpluses to get a grip on the country's unsustainable debt trajectory. The National Institute of Economic and Social Research says an extra £50 billion is needed to guard against future fiscal shocks. Coming up, the KPMG annual survey of CEOs showing concerns about the economy but enthusiasm for AI. KPMG's global head of clients and markets talks us through the findings and what they tell us about how CEOs are positioning around AI and trying to ensure their workforce is match fit for that revolution. Stay with us. This is Bloomberg.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Welcome back to Bloomberg Daybreak Europe. Now, an annual survey of global CEOs suggests confidence in the global economy has dropped to 68%, its lowest level since 2021. But business leaders are clear that AI is their top investment priority for the year ahead. We're joined now by Regina Mayer, KPMG's global head of clients and markets. This is a KPMG survey, of course, surveying 1,350 CEOs from around 11 countries. Regina, thank you for your time. Talk to us about the AI piece of this then. It's interesting that the views on the global economy have softened and become a little bit more cautious, but that emphasis on AI being the top priority for most CEOs.
I see that as a way to drive further growth when you see labor rates have actually been decoupled from growth and productivity. So some of the really interesting statistics, in addition to the number of folks that say it's a top investment priority, we have 69% of CEOs that say they can spend up to 20% of their IT operating budgets, and 67% now say they can see a return on investment in the next 1 to 3 years, whereas last year that was 3 to 5 years. So clearly we've got a lot of experimentation that's leading to real life use cases and improvements in efficiency and effectiveness, and they're seeing that as a way to drive further growth given these really challenging economic times.
Well, that's crucial that you zero in on the return on investment piece, because we know investors are concerned about that. And they are now, CEOs are now shrinking that time frame. They're becoming more confident that the investments they're making in AI will actually lead to gains in terms of upside for the balance sheet.
Because they can see it now. So we've moved out of the it's fun to play with these tools, or I've got a small use case that saves an hour or two, and now with agentic AI and large ability to use massive data bases and the ability to do end-to-end orchestrated agentic processing. I'm not a technologist, but that is driving real life bottom line savings. It's not immediate. We're still 1 to 3 years out, but you can see the optimism growing about what the potential these tools can drive. And that's coupled against challenges on the labor market. So that's the other interesting dynamic that we're watching, how AI interfaces with humans and what that does ultimately for the workforce of the future.
Yeah, and I want to get your take on that and what the survey tells us about the impact on jobs. Before I get there, though, in terms of that return on investment piece, the adoption, did CEOs say anything about the challenges around adoption? There are so many different choices in terms of what they could be implementing, whether they build the solutions in-house, whether they buy externally, concerns maybe about ethics, about data, about security. Where are we? Do we have clarity on where CEOs and how they're positioned, how they're thinking about actually adopting some of these solutions?
I think we're really nascent in that whole conversation, and I've characterized it as the CEO's trilemma. How do you assure access and use? So they've dealt with access. It's pretty ubiquitously deployed now, but we still have low levels of adoption rate with certain categories of workers. The second is, how do you get the right talent and the workforce to use those tools, and how do you upskill and retrain them to take advantage of that? And then there's the whole regulatory framework, ethics. We did another survey with the University of Melbourne and found that 66% of folks use AI without verifying accuracy. So we know that there's challenges across all three dimensions, and we're working with clients that are just trying to figure out what that strategy is, how do they take it forward, and how do they deploy it. That's where the 20% of their IT budgets going to AI is really significant finding in this survey.
And Regina, you touched on the labour market in your previous answer. Are these CEOs chomping at the bit to use AI to slash their workforce and their headcount?
I don't see it as an employee or workforce reduction play. We have actually labor shortages and a change in demographics. I'm sitting here in Tokyo with a country that's faced with a significant labor shortage. So how does AI start to fill that gap? And how do we change the current workforce to be able to take advantage of these tools of the future? And how do we leverage experienced employees to train the next generation who don't have that experience, but then can be further enabled by AI? There's huge opportunity, but it's going to be really hard to get that balance right. And whichever companies get that right sooner rather than later, I think they will be dominant in their sectors.
What are the biggest constraints in terms of hiring when it comes to expertise in AI?
So they are worried, that was one of the findings, was 70% are worried about the ability to find that talent and attract it. We've seen some of the examples of looking for that unicorn-like talent. We know that there's not a lot of folks that are completely versed in these tools. And again, I go back to experience is incredibly important. It's not just technology. And we advocate strongly that there has to be a human in the loop. So how do we effectively broadly deploy it across a broad group of folks? How do we use agents to make some of the more mundane tasks a lot more effective and efficient? And then how do we unlock that brain power to improve our customer experience, to reduce costs in terms of our manufacturing, to decarbonize our supply chains, and turn that insight and innovation into other bigger picture things that are harder to tackle?
Okay. Regina Mayer, we appreciate your time on the back of that survey. KPMG's Global Head of Clients and Markets, on how CEOs are thinking about AI adoption and the return on investment. Now, in other news, several German subsidiaries of First Brands Group have filed for insolvency in a sign that the fallout from the US car parts supplier's bankruptcy is rippling through to its foreign operations. The auto parts maker's European units have been hit by weaker car production and tighter credit conditions. Talks are underway with major automakers as administrators seek buyers. There's plenty more coming up. We're going to give you a deep dive in terms of how the Democrats have come through with some success in the voting in the last 24 hours or so, and how that could position them for the midterms next year. Stay with us. This is Bloomberg.
bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Tehran, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
New York, tonight you have delivered a mandate for change. Politics. A mandate for a city we can afford. And a mandate for a government that delivers exactly that.
New York City Mayor-elect Zohran Mamdani speaking there in the last couple of hours. And it wasn't just a victory for the Democrats in New York, Social Democrat, of course, when it comes to Mamdani, but also the Democrats in Virginia, in New Jersey, in down-ballot races as well in Pennsylvania and Georgia. If we take a step back, here is how the prospects for the Democrats and the Republicans and President Trump himself have adjusted since March of this year. Let's start with President Trump's own personal approval ratings, jobber ratings. That's the white line. You can see a pretty sharp drop just in the last few weeks or so in the month of October. In terms of the red line, that represents the Republicans in terms of congressional voter intentions and polling data has edged lower as well. And the Democrats have ticked up. So the prospects, of course, this is a bit of a litmus test in the last 24 hours for how things may turn out, possibly when it comes to the midterms. But the prospects for the Democrats on the results of the last 24 hours, slightly brighter, certainly brighter than they were, of course, shortly after the election of President Trump and the inauguration. Let's flip the board and have a look at what's happening in terms of the government shutdown, because that could be one of the factors that's weighing on voters' minds. We are now at a record shutdown. We've never seen a shutdown as long as this, 36 straight days. The second longest shutdown was under Trump in his first administration, of course. And there are a few signs at this point that the two sides are going to resolve this issue. A record when it comes to the shutdown. Let's flip the board and briefly look at a very different picture. This is in terms of the crypto and Bitcoin and the sell-off that we've seen. Interestingly, when you take a step back as well, you could have gained about as much by being exposed to US Treasuries year to date in terms of the gains of about 6% versus Bitcoin, given the sell-off that we've seen and the liquidation. Around 400,000 coins liquidated by some of the biggest holders. That accounts for about $45 billion worth of Bitcoin. It crossed below 100,000 yesterday. It's back above that today. Watch crypto then on some of those adjustments. We're going to be speaking to the CEO of Novo Nordisk, by the way, 9:15 a.m. UK time. The opening trade, though, is up next. This is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on Filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Good morning from London. I'm Anna Edwards alongside Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. European futures fall as the Kospi and Nikkei sell off on worries over lofty valuations for chip stocks, pushing up demand for bonds and other haven assets. Democratic candidate Zohran Mamdani sweeps to victory in New York, becoming the youngest mayor of America's biggest city in 100 years. Elsewhere, Trump's Republicans suffer defeats in key local contests as the government shutdown becomes the longest in history. Plus, Novo Nordisk and BMW both see some tariff-induced weakness, and the competitive environment gets tough for Novo on a busy day for European earnings.
In the meantime, quick check on these markets, because yesterday was a brutal day for the stock market. Today, you aren't necessarily seeing any of the sentiment change. Your Stoxx 50 futures still in the red, down about 0.5%. A similar story across the Atlantic. Even in the NASDAQ 100 tech-focused futures, still down 0.2%. To me, I think the strength of the dollar is starting to get interesting. We're at a 114 handle on euro dollar right now. So you are seeing weakening in European currencies across the board. Cable is similar story, 130 on that currency pair. We're also keeping one eye on the Swissy, perhaps a thaw between U.S.-Swiss relations. The countdown to the opening trade starts right now.
Welcome to the program, everybody. This is the opening trade. It is Wednesday, the 5th of November. We need to talk about a lot of things this morning, Kriti. We need to talk about big shifts in US politics. We need to talk about the latest dynamics around the earnings stories. We've got lots to say there this morning. But let's start with tech and the sell-off that we've seen in tech around the world. And it is continuing into the Asia session. We do see futures weaker in Europe, but I think it is also important to point out that we're off our lows in the Asia session, and there's a few dynamics going on here. So we're worried about valuations, about interest rates, whether they continue to be cut. These CEOs of Wall Street giving us these warnings we talked about yesterday. But the Kospi in Korea was down by more than 6% at one point. It's now down by less than 3%. So just giving a sense of how we've pulled back from some of our lowest levels. AMD didn't help. The numbers were better than estimated, but the market took quite negatively the fact that the top end of estimates was not met, and so that's where the bar is for some of these really quite expensive chip stocks right now. But important to say, what has pulled us back from the edge in the Asia session? China. Some of the news there, the mood music there around tariffs a little better, the growth story coming from Li Qiang a little bit better out of China, and so all of that adding up to something that is negative, yes, but maybe not as bad as it was.
And building on the theme that we saw in the last 2 days of the week as well, which is simply that we are seeing these massive earnings beats on the kind of the numbers. You saw it in Palantir, you saw it in Alphabet, you saw it in several of these mega cap names. But to your point, the A++ student can't be the A++ student forever. And I think this is really crucial here, because this is where the valuation question is coming in handy. But it only feels like it's isolated to tech yet. I'm waiting for it to broaden out to the other parts of the market that are also seeing as frothy. Things like healthcare, things like mega caps, things like luxury in this region. We haven't seen it broaden out just yet.
Yes, a lot of questions about breadth. And actually, one of our guests this morning is not worried about breadth and the fact that the Mag 7 has dominated. So that'll be an interesting conversation. One of our colleagues, Dan, telling me today that an illustration of just how strange some of the market moves are. We saw more stocks going up yesterday on a day that the S&P fell than we saw on Monday on a day when the S&P rose. So that just tells you a lot about concentration, about the fact that the Mag 7 does tend to dominate, or when it doesn't, it throws up some interesting developments, some weird developments in markets.
It absolutely does, and I think that China mood music is really fascinating. You're getting a little bit of validation that perhaps the events of last week are actually creating a thaw, a long-lasting thaw. I mean, the fact that we're talking about suspension of tariffs potentially for a whole year, I mean, the visibility into 12 months' time, I think, is a unique aspect of this relationship. But things in terms of strange things happening in the markets, let's talk about strange things happening in politics. We have to go to the story of the morning. It's over in the States, where Zohran Mamdani has been elected the 111th mayor of New York City in a historic victory.
So, Donald Trump, since I know you're watching, I have 4 words for you. Turn the volume up.
Turn the volume up. You heard it from Zohran Mamdani himself, of course, winning the election victory. Anna, this is so fascinating because he's basically in his victory speech, as expected, saying that because of a year into Donald Trump's term, a lot of voters are swinging in the other direction. And this is so crucial. You're not only seeing this in New York City, you've seen it in other special elections in the United States, in New Jersey, in Virginia as well, where both the Democratic candidates won on 2 key swing states. Does this portend something for the future, especially when it comes to Donald Trump's kind of success that he may have in terms of legislating with Congress come the midterms next year, or also just what the 2026 makeup of Congress might actually look like?
Yeah, does it tell us anything about, yes, exactly that, the midterms, and when we get to those, does it tell us anything about the policy agenda that we might see as trying to be adopted by other Democrats? So rent freezes on 1 million apartments, free buses and childcare. These are the kind of policies that Mamdani has stood on. Will they spread? Does this represent then something of a blueprint for the Democrats? Is interesting. How this goes down on Wall Street, also really interesting. And some, of course, on Wall Street will still be concerned, worried about some of the policies that are going to be introduced. But some leaders suggesting they're going to try and work with Mamdani. So Novogratz, Diamond, Fraser, all suggesting there is work that they can do with him. So will be really interesting to see how the relationship between a self-declared socialist Democratic mayor, how that plays out in a city that contains Wall Street, in a city that basically leads global finance.
And in a city that has plenty of Trump supporters as well. Ian Bremmer, I thought, made a very, over at Eurasia Group, made a very funny comment on LinkedIn as well. He said that for a lot of New Yorkers, Zohran Mamdani, a Democratic socialist, is the mayor, and Donald Trump is the president, which I think really speaks to the polarization that you're seeing, not just in the United States, but globally. A Democratic socialist on one side and, of course, a far-right candidate on the other.
Let's get to some of the earnings stories we've had out this morning, Chrissy, and we've had some disappointment, I think, with some really big companies. We'll come to those in a moment. Another one out this morning, which maybe is a little more mixed, and that is Orsted. If you look at the bottom lines of the net loss coming in lower than had been anticipated, the pre-tax loss coming in lower than had been anticipated, but the further up the P&L you go, the less impressive things get, I suppose. So the top line not coming in anywhere near where estimates are. So I wonder how that will play out as we start to see this one trading. And, of course, we know the story behind Orsted. We've covered it many times, the difficulties politically in the United States, so the pivot to Europe. They've been raising equity. They've been bringing in other investors, the likes of Apollo, for example, in the UK. So there's a lot happening in the sector. We'll watch Orsted at the open, but we have plenty of other earnings to talk about.
Plenty of other earnings. I'll stick with the renewable sector if I can, because Vestas had also come out earlier this morning as well, but their numbers weren't so hot. And we know that Vestas has been dealing with some of the pressures that they're talking about in terms of onshore wind in the United States as well. I wonder what the commentary looks like between Orsted and Vestas. I believe we're speaking to the Vestas CEO tomorrow as well, right here on our London set. So we're going to maybe ask him as well about the private capital story. Plenty of others. Let's talk about BMW as well, because that is one that has hit the wire. The automakers, at least going into this, seem to have a little bit of a turnaround story. BMW, maybe not so much.
Yeah, not so much. And talking about tariffs, so that is one of the things that is living on into this earnings story. We are seeing an impact on tariffs at BMW, so missing on revenue, missing on EBIT, and the tariff story certainly getting a mention. Let's pivot to another big corporate here in Europe that has, well, it wrestles, doesn't it, for first place as to the biggest, or it used to before this year. Let's talk about the story behind Novo Nordisk, reporting some weakness in Wegovy sales this morning. Guy Johnson is at the Novo Nordisk headquarters near Copenhagen, and he's with us now. Good morning, Guy. Talk us through the numbers.
Yeah, so it's a big morning for Danish reporting. We've had some of the numbers you've already talked about, but Novo's the big one that we've really been waiting for. And, guys, it's a miss and a cut, or should I say another cut from Novo Nordisk. Remember, this is a company that basically is looking to stand side by side with Eli Lilly over in the United States in terms of performance. Lilly a few days ago absolutely smashing it. Novo this morning delivering the exact opposite. But, and this is a big but, remember we've had a massive board shake-up here. We've got cost cuts underway. We've got a new chair. We've got a new CEO. That new CEO is about to join us here on Bloomberg Television. And the real question is, does the rebuild begin here? Is this the quarter that the rebuild begins at? Because there's so much going on around this company. We'll talk about Metsera in just a moment. We'll talk about the possibility that Mike's going to be at the White House on Thursday to do a deal with Donald Trump as well. But at the moment, the basic foundations of this are that this is a company that is underperforming. It needs to turn the situation around. How it's going to do that, how quickly can it do that, how quickly can it stand side by side with Eli Lilly?
It's fascinating that you mentioned that the CEO is going to be at the White House because drug pricing, of course, front and center. That is one of Pfizer's arguments for the Metsera bid. Walk us through the latest there.
OK, so let's talk about Metsera, Kriti, and figure out exactly what is happening here. Effectively, you've got a bidding war that is now underway between Pfizer and Novo Nordisk for Metsera. This is a company in the United States that has, let's call it, circa 100 employees. It is effectively a startup. It's only been going for a few years. It's got a product portfolio, future portfolio, that basically mirrors what Novo Nordisk has. So why does Novo Nordisk want to buy this business? Well, maybe today's numbers maybe give us a clue as to that. There are concerns that maybe the future pipeline here at Novo Nordisk isn't going to deliver, and as a result we need new products to be brought into this business, and maybe that's why they're going after Metsera. But if that's the case, then that's a pretty damning indictment of the future portfolio that Novo Nordisk has and the current valuation. Let's talk a little bit about what is happening with the drug pricing story. So we've seen a number of different CEOs at the White House. You could potentially see Lilly and Novo there on Thursday to do a deal. The real question there would be what happens with the Medicaid pricing and inclusion within that process. But the other key question within this as well is you've got a series of compounders in the United States that are producing similar GLP-1 products. If we see a deal at the White House, would that close the loophole that allows those compounders to continue to produce? So lots of things going on around this company. As I say, we're going to be speaking to the CEO very, very shortly. Anna, back to you.
We certainly will look ahead to that, Guy. Thank you very much. Guy Johnson, of course, over there at Novo Nordisk in Denmark. Let's tell you what else is coming up on the programme today. Becky Chin is with us, Fidelity International Portfolio Manager. Franz Muller will be with us, Ahold Delhaize CEO. We'll get a read on the US consumer as well as the European grocery landscape. Marina Zavalok will be on set, Morgan Stanley Chief European Equity Strategist. How has the earnings story developed? What clues can she take away from the earnings picture? And Eric Nelson, Wells Fargo G10 FX Strategy Head. My inbox is inundated, Kriti, with commentary on why the dollar has been more stable than it was earlier on this year. Is that the end of the dollar selling? We have a lot to talk about when it comes to that conversation with Eric.
Yeah, lots of pressures that you're seeing both domestic and internationally. Speaking of internationally, there's plenty of data around the world to keep your eye on as well. At 9:30 a.m. UK time, S&P Global UK Services PMI is going to be hitting the wire. Remember, we are in data collection mode ahead of the BOE tomorrow. We also have McDonald's earnings. This one's really interesting. You were talking about the dollar weakness story. Remember, McDonald's gets a good chunk of their revenue from outside of the United States. So anything they have to say about the currency story is relevant to a global audience. You have U.S. ISM Services Index, and then, of course, more tech earnings. I think we can call them tech. Robinhood, of course, has that major crypto exposure. Qualcomm, of course, are they going to follow in suit with AMD? But I think the big hitter, Anna, is the U.S. Supreme Court tariffs hearing. This is a ruling that we're maybe not going to get for a couple of months, but we are going to get maybe a little bit of insight from some very dedicated reporters in the courtroom of what is being argued.
Yeah, absolutely, because it seems that even as these arguments are put forward, you get a sense perhaps of which way certain justices are leaning, and that can be insightful a little bit, even if it isn't conclusive, ahead of what will be more conclusive, their verdict on these measures that President Trump has taken. That won't come until, I think, early next year, so we'll have to wait a little bit of time, but we might get some clues. In the meantime, I mean, if he did lose today, would he put in place Section 232 anyway? Really interested to see how the market would respond to any of this, because on the one hand, if tariffs were reduced, maybe that would be risk on. But on the other hand, would that leave a fiscal hole? Would that be risk off? Would it be neither? Would the market just conclude that he'll find other ways to raise this money through some kind of tariff? So lots to say there. I mean, Switzerland also in focus when it comes to tariffs.
It is, and this one's fascinating. I mean, there's no thaw necessarily between the United States and Switzerland, but Donald Trump actually going as far as to put a Truth Social post up to talk about the fact that there is negotiations happening, and we know that the Swiss equivalent of Jameson Greer has been making trips to the White House pretty significantly for the last couple of months. The Swiss president had gone to Washington as well, did not get a meeting with Marco Rubio or with Donald Trump, so that was a bit of an embarrassment there. But there is a dialogue happening, and we should mention that for the entire world, I think outside of India, Switzerland is up there in terms of the ones with the highest tariff rates.
Yeah, and certainly really high for Europe, and we'll watch Swiss stocks at the open just in case there's any upside from even talk about bringing down those tariffs. Let us tell you what else we are focused on this morning. The head of the Bundesbank says that Europe must pool defence resources and consider common financing in a bid to boost security. Joachim Nagel, a member of the ECB's governing council, says Europe must, quote, quickly strengthen its ability to protect itself and needs closer cooperation on procurement, aligning equipment, personnel and strategy. But he went on to warn there must be no risk of any kind of debt mutualisation. In other news, several German subsidiaries of First Brands Group have filed for insolvency in a sign that the fallout from the US car parts supplier's bankruptcy is rippling through to its foreign operations. The auto parts makers' European units have been hit by weaker car production and tighter credit conditions. Talks are underway with major automakers as administrators seek buyers. And the UK Chancellor Rachel Reeves is expected to meet top insurance chiefs in Downing Street today as she seeks to encourage more investment in the city ahead of her budget later this month. The talks with leaders from Lloyd's of London, Swiss Re, Aviva and many others will focus on unlocking capital and boosting growth. Separately, a think tank is warning Reeves will need to run primary budget surpluses to get a grip on the country's unsustainable debt trajectory. That's according to the National Institute of Economic and Social Research, which says an extra £50 billion is needed to guard against future fiscal shocks.
Coming up on the program, we're going to dig into the auto story after both BMW and Toyota use the T word, tariffs, in their latest earnings. Plus, of course, we're going to discuss what's next for the United States in the political sphere as President Donald Trump, of course, tries to push his agenda. And you have a series of Democratic victories highlighting a shift in sentiment. Up next, though, right back to the markets. Tech valuations driving the Nikkei and the Kospi lower. We're going to dive into that story next. If you have any questions of your own for us or for our guests involved in the conversation, IB plus BBTV Go is the function on your terminal. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Astonishing day for U.S. technology.
shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Minutes away from the opening trade. When you look at the futures picture, it's red, and the sell-off does indeed continue. It feels like it's getting worse by the minute. We're going to continue to see how this all unfolds ahead of the open here in Europe. Let's get a quick focus on what's going on over in Asia, because, of course, not such a great session there as well. Winnie Su joins us from Hong Kong. Winnie, walk us through it.
Yeah, indeed. It is a sea of red here in the Asia markets. You can see here on the board that the MSCI Asia is down about 1%, but it has been a very, very volatile session because we are seeing the losses trimming in the afternoon session. So these losses mainly dragged by the concerns around the high valuations for the technology shares, along with the prolonged U.S. government shutdown and also these warnings from the Wall Street CEOs. So basically, overall, a very risk-off mood, and you can see that also in these cross assets with the Australian bonds gaining and also the Japanese yen strengthening earlier today, pairing a bit of a strength here as we speak into the afternoon session. Now we flip the board and take a look at the South Korean market because it's basically where the most dramatic things were going on in the Asia markets earlier today. You've got the Korea Kospi benchmark down about 3%, and earlier today it was down 6%, led mainly by these chip makers, including SK Hynix here and Samsung Electronics. So based on our calculation, actually, the Asia chip stocks, along with the stocks index overnight, wiped out about $500 billion in market shares, so in market value. So that is really lots of profit taking that we are seeing with this big tech rally so far this year. Now flip the board and we take a look at the similar story going on with the Japanese market, again in the red here with benchmarks, topics, and Nikkei both down. And we are seeing Nikkei down a bit more just because it's more tech heavy, and hence we are seeing these profit taking from SoftBank and from Avantas. But overall, it has been a very volatile session for the Asian market today.
Winnie, thank you. Winnie Su in Hong Kong with that weakness from the US into Asia. Let's get a global conversation here about tech stocks and beyond. Becky Chin joins us, portfolio manager at Fidelity International. Becky, very good morning to you. So we have certainly seen a dip in US stocks, in Asia stocks. Maybe we're off the lows, but it does seem as if we saw a dip. Is that dip going to be bought? Do we continue to buy dips?
Sure. I think when we think about the dip that we've seen for the last 2 days, it's nice to contextualize it in the year-to-date gains as well. If we think about year-to-date, S&P is just about 2% of the all-time highs. So in a generally bullish market, I think it is usual to see a little bit of pullback, a little bit of correction. And if we bring it back to how, the fundamental and the macro policy side of things tend to work for markets, you've still seen from Q3 earning a very solid delivery from not only tech companies, but also broadening out of earnings beats. And so fundamental story remains quite strong. And the macro policy side, we're seeing not only growth, we think growth is going to muddle through this year, probably at trend, and inflation is probably above target, but not going to derail the Fed. And so we're still going to get a relatively supportive Fed as well as fiscal policy next year. And so this type of environment, when met with relatively elevated valuation, tend to create a buyable dip scenario.
Okay, tend to create a buyable dip scenario. That's interesting. So let me talk to you about breadth, because you mentioned breadth there, but on the earnings context. In terms of the breadth of the strength and weakness that we see coming through in US stocks, I've got an interesting chart here that shows the percentage of the S&P stocks that are above their 50-day moving average, and it is dropping. And I guess that plays to a lot of people's concerns about a lack of breadth in the US market. But you have a slightly different take.
Yeah, I think when you look at the overall earnings perspective, first of all, we're seeing clearly tech and financial leading the earnings speed, but the percentage of overall stocks and the number of sectors that are beating is also increasing from the previous quarter. So the operating performance of companies are broadening out a little bit. And indeed, we're seeing stock performance-wise, as you've quoted, narrowing a little bit. But if you look at the trend of, for example, small cap or equal weight, they're still looking relatively constructive. And with a dovish federal policy in terms of rate cuts and potentially, QT stopping and liquidity being sort of re-injected into the market, I think that should be a bit of a tailwind going forward to help with that breadth concern.
But if there is a breadth concern that's on valuations, why is it only on tech? And I think that's the part that I'm trying to understand. Is tech going to lead some sort of mini correction in luxury, defense, et cetera, on the side of the Atlantic? Is that where we're headed?
I think the focus on tech will probably have something to do with positioning, being, it has been a favorite sector for institutional investors as well as retail sector. So when we see correction, they tend to be, the focus for investors. We think valuation concern is legit, which is why I guess it's easy for me to say in my business, multi-asset, people tend to look for good risk-adjusted returns, so we tend to be quite diversified with hedges. But going forward, we still think earnings is probably going to take over the baton from PE to drive return for stocks going forward. And so that, by and large, I think is a broadly still constructive environment.
You mentioned hedges. What is the hedge to tech? So many people would say tech is the hedge. What's the hedge to tech?
Indeed. I mean, I think the definition for hedging assets will vary over time because as we have seen through 2022, correlations change over time. Sometimes it's going to be currencies. I mean, the yen and Swiss franc tend to work well. The dollar's hedging asset quality is being casted a strong doubt, I guess, over the past year. Sometimes it is bonds. We think that hedging quality is somewhat diminished this year. And most reliably, VIX put option tend to be the most reliable negative correlation to risk assets. So for us, it's about selecting a mix of hedging assets in the portfolio to make sure that there's resilience.
Gold, bonds, those?
Gold is interesting because we've seen such a sharp pullback recently. I don't personally think the gold story is broken yet. Clearly, gold also exhibited parabolic rise earlier this year as well.